Good morning, everyone. Okay, so last class we completed the discussion related to this interest under section 50 subsection 3, wrong availment and utilization of ITC. So now we are moving on to the other aspects. So we are right now into assessment and audit under GST. So kindly look into page number 174. Page number 174. And in this, so first I told you section 50 subsection 1 interest, that is interest on account of self-assessed liability for delay in filing pre-B, etc. These things we have seen. Section 60 interest will come into picture in case of provisional assessment. So just like in customs, whenever a person is unable to compute, that is a taxable person or a registered person is unable to compute their tax liability, they can make an application for provisional assessment and the officer will compute how much is the tax that the person needs to pay. That is called as provisional assessment, and upon finalization of assessment the differential tax will be payable. So that particular differential tax, while paying we have to pay interest. This is 18% per annum. In customs it is 15% per annum. In customs it is first day of the month in which provisional assessment is resorted, but here it is first day after due date till the date of payment. So first day after due date of the month in which tax is provisionally assessed till the date of payment of GST. Whereas section 16 is there, which says that if the recipient is not making payment to supplier within 180 days from the date of invoice, so much of the ITC availed by the recipient needs to be reversed along with interest at the rate of 18% per annum. And that interest always, in case of wrong availment of ITC, interest needs to be computed from the date of utilization till the date of reversal. So first day after utilization till the date of reversal. Then rule 42 also there is a interest, that is we need to reverse the proportionate ITC attributable to exempted supplies and proportionate ITC attributable to non-business purpose, and that again we need to compute at the end of the year. So monthly also we need to do the reversal, that is called as provisional reversal. At the end of the year also we need to do finally, and whatever we have already reversed is say less than what we need to reverse, that differential amount we need to pay along with interest at the rate of 18% per annum. From when we need to pay? From 1st April of the succeeding financial year till the date of payment. So month on month we need to compute D1 and D2. What is D1 and D2? D1 is inward supplies, that is ITC attributable to exempted supplies. How to calculate D1? So that is common credit C2 into exempted turnover divided by total turnover. So you will get the proportionate ITC attributable to exempted supply, and a proportionate ITC attributable to non-business purpose is 5%. So that we need to do month on month and again compare at the end of the year, that is this. Then in case of rule 43, rule 43 is in case of capital goods, which is commonly used for both taxable and exempted supplies. First we need to avail the ITC on capital goods, thereafter we need to reverse the ITC on capital goods over a period of 60 months. So how much we need to reverse? Monthly ITC, that is total ITC on capital goods divided by 60 months into exempted turnover of that month divided by total turnover of that month, that we need to reverse, and along with that we need to pay interest also at the rate of 18%, but in this case it is not from the date of utilization, it will be from the date of availment till the date of addition of proportionate ITC to the output tax liability. Then section 56, this is refund interest. Whenever we are getting the refund, we need to make application for refund. Once we make application for refund within 60 days, they need to grant the refund. If they are not granting refund within 60 days, from 61st day, interest will be payable at the rate of 6% per annum till the date of refund. Suppose if the refund is arising on account of any order of the adjudicating authority or appellate authority, then the interest rate will be 9% per annum and it will be computed same from 61st day from the date of application till the date of refund. That's the reason why we took in case of pre-deposit 9%, because that refund is arising on account of appellate authority. So 9% per annum should be taken for pre-deposit, and the pre-deposit interest, the 60 days is not applicable. It will be from the date of pre-deposit till the date of grant of refund of pre-deposit. And here they are telling first date after due date. So what is the due date? Due date will be due date of filing 3B. What is the due date of filing 3B? Usually 20th of the month following every month. And If there is any delay in filing 3B, interest is payable on net liability, provided the liability is reported in 3B, otherwise interest is on gross liability. Then look into this assessment under GST. Total we have 5 types of assessment. Self-assessment, that is where the taxpayer can compute how much tax he need to pay, that is known as self-assessment. Provisional assessment, where he is unable to compute, then he will make an application, that is provisional assessment. Then scrutiny assessment, whenever he files the self-assessment return, that will be taken up for scrutiny by the GST department and they will verify and they will be giving any notice in case of discrepancy, that is known as scrutiny assessment. And then we have best judgment assessment. In 2 places we will come across best judgment assessment. One is best judgment assessment on account of non-filing of returns, that is section 62. Then best judgment assessment with respect to unregistered person. There is unregistered person who is liable to pay GST but he has not paid GST. So why he is liable to pay GST means he made a suppression of turnover. So then it will be section 63. Then summary assessment will be section 64. This summary assessment is like income escaping assessment in income tax, the same logic, that is summary assessment under section 64. Now let's try to understand one by one. So self-assessment is section 59, and what is the status of the person? Registered person. So what this registered person will do? He will only compute how much tax he need to pay and file it in the returns. So it will be done by registered person. Notice not applicable. Situation, every registered person has to assess the tax payable and furnish the return. What is the time limit? Due date of return, that is usually due date of 3B, that is 20th of next month. And officer to take permission, not applicable. Withdrawal of order, not applicable. There is no consequences. Whereas if you see provisional assessment is section 60. So in that, status of the person is a taxable person, means even a person who is not registered also can go for provisional assessment. So who is not registered but liable to get registered. Okay, so taxable person means registered person or a person liable to get registered. And who will do this provisional assessment? Definitely it will be done by the proper officer. Notice there is no question of this because we are only making application for provisional assessment. What is the situation where the taxable person is unable to determine the value of goods or service, or both, or determine the rate? Unable to determine the value or unable to determine the rate, then they will be going for provisional assessment. What is the time limit? Provisional assessment order should be passed within 90 days from the date of receipt of such request. Means whenever we make application for provisional assessment, within 90 days they need to pass the provisional assessment order, and thereafter final assessment order they need to pass after provisional assessment order. That will be 6 months plus 6 months plus 4 years. This 90 days again we have come across in 3 places so far. Point number 1, in case of compounding, so we need to make application for compounding, and within 90 days they will be giving the compounding order. Then again advance ruling also, once we make application for advance ruling, they will pronounce the ruling within 90 days. Even appellate authority also pronounce the ruling within 90 days from the date we make appeal to appellate authority for advance ruling. And here again provisional assessment order also within 90 days from the date we make the application. Thereafter they will pass the final assessment order within 6 months. It can be extended for a further period of 6 months and plus 4 years. And from the provisional assessment order they can pass the final assessment order. So ample time is there, but in customs we don't have that much time. So there it will be 2 months. If the documents are submitted, 2 months from the date of submission of documents. If not submitted, 2 months on expiry of submission of documents, plus it can be extended for a further period of 3 months. So 2 months plus 3 months, like that it is there in customs. But here 6 months plus 4 years from provisional assessment order. So whenever you are reading, you need to connect this and read, because even not only this, income tax also when you are reading, so what is a provision in GST, that you need to refer. So little bit we will be lazy to refer. So our mind will tell it's okay, just read this, like that it will tell. No, don't do that. So you open another book, it will take little bit of effort. Okay, you have to get up and find another book and turn the pages. So that much of effort only you can put, because what will happen is that when you are trying to compare this, you will never forget. That is one advantage. Second advantage is it will definitely help in IBS exam. So in IBS exam also you will not make the mistake, because in IBS exam what they are doing is that in MCQs they are merging 2-3 provisions like DT provision and IDT provision, they are merging and asking. For example, last attempt they have given one question on TDS, that is income tax TDS is also there, GST TDS is also there. Merging those two, they have created one MCQ. So for that purpose, so while preparing itself, if you are able to connect this and prepare, it will be helpful for you. Okay. Then coming back to this, officer to take permission, no. So withdrawal of order, not applicable. Consequences, what will happen upon final assessment? So 3 possibilities could happen when the final assessment amount is less than provisional assessment amount. So which means that we have to pay the differential amount, and that differential amount will be at the rate of 18%. In customs it will be 15%. And from which date to which date? From the due date till the actual date. There, from the first date of the month in which provisional assessment is made till the date of payment of differential amount, that is this. Then pay the difference at 18% from the first date after due date till the date of payment. What if it is negative? Negative means what? Whatever final assessment amount is less than the provisional assessment amount, means we have paid the excess, that we will get as a refund, and for that we need to make application. Once we make application, within 60 days, if they are not granting only, from 61st day they will be giving interest at the rate of 6% per annum. But in customs it's not like that. 3 months. Here it is 60 days, there it is 3 months, and there the 3 months will be from the final assessment. As soon as final assessment is made, from there 3 months, if not they will compute interest. Application and all not there, for application plus 3 months is not there. Only provisional assessment gets finalized, from the date 3 months. Here final assessment plus 60 days, if they are not giving, then only interest will be payable from 61st day till the date of refund. Then next we have scrutiny assessment. Section 61, what will happen? Scrutiny assessment. So as per section 61 in scrutiny assessment, so status of the person, registered person, and it will be by the proper officer, and notice, yes, a notice will be given. So what will happen? Usually whatever returns that we are filing, those returns will be taken up for scrutiny by the officer, and those returns they will scrutinize. If there is any discrepancy, they will be communicating the discrepancy. For that communication of discrepancy only they will be giving this notice. So this will be done by the proper officer and registered person, because self-assessment is connected to scrutiny assessment and situation. In order to verify the correctness of the return, the proper officer may examine the return and seek the explanations. Time limit they have not given, but logically it should be within the time limit under 73-74, because if they are giving this notice beyond that time limit, how they will be able to recover? Because there is a maximum time limit for passing the order under 73-74, that is 3 years from the due date of filing annual return and 5 years from the due date of filing annual return. By the time only they can pass the order, na? So even though they have not given, but logically it should be before the order under section 73-74. Officer to take any permission, no. And withdrawal of order not applicable. What is the consequences? If the explanation is not obtained within 30 days or extended period. So first they will give a notice, that is intimation or communication of discrepancy. Within 30 days we need to respond. If not responded within 30 days or extended period, or registered person fails to take corrective measures, then what proper officer will do? Proper officer may conduct audit, that is departmental audit, or may order for special audit, or initiate any recovery. If the officer is having solid evidence about the tax non-payment etc., they will initiate recovery by passing order under 73 or 74, or conduct inspection. Which inspection? Inspection under section 67. Inspection with respect to the premises. Okay, so you can write there initiate, that is conduct audit. Audit, which section audit? Audit under section 65 or 66. 65 audit is departmental audit, 66 audit is special audit. Or initiate recovery, that recovery will be under section 73 or 74. If it is other than fraud, 73. If it is on account of fraud, then it will be 74. And conduct inspection, that inspection will be in terms of section 67. So inspection in the premises, okay, they can resort to any of these things, either audit, initiate recovery, or inspection. Then next we have best judgment assessment. Best judgment assessment. Sir, I request you to switch off ads. Long back we switched off ads. Yes, in our channel we have not monetized, we have switched off. Okay, so mainly because of students only. I was getting good YouTube revenue, So amazingly, per month I used to get 40 to 50,000 rupees as YouTube revenue, and I lost it because of you guys only, idiots. Okay, and so still again you are asking switch off the ads. So I switched off. Long back I have switched off. I am not getting any revenue also out of that. Then, so timing of lecture 9 or 9:30 a.m. 9:30 only, yaar. Every day it is starting at 9:30. Maybe you start at 9 o'clock today. Okay, no issue. You can revise. You have time to revise. And 9:30 to 6:30 daily I am taking like that only. Fine. Coming back to this. So best judgment, but of course I am not regretting. It's okay. 50,000 before you, 50,000 and all is small only. Okay, because no. You are important. 50,000 I can earn anytime, but you are important, correct? No. So for that reason. And best judgment assessment, section 62, that is non-filers of return. Whenever a person is not filing the return, so then officer will give a notice under GSTR 3A, and that notice under GSTR 3A will be given, and within 15 days from that notice. So usually we need to file return, just like income tax only. We need to file returns. We are not filing returns, they will give a notice. In pursuance of notice, we need to file the return within 15 days. Otherwise, they will initiate best judgment assessment under section 62. Status of the person, registered person. Who will assess? Proper officer will assess. Opportunity of being heard, yes. And GSTR 3A is the notice, not a separate notice here, but it is a notice under GSTR 3A. Situation where a registered person failed to furnish the return within 15 days from GSTR 3A notice. I told you already. And then what is the time limit within which this best judgment assessment order should be completed? Within 5 years from the date of 31st December of the financial year for furnishing of the annual return to which the tax not paid relates to, which means that we need to see the financial year, say financial year 25-26. For financial year 25-26, due date of annual return is 31st December 2026. From there within 5 years, just like 74 time limit. 74 also 5 years na, from the due date of annual return. Same logic here also. Officer to take permission? No need to take any prior permission. Withdrawal of order? Yes. What is the reason why they are going for best judgment assessment? Because we are not filing the returns. What if we file the returns and they will withdraw the best judgment assessment order? But what is the time limit within which we need to file the return? After best judgment assessment order, within 60 days, we need to file the return. So then they will withdraw the best judgment assessment order, and as per returns, whatever is your tax liability, you need to pay the tax liability. What if the 60 days is over? That is, best judgment assessment order is given, 60 days is over, I could not file the return. Can there be an extension? Yes, definitely there is an extension that is possible for a further period of 60 days. For that, what is the late fee that we need to pay? 100 rupees. But after 60 days, after 60 days, we need to pay 100 rupees. Subject to maximum, there is nothing like that called subject to maximum. 100 rupees per day. That's it. Okay. See this. So, where a registered person furnishes a valid return within 60 days of ASMT 13. ASMT 13 is assessment order, best judgment assessment order, and plus 60 days with a late fee of 100 rupees per day, shall be deemed to be withdrawn. However, interest will be payable. So once we file the return along with this late fee, so definitely they will withdraw the order. But this particular late fee, there are two types of late fees. The regular late fee is there for delay in filing return. Already I am filing late. There is a regular late fee under section 47 for delay in filing return. That late fee also will come, and this late fee also will come if it is beyond 60 days. So for the first 60 days, we have only regular late fee. I gave the chart in the next page, you can see. Late fee for filing returns after best judgment assessment order under section 62. So due date of GSTR 3B, and if 3B is filed after due date but before best judgment assessment order, after due date before best judgment assessment order, we need to pay a normal late fee. What is a normal late fee? 25 rupees per day, subject to maximum. That maximum differs. So that maximum will be, we have 1000 and 2500 and 5000. If my aggregate turnover during the previous year exceeds 5 crores, then it will be 5000. If my aggregate turnover during the previous year exceeds 1.5 crores but does not exceed 5 crores, half, that is 2500. If my aggregate turnover during the previous year does not exceed 1.5 crores, then it will be half, that is 1250. Ignore 250,000. Okay, so this will be, so 5000, 2500 and 1000. This will be the maximum late fee depending upon my aggregate turnover. This is under CGST Act. the equal late fee will be payable under SGST Act also. So that is the normal late fee we need to pay. After best judgment assessment order, within 60 days from best judgment assessment order, if I pay also same, the normal late fee, that is 25 rupees per day, subject to maximum 1000, 2500 and 5000 under CGST Act, SGST Act. Okay, if GSTR-3B is filed within 60 days. Thereafter, if I pay, that is after 60 days from best judgment assessment order, if I file GSTR-3B, then what will happen? For normal late fee also will be there. Normal late fee also will be there, plus additional late fee also will be there from 61st day. So that is 100 rupees per day. There is no maximum there, 100 rupees per day. But this 100 rupees per day is for a period beyond 60 days. Okay, that is additional late fee. This is also under CGST Act and SGST Act. Definitely in MCQ they can convert, like merge these two, and they can ask. Be careful, normal late fee also applicable and this additional late fee also applicable if it is beyond 60 days. That is about this, best judgment assessment, where the registered person furnishes a valid return within 60 days plus 60 days. Then look into another best judgment assessment, that is section 63. This best judgment assessment is with respect to unregistered person who is liable to pay GST. There is an unregistered person, but he suppressed the turnover, he is not got registered and he did not pay any GST. Then in that case, so the proper officer will compute the tax payable. And opportunity of being heard, of course, yes, notice will definitely be given. And situation where a taxable person failed to obtain registration even though liable to do so, or whose registration has been cancelled but still he is having some liability to pay. What is that liability that he need to pay? He need to pay the ITC with respect to inputs as such held in stock, inputs in WIP held in stock, inputs in FG held in stock, and even on capital goods. ITC divided by 60 months into balance life. So whenever we cancel our registration, we need to reverse the ITC on closing stock. So that we need to pay. Suppose if the person has not made the payment, then they can use this best judgment assessment, that is this. And what is the time limit? Same time limit, 5 years. 5 years from the due date of filing annual return for the respective financial year. Officer to take permission? No. Withdrawal of order? No. Here there is no withdrawal of order. We need to pay as per the best judgment assessment order. If you don't want to pay as per best judgment assessment order, go for appeal. So pay as per the assessment order or prefer an appeal if not satisfied with the assessment order. Then next one, section 64, summary assessment. Summary assessment will come into picture whenever the officer identifies some goods which are evaded and delay in passing assessment order, that person may escape from payment of tax. In that case, what they will do? Summary assessment they will do. And in case of summary assessment, no notice will be given. This summary assessment implication we have come across in two places. So one is in case of section 67, search will happen. Whenever the search happens, so what they will do is that, so they will do the seizure, and after seizure already one notice is given there. So what is that notice? For the purpose of paying the tax. So that's the reason why that is actually a summary assessment, wherein they are assessing and they are passing, immediately seizing the goods and asking you to pay. So again, even in case of section 68, that is situation 2, also we are seeing a kind of summary assessment. What happens is that when the vehicle is stopped and intercepted, they seize the goods and they seize the vehicle and they are asking us to make the payment. So that is what summary assessment kind of is. So whenever there is a delay in passing assessment order, the person may escape from payment of tax. They will invoke this power, that is summary assessment. But usually summary assessment rarely they will be invoking, because already we have that particular coverage. If they want to use this power, they can definitely use. This is one power which they have just kept it with them. So sparingly it will be used. Like how all history warriors and all are there na, this Mahabharata, wherein one Brahmastra will be common with everyone, but no one will use, because if they use entirely it will be over. So with just one Brahmastra, entire war they would have ended, but they did not end like that. So summary assessment is like this, completely killed. Okay, so status of a person, no notice, that is important. And section 64, status of the person, taxable person. Who will do this assessment? Proper officer will do the assessment. Situation, the proper officer has evidence that a taxable person has incurred a liability. Proper officer has evidence that the taxable person has incurred a liability, and proper officer has sufficient grounds to believe that delay in passing an assessment order may adversely affect the interest of revenue. In that case, they will pass the summary assessment order. And any time limit? No, they have not given the time limit. Officer to take any prior permission? Yes, they need to take the prior permission of additional joint commissioner, because they are going against the principles of natural justice without giving an opportunity of being heard, they are passing the assessment order for that reason. Withdrawal of order, yes. When it will be withdrawal of order, if the officer is of the opinion that no, he don't want to levy, he can withdraw, or upon request by the taxpayer, sir, I will follow the regular assessment process like 73, 74 itself, please withdraw this order, like that. When the request is made, thereafter officer can withdraw. So pay as per the assessment order, or if the order is erroneous, proper officer may withdraw such order and follow the procedure laid down in 73, 74. So that is about assessment under GST. Then look into audit under GST. And yesterday while discussing, I told you compounding fee is 25% to like 100%. But in the 25 to 100, that is the general compounding fee. But in one question actually, so it's a old past exam question in the solved workbook, it is given as some 50% to 150% like that. So you need to correct it. It is 25% to 100%. That is that. And there are some mistakes. Really, I'm extremely sorry, because how much ever I can incorporate, but because of the amendments and all, so some errors have come up. So that's the reason why I have just created one forum. So idtwizard.com like that, and in this forum, so whatever queries that you have, you can post it. So a lot of students are posting their queries and I am responding to those queries also, plus some frequently asked questions, like say for example some good questions are there which a student has asked. For the benefit of other students also, I have created this like GST for students. So chapter wise I have created, and this month, so after this batches and all get over, April month and May month I am fully free only. I don't have any other classes. I am all yours. So therefore I will be updating whatever queries that I am getting, I will update here. And even so these mistakes whatever I identify also, so based on the students, even I am also noting down. So this correndum to solved workbook I have given. So this you please check, no need to check regularly. So just one day you sit and you incorporate all these changes, small changes only it is there. So therefore you can incorporate these changes in your book, so that you will not have any kind of confusion, etc. Even when you are having like any query, like say whenever you are feeling free, you can just go through the queries which are posted by other students also, so that you will know, okay, this is the answer for this. Maybe suddenly we may not get that doubt, but after reading the question we also may get that doubt. So that's the reason why I created this. Please don't post anything other general about other things and all. So this faculty's book is available. I have this faculty video lecture. I am thinking of selling at 2000 rupees, whether you want. All these stupid things don't post. Make use of it only for IDT. Okay. Then next thing, say this audit under GST. So audit under GST, statutory audit, section 35 subsection 5 under GST stands omitted. So now we don't have audit. We have only self-certified reconciliation statement, GSTR-9C. And then we can see departmental audit and special audit. There are two types of audit. Departmental audit is section 65 and special audit is section 66. Who will conduct the department audit? Commissioner or any officer authorized to undertake audit will be done, whereas special audit will be by practicing CRCMA nominated by commissioner. When audit is conducted at such frequency based on the turnover that is yet to be notified. And special audit, if during scrutiny, inquiry or investigation it is found that value is not correctly declared or ITC irregularly availed. So special audit is only in case of value and ITC discrepancy. And what is the time period for completing the audit? Departmental audit 3 months plus 6 months. So therefore 3 months, it can be extended for a further period of 6 months by the commissioner. And in case of departmental audit, to whom the audit report will be submitted? It will be submitted both to the registered person as well as to the commissioner within 30 days of conclusion of audit. So therefore, what are all the audit objections which are raised by the officer will be known prior, so that we can voluntarily pay the tax. Thereby we can avoid the penalty, because in case of 73, before show cause notice if you pay, there won't be any penalty. In case of 74, before show cause notice if you pay, just 15% of the penalty you need to pay. For that reason only, the audit report will be made available to the registered person. And who will bear the expenses for the audit? It will be borne by the department. And next, what is the scope of audit? Will they audit all the accounts and records? Yes. In case of department audit, so there is nothing like they will audit only GST related records. Everything they can audit. Audit of all books of accounts and records maintained or to be maintained during the audit period. And notice for audit, yes, a 15 working days prior notice will be given. In customs it will be 15 days notice. Here it is 15 working days prior notice will be given prior to commencement of the audit. And whereas access to business premise also one 15 days is there, that is 15 days, not 15 working days. If you see offences and penalties chapter, offences, penalties, search and seizure, there I told you access to business premises section 71. In that access to business premises section 71, so whenever they wanted to ask like come and verify the records, they can verify, but that is 15 days. 15 days, whenever they demand within 15 days we need to give, but here it is not 15 days, it is 15 working days prior notice to be given before commencement of audit. And what if audit is already complete under any other law? So under this law also they can create the audit, means income tax audit is done, so can GST audit also be happening? Yes. And next we have special audit. So special audit will not be conducted by CA or CMA selected by the registered person, but it will be nominated by the commissioner. What is the time period? 90 days plus 90 days. Audit report shall be submitted to jurisdictional ACDC, and there won't be audit report submitted to the registered person. So it is like a surprise that the registered person don't know what are all the audit objections, and who will bear the audit expenses? Department. Scope of audit, they will audit only valuation related things and ITC related things. The scope of audit is very limited. Notice for audit, no notice will be given, but a direction to get audited will be given. What if audit is already completed? So audit under this section also can be made mandatory. Then audit by tax authorities can be conducted for part of a year, which means that, say for example, so I commence the business only in August. August to March is not even a year. So can they conduct the audit for August to March? Yes, for part of the year also they can conduct the audit. Then liability to pay in special cases. So these are some special points with respect to payment of GST. So who is having liability to pay tax? Generally FCM means supplier, RCM means recipient. But these are some special cases where there will be liability on other parties also. For example, in case of transfer of business, so any dues which are there before the date of transfer, both transferor and transferee jointly and severally liable. So I am selling my business to you. So before the date of sale, logically I should bear the liability, but if there is any tax dues before the date of transfer, both transferor and transferee jointly and severally liable for the dues. What if the business is transferred, thereafter there is some GST dues, only transferee will be liable. So that is this liability in case of transfer of business, transferor and transferee jointly and severally liable to pay dues with respect to pre-transfer period. Then liability of agent and principal. So every agent who is making supply on behalf of principal, when an agent will be making supply on behalf of principal, if the invoice is raised by the agent in his name, then the agent is acting on behalf of principal. Then in that case not only agent but also principal jointly and severally liable to pay the dues. Then liability in case of amalgamation or merger of companies. So in case of amalgamation or merger, till the time it is a notified date, there is one notified date, that is a court order date or NCLT order date. Till that order date they are treated as two separate entities only, even though in principle they got shareholders approval and prima facie they started making the transfers between them, but only when the court order comes, till that day they are not treated as merged entity, they are treated as two separate entities only, and transactions between them attracts GST. So order of amalgamation or merger passed on a date but effective from earlier date. For GST dues, two companies shall be treated as distinct, not merged till the date of the order. Liability in case of company in liquidation, this is subject to IBC. Subject to IBC. So whenever a company is liquidated, so normally means IBC is not applicable. In that case one official liquidator will be appointed. That liquidator should notify his appointment within 30 days, and thereafter the commissioner within 3 months, next 3 months, will notify the GST dues, and those GST dues the liquidator should consider as first charge and need to make the payment. Then if a company is a private company, even though it gets liquidated, but the directors are jointly and severally liable. So every director of a private limited company, even if the private limited company is liquidated, jointly and severally liable. Then what about the liability of a directors of a private company during the time when the company is in existence, not liquidated? Even then, if the company has not paid the GST dues, the GST dues can be recovered from the director of the company. Sir, but company is a limited liability now, sir. Yes, for shareholder only limited liability, not for the director. So for director there is unlimited liability, okay. So that is this. If a company is a private company, all directors shall remain liable jointly and severally. So just like that, when someone is telling you become the director of my company, be careful. Unless you know them, don't become director of their company, okay. Then however, if a private company is converted to public company, then director shall not be liable, okay. Then next. Why? Because in case of public limited company, this provision is not applicable. In case of public limited company, that liquidation process or IBC only will come. Then what is the liability in case of partners of a firm? So firm and partners are jointly and severally liable. If a firm has not paid the GST dues, the partners has to pay the dues. And what about retiring partner? Retiring partner is liable to pay dues till the date of his retirement, provided he gives a notice of his retirement within 1 month from the date of his retirement. If he is not giving the notice of his retirement within 1 month from the date of his retirement, then till the date he is giving the notice of his retirement, he need to pay the dues. So retiring partner will continue to be liable till he gives his notice of retirement to the commissioner, if such notice is not issued within 1 month from the date of the retirement, okay. Then next, section 91, liability of guardians or trustees. So guardians or trustees will be appointed for the purpose of a minor or incapacitated person or a trust. So therefore they are liable to pay the dues, but generally contract with minor is void. So therefore GST liability shall not arise. Like that we cannot say, as if minor is doing business becoming major, or as if incapacitated person is doing business as capacitated person. What are all the liabilities, including the prosecution liability, that is imprisonment liability, will be served upon by the guardian or by the trustee, etc. For example, there is a minor. In the name of the minor, the guardian is taking care of the business, and there is some GST fraud, and the GST fraud is more than 2 crores. Then in that case, can the guardian be imprisoned? Yes, of course. Minor cannot be imprisoned, so guardian will be imprisoned. That is this point. So guardians, trustee of a minor or incapacitated person, liable for dues as if minor was major and conducting business himself, or incapacitated person was capacitated and conducting business himself. This is as good as in Motor Vehicle Act. So whenever a minor is driving a vehicle and he hits any other person, then his parents will be arrested and imprisoned. So that logic only, okay. Next, liability of court of wards. In case of court of wards will be coming into picture whenever there is no guardian for a minor. So there is a minor and he is having lot of estate, means lot of wealth, but there is no guardian for that person, and the court only will appoint one person to look after his assets. So that person will be called as official trustee or administrator general. So that, or any manager, that person is liable to pay the dues. So this 91 and 92 are connected. Then 93, death of a person. What is the liability of legal representatives? Whether the legal representatives inherited any wealth, yes. Whether they continue the business or they are not continuing the business, you need to check. Suppose if they are continuing the business, whatever may be the wealth that they have inherited, irrespective of that, they need to pay the GST dues. Suppose if they have not continued the business, then to the extent of the wealth they have inherited, to that extent they need to pay the GST dues. Say for example, GST dues of the father is 1.5 crores and the wealth that is inherited is only 1 crore. Now if they continue the business, they have to pay entire 1.5 crores. If they are not continuing the business, they need to pay only 1 crore to the extent of estate inherited by them. Then HUF, business discontinued, that we have seen, HUF or AOP, partition of assets among the members. Each member will be jointly and severally liable even if after the partition. So say for example, 4 brothers started a business together and they created a HUF, and now the HUF got dissolved and partition happened. Even then, so before the date of partition, whatever is the dues, all the brothers are jointly and severally liable. Same is applicable in case of partnership firm being dissolved. So then also all the partners are jointly and severally liable. And termination of guardianship and trust. Even after termination of guardianship and trust, before the date of termination, if there is any dues, the guardian and the trustee is liable to pay those dues. Then section 94, liability in other cases, partnership firm, HUF or AOP, business discontinued. Can the assessment be still completed? Yes. And partnership firm, HUF or AOP, change in constitution. Partners or members will remain liable. For example, there is a newly admitted partner. When the newly admitted partner is there, so before the date of his admission, there is some GST dues. Whether the newly admitted partner is also liable for those dues? Yes. So because jointly and severally, change in constitution. Partnership firm, HUF or AOP dissolved. So still the partners or members will remain liable jointly and severally. So these are the points mostly, somewhere in MCQs, case scenario MCQ, somewhere like one MCQ they may ask on this, but otherwise there won't be any separate question on this. So this is about assessment and audit. Now we are moving on to refunds under GST. Refunds under GST, and they have, before moving on to this, yesterday one student asked me this query. So related to one question we did na Nitya, like that one question related to payment process. So in study material it seems they have made the correndum related to this. So let me check. I think it is module 3. So this is the question. This is the question. From this question only I was explaining yesterday, and 75,000, 40,000 and 80,000 they were having, and whether interest is computed or interest is not computed in this. So for this question, for 35,000 there is a shortfall and transferred, but about interest computation they have not given anything, correct? Yes, about interest computation they have not given anything. They are not telling whether interest is applicable or interest is not applicable. Okay, so they have not given any information about it. And let me check the correndum also. This updated only, no? Okay, this updated only. So they have not given anything about interest. I mean, whether interest is applicable or interest is not applicable, both points are silent, because the question itself they changed. The question they are telling whether they can utilize it or not. But logically, if the interest related question, that's what usually whenever there is a dispute etc. in provisions and all, ICA will not interfere in that and they will ignore that question. So therefore still whatever answer I gave is valid, okay, because in that question there is nothing about the interest computation, okay. So therefore whatever yesterday I said is not wrong. Then can you also please explain question number 16, amendments in valuation? I explained no yaar yesterday. Question number 16. Already in YouTube, you can watch it again also. So this question already explained here, this question. So please watch in YouTube. So go to YouTube, just to scroll, you need to go like this, cursor, you need to go like this, you will be able to see that. Sorry, don't think that I am rude and all, it's already recorded, I am giving live. Still what you want me to do, I don't know. If you ask me doubt, no, like sir this is the doubt, means I can explain. Explain entire question means already it is there, you can watch that. So there is a limit bro for everything. You are taking me on a raid, okay, but I am being polite. Then so we are moving on to refund under GST segment 16, and refund of GST is possible in the following cases. So this is just an illustrative list. So refund, actually this attempt, no, again I am expecting a question, because November one question also they did not ask on refund. In the main paper IDT, even in IBS also they have not asked. So there is a high chance of asking a question on refund. So mark my words. So this is also, I told you 3 guaranteed question. Question number 1 on that, like compounding, not compounding here, appeals I told you, then corporate guarantee I told you, then refunds. These 3 questions, okay, guaranteed, trust me, 15 marks already I told you. And refund is possible in the following cases. So this is just an illustrative list, but various cases where we are getting refunds I have given here. First one, refund of IGST paid on exports or zero rated supplies. So whenever we are making zero rated supplies, what are zero rated supplies? Export of goods or services, supply of goods or services to SEZ is known as zero rated supplies. In case of zero rated supplies, I have two options. Option number one, I will pay IGST and I will get the refund of that IGST. Option number two, I will not pay any IGST but I will get the refund of ITC, means it is export under bond or LUT and I'll get the refund of ITC. So you can see refund of IGST paid on export, refund of unutilized ITC. What are the two cases where we will get refund of unutilized ITC? One is zero rated supply, another is inverted tax structure. What is inverted tax structure? The tax rate on output is less than the tax rate on input, then it will be inverted tax structure. Tax rate, not tax payable, tax rate. Then third one, refund on account of deemed exports, that is sale to advance authorization holder, sale to EOU, EPCG, or sale to three people, sale to AA, sale to EPCG, sale to EOU. So these three transactions will be called as deemed exports, not only under FTP but also under GST. So in case of deemed exports, there are two options that is available. So I am a supplier, I am making sale to you. You are an advance authorization holder or EPCG holder or a EOU. Whenever I am making sale to you, I will not charge any GST from you, which means that you have procured from me without payment of GST, and I will pay GST out of my pocket and I will get the refund. This is option number one. In case of option number two, I will regularly collect GST from you like a normal transaction and you have got the tax burden and you will get the refund. That is in case of option two, deemed exports. Okay. And number four, refund of balance in electronic cash ledger. Whenever we have deposited some excess balance in the cash ledger, we can get the refund of that. And refund on account of issuance of refund voucher. So initially, whenever the advance is collected, a receipt voucher will be given. On that advance, already tax would have been paid, and thereafter the supply gets cancelled. When the supply gets cancelled, I will be giving a refund voucher. So whenever I give the refund voucher, but already tax I have paid, so whatever tax I have paid on advance, that I can claim as a refund based on this refund voucher, that is known as refund on account of issuance of refund voucher. Okay. Then refund on account of wrong classification. Wrong classification means intrastate supply is treated as interstate supply and vice versa. Then in that case, we will pay the correct tax and get the refund of wrong tax. That is this. Refund on account of provisional assessment, already we discussed. So whenever upon finalization the final assessment is less than provisional assessment, we will get a refund. Refund on account of judgment, decree or order. Suppose if we have paid some tax and thereafter we made appeal against it, whatever tax that we have paid, we will get as a refund, including the pre-deposit refund also. Then refund to UIN holder. Who is a UIN holder? Unique identification number holder, that is UN agencies or embassies or consulate. Basically their outward supplies are exempted, and whatever inward supplies that they are having on the GST paid, they can get as a refund, that is refund to UIN holder. And refund of excess payment of tax. Normally sometimes by mistake we will pay the excess tax, that also we can claim as a refund. And refund to unregistered recipient. Say for example, you have made a marriage hall booking, and in case of marriage hall booking, they are collecting some advance 1 lakh plus 18% GST, 1,18,000 from you, and thereafter you cancel the marriage hall booking. Then in that case, they have not returned you 1,18,000, they refunded you only 1 lakh. That 18,000 rupees is still, there is a burden on you. That 18,000 rupees you can claim as a refund. So that is known as refund to unregistered recipient if supplier has not issued a credit note or supplier has not issued a refund voucher. Then the recipient also can claim the refund even though they are unregistered person. That is this refund to unregistered recipient. Then next, refund subject to unjust enrichment. What does it mean? Every person should prove that, so I have not transferred, they have not transferred the burden to the next person. Prima facie, it's a reasonable assumption both in GST as well as in customs is that whenever they are claiming for refund, which means that indirect tax is basically a tax which can be recovered from next person. So it's a reasonable presumption that they would have recovered from the next person. So they need to prove that they have not recovered it from the next person. That is known as refund subject to unjust enrichment. But in case of customs, how to prove unjust enrichment? Through documentation. So we need to show the invoice, etc. and all, and we need to prove. But in case of GST, it is very simple. So just a declaration. If the refund amount does not exceed 2 lakh rupees, just a declaration, self-declaration that I have not transferred the burden to the next person. Whereas in case when the refund amount exceeds 2 lakhs, I need to get a certificate from a CA/CMA that I have not transferred the burden to the next person. So that is how I need to prove. And in customs also there are few cases refund is not subject to unjust enrichment. I told you it is important for theory etc. and all. That is when the goods are imported by individual for personal purpose, or in case of duty drawback, or a refund under section 26, that is refund of export duty. Like that some situations we saw. Like that here also in GST there are some situations where refund is not subject to unjust enrichment, means we don't have to give declaration nor we don't have to submit any certificate from CACMA. That is this. Refund subject to condition that there is no unjust enrichment, that is refund shall not be granted if the registered person failed to prove that burden is not transferred to the recipient. To establish that there is no unjust enrichment, a declaration by registered person is required if the amount of refund does not exceed 2 lakhs. If the refund exceeds 2 lakhs, a certificate from CACMA. If declaration or certificate not submitted, what will happen? That amount will be transferred to Consumer Welfare Fund. Refund application cannot be filed and such amount shall be credited to Consumer Welfare Fund. These are the situations where we don't have to prove unjust enrichment. So even if the amount exceeds 2 lakhs or it does not exceed 2 lakhs, neither declaration nor certificate from a CACMA. What is that? First case, refund of IGST paid on export of goods or services, not SEZ, not SEZ. Refund of IGST paid on export of goods or services, no need to prove unjust enrichment. Export, refund of IGST paid on export of goods or services. Number 2, refund of unutilized ITC, all cases, both zero rated as well as inverted tax structure. Then refund arising on account of refund voucher, and next refund on account of wrong classification. Then refund of excess balance in the cash ledger and refund claimed by the unregistered recipient. So these are the 6 cases where we don't have to prove unjust enrichment. Okay. So this again important for theory. They can make a short note question related to this, or they can make an application question also. Just remember these 6 cases. One is export of goods or services upon payment of IGST, not supply to SEZ, not supply to SEZ, only export of goods or services upon payment of IGST. Then unutilized ITC on account of both the cases, that is zero rated as well as inverted tax structure. Then refund voucher, then wrong classification and excess balance in the cash ledger and refund claimed by the unregistered recipient. Then Consumer Welfare Fund section 57 and 58. What happens if an applicant failed to prove unjust enrichment? Such amount will be credited to Consumer Welfare Fund. Also, any income arising out of that fund will also be credited to that fund only, and committee will be appointed for the purpose of utilization of such fund, and any amount having been credited to Consumer Welfare Fund, ordered or directed as payable to any claimant by orders of the proper officer or appellate authority. Suppose if the recipient is coming and claiming refund, so it will be given. So first it will go to Consumer Welfare Fund, and the incidence is borne by the recipient, so recipient can claim for the refund, so then it will be given to the recipient. Or the person only will tell the government, like will go to a court and appeal he will be making, and he will state that, sir, they have rejected my refund application, everything is correct, so I need to get the refund. Already it is credited to Consumer Welfare Fund, from there it will be paid to that person. That is the meaning of this. Either by order of proper officer or appellate authority or tribunal or court, it will be paid from the fund. Next, interest on refund. So what is the interest rate on refund? 6%, and it should be computed from which date? 61st date from the date of application. So first we need to make application for refund, and thereafter 60 days they need to grant the refund, otherwise it will be 6% per annum. Whereas if the refund is arising on account of any adjudication order or appellate order, the rate of interest will be 9% per annum. Then this is the refund process. So what will happen? First, there is a person, any person can go for refund. I told you even unregistered recipient also can make an application for refund. So any person can make an application for refund. So within 2 years from the relevant date, they will make application for refund, and the application for refund is in RFD 1. Once they make application for refund, so thereafter within 15 days, the proper officer will verify that refund application. If everything is fine or perfect, then they will accept the application. So they will give an acknowledgement. So acknowledgement in RFD 2. So suppose if there is some discrepancies in the application, refund application, then the refund application will be rejected. So for that they will be giving a deficiency memo in RFD 3, which means within 15 days from RFD 1, either we will get a deficiency memo in RFD 3 or we will get a acknowledgement in RFD 2. Suppose if we get a deficiency memo in RFD 3, then again we need to make a fresh application, so in RFD 1. And again within 15 days they will check, and if it is proper they will give an acknowledgement. So therefore, second time when we made an application for refund, that is the application of refund. So previous application which was rejected will not be considered. So therefore, the date of application will be specified in the acknowledgement. That is so crucial, because suppose if the application is not made within 2 years from the relevant date, the application stands rejected automatically. So for that reason, then in the acknowledgement they will specify the application, and after acknowledgement what will happen? If it is zero rated supplies, only for zero rated supplies they are giving a provisional refund. That is prima facie, when the application is accepted within 7 days from the date of provisional acknowledgement, not from the date of application, within 7 days from the date of provisional acknowledgement. So that is this acknowledgement they gave na, acknowledgement in RFD2. So within 7 days from the date of this acknowledgement, they will be giving a provisional refund. So what is that provisional refund in RFD4? What is the time limit? 7 days or 7 working days? 7 days from acknowledgement. And provisional refund order RFD4, then it will be released to the person. How much is the provisional refund? 90%. Refund order will be RFD4 and payment order will be RFD5. So RFD4 is for sanctioning the refund, RFD5 is for releasing the money into the bank account of the person, 90% of the refund claim. And in this case, it will be either credited to the consumer welfare fund or credited to the bank account of the applicant. If the person has not proved unjust enrichment, it will be credited to that is not proved unjust enrichment, credited to consumer welfare fund, otherwise it will be given to the bank account. But sir, I have a doubt. First of all, in case of zero rated supplies, there is no need to prove unjust enrichment. Then why it is given? No, we have to prove unjust enrichment in zero rated supplies in one place. Generally, on export of goods or service only, we don't have to prove unjust enrichment. So there are two options for zero rated supply. One is pay IGST and get refund of IGST. Again, zero rated is divided into two, exports and supply to SEZ. That's what I told you, I was stressing this. Supply to SEZ on payment of IGST, we need to prove unjust enrichment. So that's the reason why for zero rated in that place we have got it. So in which place we need to prove unjust enrichment even though it is zero rated supply? In which case we need to prove supply to SEZ. Supply to SEZ upon payment of IGST. Upon payment of IGST, even though it is zero rated, we need to prove unjust enrichment. Okay, otherwise it will be credited to consumer welfare fund. And thereafter you can see here, suppose if it is other cases other than zero rated supply, or the 10% balance, that is 90% already here claimed na, the remaining 10%, refund with respect to other case and balance refund in case of zero rated supply. What is the treatment with respect to that? Within 60 days from application, three things can happen. Either they will sanction the refund, that is final refund order RFD6 within 60 days from application, not acknowledgement, application. So either they will sanction the refund or they may adjust it against the liability, because yesterday in demand and recovery I told you one of the mode of recovery is that deduction of any money owed from government. So if government is required to give any refund and already recovery process is on, from this it will be taken, from the refund it will be adjusted, that is this adjustment against liability order RFD7. Or they may give a notice for rejection. Suppose if they are of the opinion that refund should not be sanctioned, they will be giving a notice. So within 60 days from the application, these three things can happen. Either they will sanction the refund, or they will adjust it against your liability, or they will give a notice for rejection. If they sanction the refund, what will happen? Simple. If the unjust enrichment is proved, it will be credited to bank account. If unjust enrichment is not proved, that is, then it will be going to consumer welfare fund. Then suppose if it is adjusted against a liability also, no issue, gone, our liability is paid through our refund. Whereas if they give a notice for rejection, thereafter we need to give a reply to the notice. What is the time limit? Within 15 days we need to give reply, and thereafter proper officer satisfied with the reply will give final refund order, otherwise application will be rejected. There is refund rejection order in RFD6. So therefore, after reply anything can happen, either they will process the refund or reject the application, but both things will happen in RFD6 only. Then provisional refund would not be granted. So generally provisional refund will be granted 90% of refund claim, but this will not be granted if the applicant was prosecuted for an offence where the tax evaded exceeds 2.5 crores, more than 2.5 crores tax, not refund, not value, tax, and that evaded exceeds 2.5 crores during any period of 5 years preceding the refund period. So today is the refund period. So from this period within 5 years backwards, any time if he has been prosecuted for an offence. So 2.5 crores means definitely imprisonment is there. So prosecuted means there is imprisonment, okay. So exceeds 2.5 crores, then provisional refund is not possible. That is with respect to this, okay. Next, we have procedural aspects. First, what is the application for refund? RFD 1. But in case of UIN holder, the application for refund will be RFD 10. And in case of export of goods upon payment of IGST, it will be shipping bill. So an application for refund RFD 1. And in case of refund to UIN holder, it is RFD 10. In case of refund of IGST paid on export of goods, it will be shipping bill, which is filed under the customs. So that shipping bill itself will be taken as application for refund, and the customs officer will process the refund. And whether for making application for refund, Aadhaar authentication is mandatory? Yes. Aadhaar authentication mandatory for filing refund application. What is the time limit for filing refund application? Within 2 years from the relevant date. But while computing the 2-year period, from the date of filing refund claim till the date of communication of deficiency shall be excluded. So what does it mean? Say for example, there is a relevant date. There is a relevant date, and that relevant date is somewhere like 5th of March 2024. 5th of March 2024 is the relevant date. From the relevant date, I need to make application for refund, okay. I made the application for refund, that is RFD 1. RFD 1 has been filed, and RFD 1 has been filed somewhere on 25th February 2026, okay. 25th February 2026 we filed RFD 1. Is it within 2 years or beyond 2 years? Of course, within 2 years. 2 years we filed. And thereafter what happened? They have given a deficiency memo to us, and that deficiency memo is in RFD 3. That deficiency memo is given somewhere on 2nd March 2026. They gave a deficiency memo, and it should be within 15 days, correct? It should be within 15 days. Is it within 15 days? Of course, yes. Within 15 days they have given the deficiency memo, and thereafter we made the refund application. So that is revised refund application. When we made the revised refund application, that is revised RFD 1. Revised RFD 1. This revised RFD 1 is filed on 8 March 2024. Okay, we rectified it and we made the revised refund application. If you see, 26 we made the revised refund application. If you see, from relevant date to revised refund application, it is beyond 2 years. So what is the time limit? 2 years, 3 days, correct? 3 days, 2 years plus 3 days. Now what is this provision says? This provision says, from the date you made the refund application till the date you got the deficiency memo, okay, from the date you made the refund application till the date you got the deficiency memo, how many days we have? 25 means 26, 27, 28, 3 days and 2 days, so minus 5 days. Minus 5 days needs to be reduced so that it will be within 2 years. It will be within 2 years. Therefore, refund application filed on 8/3/2026 is accepted. So they will accept this refund application, because we need to adjust this, even though it is overall period beyond 2 years. Overall period beyond 2 years, but this period needs to be excluded. That is this wording. Time limit for filing refund claim within 2 years from the relevant date, while computing 2 years period from the date of filing refund claim till the date of communication of deficiency shall be excluded. And this time limit of 2 years is not applicable in case of refund of excess balance in the cash ledger. So whenever we have some excess balance in cash ledger, time limit not applicable. Like this, in customs also one place time limit is not applicable, that is payment of duty under protest. So in that case also, generally time limit in case of customs refund section 27 is 1 year from the relevant date, but in case of payment of duty under protest, the time limit is not applicable. So here also balance in excess balance in cash ledger, time limit of 2 years not applicable. Then how to count these 2 years time limit? So relevant date is what? Depending upon the situation, the relevant date will change. So this you need to remember. You know why? Because already they have asked one MCQ in the past. So they have given one MCQ wherein 4 dates they have given in the question, and they are telling what is the relevant date for refund application. The refund application should be filed on or before. 4 options they have given. You take any date and add 2 years, you will get that option. 4 dates they gave in question plus 2 years if you do, you will get. So what we will think, any one date randomly we would have taken plus 2 years, option is there, means answer is correct. Okay. So all answers will be correct only. Actually you do a mistake, and for that mistake what answer will come, that's how they will create the option. So for option itself they will be spending a lot of time. So for creating the MCQ options, it's not about question they will spend time. For options they will spend time, so that you know a mistake is done, you will end up with the answer, that answer will be there in the option. Be careful. Just because you got an answer, that answer is there in the option does not mean your answer is correct. Okay. Then so coming back to this, relevant date for computing 2-year time limit in case of export of goods. So in case of export of goods, logically what is the relevant date? The date on which goods leave the country. So date on which goods leave India. In case of export of services, generally export of services 5 conditions should be satisfied. Supplier in India, recipient outside India, place of supply outside India, consideration should be in convertible foreign exchange, supplier and recipient are not two establishments of the same person. So should be received in convertible foreign exchange, which means that only when we receive the money it will be treated as export of services. So even though we raised invoice, so the relevant date is only when we receive the foreign exchange. And suppose if we already received the foreign exchange but we have not yet raised the invoice, then whenever you raise invoice from there 2 years. So refund can be claimed based on invoice date or payment date, whichever is later. Tax will be payable based on invoice date or payment date, whichever is earlier. Whereas in case of refund it is whichever is later. This is another place where we are coming across whichever is later. So mark this. So invoice date or payment date, whichever is later will be taken. Then next, deemed export. Deemed export, actual date of 3B and supply to SEZ and inverted tax structure, due date of 3B. Generally we need to take due date of 3B, but in this place for deemed export, D already came, that's why actual date. You understood? Generally what is the time limit here? Relevant date is due date of 3B pa. Supply to SEZ, inverted tax structure, due date of 3B. Okay, but in case of deemed export, already this D came here na, so that's why actual date of 3B. You remember like this. Okay, so somehow you need to remember. If you have any other way also you remember. And so then refund on account of judgment, this is easy, the date of judgment. And refund on account of provisional assessment, whenever provisional assessment got finalized, final assessment. Then refund by recipient, whenever he received the goods or services. Refund by unregistered recipient, that is date of cancellation letter, that marriage hall booking example. So whenever the cancellation letter is given by supplier to recipient. Any other case, the date of payment of tax. So these are the points you need to remember. Very, very simple only. Export of goods, the date on which goods leave India. Export of services, invoice date or payment date, whichever is later. And any other case of zero rated, that is refund of unutilized ITC, either zero rated or inverted tax structure. We need to take due date of 3B, that is supplies to SEZ. Export of goods services over, what is remaining? So supplies to SEZ and inverted tax structure, due date of 3B. Whereas in case of deemed exports, it is actual date of 3B. Then refund on account of judgment decree, date of judgment. Provisional assessment in case of final assessment. And then in case of refund claimed by recipient, whenever he received the goods or services. If he is unregistered, the date of cancellation letter, or any other case, date of payment of tax. Got it? So next, withholding of refund. Why will they withhold the refund? If there is any order against a person for which recovery process is on, if there is any outstanding demand against a person to whom refund is payable, then such person can pass an order for withholding the refund. Where proper officer or commissioner is satisfied that the refund is no longer liable to be withheld, then he may pass an order for release of the withheld refund in prescribed form. Proper officer is required to first pass an order for release of withheld refund and then pass the refund sanction order. That is like whenever the recovery is made, already collected, so thereafter this refund may be paid back. Then next we are looking into some specific situations. Sir, with respect to provisional refund, can you please clarify whether the evasion of tax exceeding 2.5 crores is for a period of consecutive 5 years or for any 5 years? For any 5 years. For any 5 years. Okay. Any period of 5 years. Okay. Not consecutive 5 years. Consecutive 5 years means what kind of a moron he will be here. Like every year how he will go for imprisonment here. How it is possible? So, imprisonment and all cannot be happening every year. So, in any 5 years, once it exceeds 2 crores, what is the imprisonment? 2 years. How every year he can go for imprisonment then? Maybe he will clone himself, okay. So, not practically possible. Refund in case of zero rated supplies. What is the refund in case of zero rated supplies? That is in case of exports. Basically see this. So, usually what happens is that there are two options for export. Pay IGST, we are discussing IGST. The exporter may supply goods or services subject to such conditions, safeguard and procedure as may be prescribed on payment of IGST and claim refund of such tax paid. And there are certain cases where refund is not possible even though we have paid IGST on export, that is notified goods. So those notified goods are tobacco and tobacco products, pan masala and tobacco products, and essential oils other than those of citrus fruit. You can see government notifies certain goods with respect to which refund cannot be claimed on export, that is pan masala, tobacco products, essential oils other than those of citrus fruit. Then whenever we export upon payment of IGST, who will be processing the refund claim? Customs officer will process the refund claim. That's the reason why the shipping bill itself will be taken as a refund application. When customs officer process the IGST refund, what is that they will verify? First they will verify the export manifest, export report and departure manifest filed by the person in charge to know whether the goods are really leaving the country. Number two, they will verify our GSTR-3B to know whether we have really paid the IGST, because this which option? Pay IGST and get refund. So these two things they will verify. First they will verify the export manifest, departure manifest or export report to know whether the goods have left the country. Second, they will verify GSTR-3B. And there is one very important point. That is, suppose if you have imported any goods on which you have not paid anything, customs duty, IGST, nothing. So your tax incidence is zero. Now when you are exporting, so you cannot go for this option of payment of IGST. Why you cannot go for export upon payment of IGST option? First of all, you don't have the burden of tax on import. When you don't have the burden of tax on import, there is no question of refund. So because the refund is given only when you have some tax burden on your inward supplies. So this point is there. So I am making some purchases. On those purchases I have not paid any tax, and now when I am exporting, can I claim any refund? No. So I cannot claim any refund in this case. Is it clear? And however, so there are many instances wherein lot of people have imported goods without payment of basic customs duty, IGST, etc. under an exemption notification, but they have made an export, and export at the time of export actually they don't have to pay IGST, but unnecessarily they paid IGST, and now they are claiming the refund, and the refund is getting rejected, for which the people went and complained with the finance minister that we don't know, we already paid IGST. What is the relief for that? For that purpose, what she is telling is that don't worry, at the time of import you did not pay, now you pay. Now you pay along with interest under customs, not under GST, under customs. And what, madam, should we pay? Basic customs duty, social welfare surcharge, everything? No, that and all you don't have to pay. Just IGST and GST compensations, if applicable, that alone you pay. When you need to pay, now you need to pay. Then on export, whatever IGST you paid, that we will get as a refund. What if I have exported without payment of IGST? Congratulations, very good, keep it up. So whereas if you have exported upon payment of IGST, then you will get the refund. Definitely you will get the refund, provided you need to do one thing. What is that? On import, whatever you have not paid, now you need to pay. Means, should I reassess the bill of entry? Yes. Go to the customs portal, select the bill of entry, request for reassessment. They will do reassessment and they will ask you to pay the IGST and compensations. Pay that along with interest at the rate of 15% per annum. And then here, whatever you have exported, IGST already you paid that, you will get as a refund. If you need this money, you have to give something. You understood or not? So, like rather than asking below the table, they are asking above the table literally. So say this, whether refund of IGST paid on export is available if the inputs used in such exports are imported without payment of customs duty including IGST or GST compensations as under an exemption notification. if goods are imported without payment of customs duty, including IGST or GST compensation cess, refund of IGST paid on export is not available. Why not available? Because you have imported without payment of customs duty. Okay. However, if only basic customs duty is exempted, but IGST or GST compensation cess is paid, then the condition is not violated and refund is available. So, if initially goods are imported without payment of IGST or cess, but later paid along with interest, refund of IGST on export shall be sanctioned, provided reassessment of bill of entry is completed under customs, which means this IGST and compensation cess is not payable under GST, it is payable under customs. In this regard, I have created one question. You can have a look into that question here. Say this, question number 25. Question number 25. ABC Exports Private Limited, an Indian exporter, imported raw material worth 10 crore on 1st January 2022 for manufacture of goods intended for export. At the time of import, ABC Exports availed exemption under notification 78/2017. So at the time of import, what this person did, they did not pay customs duty worth 10 crore worth of raw material, they did not pay customs duty including IGST and compensation cess, while only availing exemption on basic customs duty. Subsequently on 31st March 2024, so after some time, after 2 years like that, because 1st January 2022 is the date of import, on 31st March 2024, the company realized that they were not eligible for a refund of IGST paid. They already paid. Had they know this provision, they would not have paid IGST on export. They would have went for export without payment of IGST option, but they have paid. Okay, it's a post-mortem exercise what we are doing now. Paid IGST on export of 20 crore as per Rule 96 sub rule 10 of CGST rules. Means this 20 crores is gone? Yes, this 20 crores will be lost. But to recover this 20 crores from government, so there is a way. What is that? On this 10 crores, whatever IGST and compensation says that we need to pay along with interest. Due to the availed exemption on import inputs, to regularize their position, ABC Exports now intends to pay IGST and compensation cess along with interest on the imported inputs to claim the refund of IGST paid on exports. Details of the case: value of inputs imported 10 crore, basic custom duty 10%, IGST 18%, compensation cess 12%. ABC Export Private Limited requests your assistance in determining the following: the total IGST and compensation cess payable on imported inputs including the interest. So how much is the assessable value? The assessable value will be 10 crores. On that, basic customs duty 10% and social welfare surcharge will be 10%, but it is exempted because now when you are doing under reassessment, you don't have to pay all those things. What you need to pay is only IGST and compensation cess. So it is a trap. They have given basic customs duty, we don't have to take that, and we need to take only IGST. How much? 18%, and compensation cess 12%. 1 crore 80, 1 crore 20, so literally 3 crores you need to pay. And this 3 crores along with interest, at what rate? Interest at the rate of 15%, not 18%, 15%. From which date? From 1st January. So they are not under deferred payment option. If deferred payment option is given, then the due date will be different. So they are not under deferred payment, means immediate payment. Immediate payment means on the date of import itself, they are required to pay the customs duty. So from the date, that is 1st January 2022 till the date of payment. What is the date of payment? 31st March 2024, because that date they are ready to make the payment, 31st March 2024. So how many days the interest will be payable? So in January, so you count that, so total you will be getting 821 days. So 3 lakhs into 15% into 821, because in this process February 2024 is coming. As February 2024 is coming, in the denominator we need to take 366. So 1,94,262 is what we need to pay. So 3 crores also we need to pay, and 1 crore, literally 4 crores we need to pay. Okay sir, if we pay 4 crores, what is the benefit we will get? How much you will get? 20 crores. IGST paid on export is 20 crores. So that IGST paid we will get. So that is second point. First point you understood, how much we need to pay along with interest, and what are the additional conditions if any to be satisfied. So bill of entry originally filed needs to be reassessed under customs for payment of above IGST and compensation cess along with interest. What is the time limit for application of refund in this case? application to be made within 2 years, it is export. It is export means the date on which the goods leave the country. So goods leave the country for export. Then 4, the total refund of IGST that they can claim on exported goods after making the necessary payments. So that is 20 crores. 20 crores of IGST paid. As export of goods is upon payment of IGST option, refund of IGST paid on export, that is 20 crores, can be claimed in form GST RFD1. Now only they are exporting now. Now only they are exporting. So 2 years is the time limit. So they have ample time limit to make the refund application. Is it clear? 2 years from the date of export, not import. 2 years from the date of export. So that is about this question. So testing this circular, they can coin a question like that. Then next, one more amendment is there. Earlier refund of IGST paid on export of goods and services not available if the exporter claimed benefit under EPCG. However, now they are eligible for the refund. That is previously, so if they are under export promotion capital goods scheme, if they are exporting any capital goods on which IGST is paid, they were not eligible, but now they are getting that refund. Okay. So these are the 2 amendments in refunds chapter. Then in case of supplies to SEZ, what is the procedural compliance to be followed? Simple. Whenever we are making supply to SEZ, just because supply to SEZ is not 0 rated, so supply to SEZ should be for their authorized operations, then only it will be 0 rated. How to prove that it is for their authorized operations? There will be one specified officer or authorized officer of SEZ. Whenever we are making supplies to SEZ, that invoice needs to be endorsed and stamped by that particular officer to prove that the goods are really sold to SEZ for their authorized operations. Based on that particular invoice only, we will be able to claim the refund. So see this, the supplier will have to file refund claim in RFD1 on the common portal. The application for refund shall be filed by the supplier of goods after such goods have been admitted in full in the special economic zone for authorized operations as endorsed by the specified officer of the zone. Therefore, proof of receipt of goods or service is as evidenced by the specified officer of the zone is a prerequisite for filing the refund claim by DTA supplier. Okay. Then next one, supply of goods. So if it is taxable goods, export of taxable goods, what is that we need to do? Shipping bill itself will be taken as the refund application. Along with shipping bill, we need to give export invoice. There are 2 options. What are the 2 options? Pay IGST and get the refund of IGST, or under bond or LUT get the refund of unutilized ITC. But what if the export of goods is exempted? When the goods are exempted, there is no possibility of paying IGST. So only one option is available. What is that option? That is refund of unutilized ITC. And whether the bond needs to be executed or not, no, we don't have to execute the bond. Generally, in case of export without payment of IGST, we need to execute a bond, but in case of exempted goods, the bond or LUT is not required. They have given a relaxation. Then when it comes to services normal. Whenever we are exporting the services, if the services are taxable, both the options are available. But if the services are exempted, option 1 is not possible. We cannot pay IGST. That's the reason why only one option, that is refund of unutilized ITC, even though exempted. And this will be under bond or LUT. Generally for exempted goods only, bond or LUT not required, but for exempted services, bond or LUT is required. Then refund of unutilized ITC. Refund of unutilized ITC. So here also there are few amendments. One major point they have removed. What is that? Minus refund under rule 89 4A 4B, like that one adjustment we used to do, that they have removed now. They omitted it now. They made the formula very simple. Net ITC into 0 rated turnover divided by adjusted total turnover. So maximum refund in case of 0 rated supply, including supply to SEZ, is net ITC into 0 rated turnover by adjusted total turnover. Okay. So that is not R, it was actually like this. So I just made it like divided by, because otherwise that also you will get a doubt. So 0 rated turnover or adjusted total turnover, like that. No, it is 0 rated turnover divided by adjusted total turnover. So what is the meaning of net ITC? Net ITC means ITC with respect to inputs and input services. Only inputs and input services, but not capital goods. So capital goods we will not get benefit here. And that to which ITC should be taken? During the relevant period. Can we take opening balance in this? No. Opening balance should not be taken. Only those inputs and input services which are purchased during the period only should be taken. And that too eligible ITC should be taken, which means ineligible ITC like blocked credits T1, T2, T3. Blocked credits, inward supply for non-business purpose, inward supply for exempt or outward supply should not be taken, that should be taken out. And that to match the ITC should be taken, which means those ITC which is reflected in GSTR-2B. So that is this. Next, zero rated turnover. Zero rated turnover means turnover of goods as well as turnover of services. How to take the turnover of goods? For turnover of goods, we need to take three things. FOB value declared in the shipping bill. First, we need to take the FOB value declared in the shipping bill. Then we need to see whatever is the invoice value. Why will there be different? Definitely there will be different. FOB price means price prevailing in my factory, but the customer outside India will request me to deliver it to his place, means I will only bear the transportation cost. So when I am raising the invoice, I will include the transportation cost also, but it will not be there in FOB price. So FOB price or the invoice price or 1.5 times the value of such goods sold in the domestic market. Okay, similar goods or such goods sold in the domestic market. These three things, whichever is lower, should be taken. Okay, what are the three things? Number one, invoice value, whatever is the invoice value. Number two, FOB value declared in the shipping bill. Number three, the similar goods sold in the domestic market into 1.5 times, whichever is lower. This is the meaning of zero rated supply of goods. Whereas zero rated supply of services will not be directly the invoice. First, we need to see what is the payment that is received during this period, tax period. Whatever is the payment that is received in convertible foreign exchange during the tax period, from that you need to take out advances, because in case of advances, only when you really export the service you can claim the refund. So take out the advances received during the tax period for which supplies are yet to be made in the future, and add advances which was deducted in the last period for which supplies are made in the current period. So like that we need to reconstruct. So value of zero rated supplies made without payment of IGST equals to payment received during the period minus advances with respect to which supplies are not made during the period. We need to add advances with respect to supplies are made during the period but received in the prior period. This adjustment when you make, you will get zero rated supply of services. So zero rated supply of goods we got, zero rated supply of service we got, so numerator we got. What should be taken in denominator? Adjusted total turnover. Adjusted total turnover means non-zero rated, zero rated, everything you take, but exempted supplies don't count for adjusted total turnover. Why? Because here if you observe net ITC, definitely when my outward supply is exempted, I will not take ITC on inward supply. So due to that reason, in the denominator, exempted supply should not be there. All turnover we will take, taxable, taxable, zero rated, taxable, non-zero rated, everything we will take, but exempted supplies will be excluded. So this is about refund of unutilized ITC. And next one, maximum refund in case of inverted tax structure. In case of inverted tax structure, they have given a formula: net ITC into turnover of inverted rate supply of goods or service divided by adjusted to turnover minus net ITC into tax payable on such inverted rate supply of goods or service divided by ITC availed on inputs and input services. So this is simple. First we need to get total 5 datas here. Number one, we need to get net ITC. We need to get net ITC. Net ITC is what? ITC only with respect to inputs. Net ITC, that is only with respect to inputs. We don't have input services and all. So in case of zero rated, we are at least getting so inputs and input services, but here in net ITC only inputs. So we don't have input services, only inputs. Next. So then number 2, we need to take inverted turnover. What is inverted turnover? Inverted turnover means that tax rate on output supply is less than the tax rate on input supply, that is known as inverted turnover. And number 3, adjusted total turnover. This adjusted total turnover is same, already what we have computed for zero rated, that only will be taken, adjusted total turnover. And number 4, that is tax on inverted turnover, tax on inverted turnover. And last data will be ITC on inputs and input services, ITC on inputs and input services. So now what we need to do is that maximum refund equals to, the maximum refund will be equals to 1 into 2 by 3 1 into 2 by 3 minus 1 into 4 by 5. This should be taken. So net ITC into inverted turnover by adjusted turnover means out of this net ITC, how much is pertaining to inverted turnover, okay, minus we have already paid the tax on inverted turnover, but that tax on inverted turnover in proportion to the ITC on inputs and input services, so that we need to separate. So this difference is what we will get as the maximum refund, because for paying this tax we can use both inputs ka credit, inputs and input services ka credit, but we need only that proportion of inputs credit over the credit of inputs and input services. So this is this. So don't break your head in logic, just remember this 5 points: net ITC, inverted turnover, adjusted turnover, tax on inverted turnover, ITC on inputs and input services. So the maximum refund will be 1 into 2 by 3 minus 1 into 4 by 5. So like this, when you do, you will get the refund on account of inverted turnover, that is this. And meaning of adjusted total turnover is same as above. Next, export on payment of duty. So whenever you are exporting goods, upon payment of customs duty, you will not get this option 2, that is refund on account of zero rated is there na, that you will not get. So no refund of unutilized ITC shall be allowed in cases where the goods are exported out of India are subject to export duty. However, refund of unutilized ITC available if such export duty is nil rated or exempted. Why? Because nil rated or exempted means it is actually exempted and we cannot take ITC, but the moment it is exported, for example, I am making this pen is exempted. For making this pen, if I have raw material, I cannot take ITC, but the moment this pen gets exported, it will become zero rated. When it becomes zero rated, I can happily take the ITC and I can claim the refund with respect to this. And this is a November 25 amendment, that is both the options. So far for May 25 exam, whether option 1 is available, export on payment of duty, yes. In case of export on payment of duty, so refund can be claimed under option 1. Refund can be claimed under option 1, but in future no, that is both the options you cannot claim. So that is a November 25 amendment, okay. So refund can be claimed. Export on payment of duty, option 2 not available, but refund can be claimed under option 1. This is what you need to remember for May 25 exam. Then next, applicability of inverted tax structure to merchant exports. So listen carefully. You are a merchant exporter, means you are making purchases from me and you are making exports, okay. Now whenever you are purchasing from me, what I will do is that I will not be charging you the regular GST. Rather than charging you the regular GST, I will be charging you 0.1%. When I am charging you 0.1%, automatically my outward supply rate is 0.1%, but my inward supply will be more rate, means automatically I am coming under inverted tax structure, so I will get the refund. Now whatever 0.1% you paid, that you can take as ITC, and when you export without payment of IGST, you will get the refund with respect to that, okay. So this is that. Merchant exports means exports through third parties, sale of goods to such third party by a supplier. I am making supply to you. At what rate I will pay GST? 0.1%. In that CGST 0.05, SGST 0.05, and such supplier making such supply to such third party can claim refund of unutilized ITC under inverted. Definitely my entire inward supply will be inverted only, because my outward supply is only at 0.1%. So I will claim the refund, and such third party, you are paying me 0.1% now, you can take that as ITC, and you should export the goods within 90 days from the date of purchase invoice, and it should be exported only under bond or LUT without payment of IGST. So then 0.1% also you will get as a refund of ITC. Then deemed exports. Deemed exports, that is sale to advance authorization holder and sale to EPCG holder and sale to EOU. This fourth point is already covered in the first point itself. Supply of gold by bank or PSU against advance authorization. So just remember these three cases. So sale to these people will be coming under deemed exports, and we don't have services in deemed exports, only goods we have. And what will happen in case of deemed export? There are two options. Option 1, supplier shall not recover any GST from the recipient, so that the recipient don't have any tax burden and pay GST by utilizing ITC, and he will get the refund of gross GST. Advantage is ITC converted to electronic cash ledger. Option 2, I will be recovering normal GST from you. Supplier shall recover GST on outward supply and pay GST. Recipient will take the ITC and claim refund of GST paid to supplier. But what is the advantage here? What is the difference between this and the ITC refund which we have calculated just now? Net ITC into 0 rated by adjusted to turnover. This is the difference. Recipient can avail ITC even with respect to blocked ITC, but here blocked credit and all cannot be taken. Here only eligible credit can be taken. Only eligible credit can be taken under net ITC option. Here net ITC into 0 rated by adjusted total turnover, only eligible ITC can be taken, but here blocked ITC also can be taken. That is the advantage of this. Then next, so either supplier will claim refund or second option, recipient will claim the refund. When recipient claims the refund, the supplier should not claim refund, or supplier claiming the refund, the recipient should not claim refund, and accordingly a declaration should be made in this regard. Then refund on account of wrong classification. Wrong classification means we are paying the wrong tax, and upon payment of correct tax we will get the refund of wrong tax. First, there is a wrong classification. Intrastate supply treated as interstate supply and vice versa. Refund of wrong tax paid upon payment of correct tax. And refund application in RFD1, we need to make refund application within 2 years from the date of payment of correct tax. And refund of wrong tax paid not available if the taxpayer has made tax adjustment by issuing credit note. Suppose I have collected CGST, SGST from you and I gave you a credit note cancelling this. Now again I am giving you a debit note for the purpose of IGST. Then in that case, so already I rectified it, so therefore I need not get any refund. Then refund shall be credited to the source ledger. For example, I have made the payment partly from credit ledger, partly from cash ledger. In that proportionate only it will be refunded to the source ledger from where wrong tax has been paid in proportion to the payment made during the tax period. And in this case, unjust enrichment is not applicable. Why unjust enrichment not applicable? There are few cases where unjust enrichment not applicable. In that, this is also one of the case. Refund on account of wrong classification. Then next one you can see refund to UIN holder. So unique identification number holder. Who is a unique identification number holder? Specialized agencies of UN, embassy or consulate which is located in India will be unique identification number holder. Their outward supplies will be exempted, which means they cannot take ITC on their inward supplies. Yes, because their outward supply is exempted, but whatever GST they paid on their inward supply, they can get it as a refund. So there is a supplier who is located in India who is making supply of goods or services to them. They pay the sale price plus GST. This GST will be paid to government, and from government they will get the refund of this GST. Not only this, on import of goods also. Suppose if the supplier is outside India, on import of goods also they will be paying customs duty along with IGST. This IGST also they can get as a refund. What about import of services? In case of import of services, first of all they don't have to pay GST. Why they don't have to pay GST? In case of import of services, it is coming under RCM. Means they are compulsorily required to get registered under section 24 and pay GST under RCM. But as per section 23, when their outward supply is fully under exempted, if they are making only exclusively exempted supplies, they are exempted from registration and they are not liable to get registered. IGST not payable on import of services as section 23 overrides section 24. And refund, how they will claim the refund? On a quarterly basis. Quarterly basis they will claim refund. So generally the 2 years will be there, it will be counted in case of UIN holder from the end of the quarter, okay, and 2 years from the last date of the quarter in which supply was received. And what is the refund application? RFD 10. Along with that, they need to submit the statement of inward supplies in GSTR 11, and they will get acknowledgement in RFD 2. And UIN of recipient should be mentioned in the tax invoice. So whenever their supplier is reporting the details in GSTR1, they need to put it under B2B, and this UIN number should be mentioned so that the tracking can be done. Inward supply should be received against a valid invoice, and refund not allowed. There is one point, refund not allowed if the value with respect to single tax invoice is less than 5,000 excluding tax. Suppose if it is greater than or equals to 5,000 excluding tax, they can take refund with respect to that. Refund order shall be passed in RFD 6 within 60 days from the date of application for refund. Then, in case when the applicant is making application for refund, can he withdraw the refund order? Yes. So sometimes by mistake we will make the application for refund with some wrong particulars, like lower amount. Higher amount when we mention they will reject, but lower amount they will accept and they will process the refund. So for that reason we need to withdraw. Can we withdraw? Yes. before they issue any provisional refund order or final refund order or payment order or any notice, we can withdraw the application for refund. Then whatever refund of unutilized ITC that we discussed, that is net ITC into 0 rated by adjusted to turnover or inverted, all these things, refund of unutilized ITC is list of the following. What is it? List of the following: refund as per the formula, whatever formula we computed, that we need to take first. Number 2, we need to see the balance in electronic credit ledger in the month for which refund claim is filed. So whichever month we filed a refund claim, for that month, okay, so balance in electronic cash ledger in the month for which we filed the refund claim, balance in electronic credit ledger at the time of filing refund application. Hope you understood the difference. For example, March 2023, I am going for refund application in September 2024. So now you need to see the balance in ITC in March 2023, as well as at the time when I am making application for refund, I need to see the balance, that is September 2024 plus the refund under formula, whichever is lower should be taken. Balance in electronic credit ledger in the month for which refund application is filed, balance in electronic credit ledger at the time of filing refund application, whichever is lower should be taken. Okay, then so there is one query. Section 23, sir, is the refund amendment in page 168 applicable for manufacturing warehouse also? So yes, for everyone it will be applicable. 168, everyone, this only, na, everyone it will be applicable, even for manufacturing warehouse also. But first of all, in case of manufacturing warehouse, where from they will be paying any IGST, because imported goods which are kept in warehouse, first of all there is no customs duty on import. Again, when you are exporting from there, there is no problem at all. So therefore there is no import, no export, I mean no customs duty on import, no GST on export also. But by mistake, again I am repeating, by mistake if they pay IGST on export, for them only this circular will be applicable. This circular is applicable only for those people who exported goods upon payment of IGST. If they have exported without payment of IGST, this circular is not at all applicable. Okay, then next. Section 23 overrides section 22 and 24, whereas section 23 subsection 1 is not overriding section. Hence, if I am available for registration, no pa. That is, specifically in section 23, they have given one point. Section 23 subsection 2, like that one section is there. In that only they said notwithstanding. But from quite a long time, this amendment came in recently. But 2017 itself, there is one interpretation which is in force, which says that whenever my outward supplies is exempted, whenever my outward supplies is non-taxable, whenever my outward supply is covered under RCM, whenever I am an agriculturist, these 4 cases, so I am exempted from registration. Even though I am compulsorily required to get registered also, that will not be applicable, because section 24, we should not refer here section 23, we should refer section 24. Section 24 clearly uses the word notwithstanding anything contained in section 22. So which means section 24 is not overriding section 23, means section 23 is an independent section. Whenever there is no specific provision, whenever there is a contradiction like this, that provision which is beneficial to the assessee needs to be relied upon. Accordingly, whenever my outward supply is exempted from registration, I am exempted from registration, so 24 will not be applicable to me. Got it? So this point you follow. This is not because of any amendment. From the beginning, this is the interpretation which everyone is following. Okay, if you have any dispute, don't follow, you write whichever you like. Then simple. So that is with respect to this. And refunds. So refunds, we will see some questions. So just for the purpose of getting a command over this, so mainly that refund of unutilized ITC, etc. So you can take so you can see this question number 23, it's a December 21 question for 4 marks, page 391 of solved workbook. J & Company, a registered supplier under GST engaged in weaving yarn into fabrics, has provided the following information. Nature of various intra-state supplies during April 2021, value of supply excluding GST. Outward supply of fabrics, tax rate CGST, SGST 2.5% each, which means the rate of GST on output will be 5%, and inward supply of rayon yarn, tax rate of CGST, SGST 6% each, means the tax rate on inward supply will be 12%. Inward supply of service of processing the yarn, tax rate of CGST, SGST 2.5% each, and inward supply of machineries for weaving the processed yarn into fabrics, so 18%. Now, is it inverted or not? Of course, it is inverted, because we need to see the inputs and output. What is the rate of GST on input? 12%, 6%, 12%. What is the rate of GST on output? 5%. So, as the tax rate on output is less than the tax rate on input, so definitely they can come under inverted tax structure unless they are notified. Suppose if they are notified for non-eligibility of the refund, then they will not get, otherwise they will get. Moreover, what if it is nil rate? First of all, it is nil rate means they cannot take ITC, so there is no question of refund here. So there should be some rate. The concern has not provided any other supply other than the outward supply referred above. ITC in respect of all types of inward supply as given above was claimed in the relevant GSTR-3B as well as reflected in 2A. Means everything is ITC, eligible ITC only, matched ITC. Other applicable condition for claiming the refund are duly complied with. You are required to compute the maximum refund amount eligible under Rule 89 Sub Rule 5 for inverted tax structure. Also provide workings for your calculation. First we need to see for 5 things. Number 1, what is the net ITC? Net ITC is only with respect to inputs. Don't take input services and capital goods. Only inputs you take, that is 24 lakhs into 12%. Okay. So net ITC 24 lakhs into 12%, that is 2,88,000. Then second, we need to take inverted turnover. What is inverted turnover? 30 lakhs. Next, number 3, adjusted total turnover. Adjusted total turnover is also 30 lakhs, because I have given the entity has no other supplies, no other outward supplies. So adjusted total turnover is 30 lakhs. Then number 5, GST on inverted turnover. What is the inverted turnover? 30 lakhs. 30 lakhs into 5%. 30 lakhs into 5%, 1,50,000. Okay. And then we need to take number 5, ITC on inputs and input services. So what is the ITC on inputs and input services? First, inputs related ITC you see 24 lakhs into 12%, then 4 lakhs into 5%. So 24 lakhs into 12% plus 4 lakhs into 5%, 3,08,000. We got all the 5 numbers. Then we need to take 1 into 2 by 3 minus 1 into 4 by 5. So we will get the formula. Now 1 into 2 by 3, that is 2,88,000 into 30 by 30 minus 1 into 4 by 5, 2,80,000 into, so 1,50,000 divided by 3,08,000. So we will get 1,47,740. Is it clear? And refund not available with respect to ITC on input services and capital goods. They have not given the balance in ITC. So definitely we will get the entire amount, because the question here is about compute the maximum refund amount. Now suppose if they give this question, like for 5 marks, what they will do? They will add the balance in ITC also and they will be testing. You can see one question in the previous page. That's a May 24 exam question. Bhagwan Manufacturers and Exporters Company BMEC is registered under GST in the state of Rajasthan and supplies various goods in domestic as well as international market. It is engaged in both manufacturing and trading of goods. It exports goods without payment of tax under bond or LUT in accordance with the provisions of section 16(3) of IGST Act. BMEC provides the following information in relation to various supplies made by it during October 2023 tax period. Okay. So one second. Okay. So taxable value of goods star supplied within India 14 lakhs. Taxable value of goods son exported without payment of tax under LUT. So first they have supplied some goods within India, that's a domestic turnover, and taxable value of goods son exported without payment of tax under LUT. So refund of ITC they will get. However, taxable value of such goods when supplied domestically by BMEC in similar quantities is rupees 6 lakhs. Okay, and taxable value of goods moon exported without payment of tax under bond. However, the taxable value of such goods when supplied domestically by BMEC in similar quantities is 1,50,000. So they have given both the details. We need to compare with 1.5 times the similar value. The input tax rate available for the above tax period they have given, but we need to take only inputs and input services, because this is what refund of ITC on account of export. So next, all above inputs and input service are used in manufacturing process and all conditions have been complied with. Now which month they are going for refund? October 2023 is the month for which they are going for refund. So see this, the balance in electronic credit ledger at the time of filing refund is 1,50,000. The balance in electronic credit ledger at the end of October 2023 for which we are making refund is 3,25,000. So three refunds, three balances, whichever is lower should be taken. So first we are taking refund of unutilized ITC on account of zero rated. Net ITC. What is the net ITC? 3 lakh plus 1,50,000. How much that comes to? 4,50,000 into zero rated turnover. Say this, both are exported without payment of tax under bond or LUT, and we need to compare 10 lakhs or 6 lakhs into 1.5, whichever is lower, that will be 9 lakhs should be taken. Then again 2 lakhs or 1,50,000 into 1.5, that is whichever is lower will be 2 lakhs. So 9 lakhs plus 2 lakhs, both are exported without payment of tax, that's why we are taking it as zero rated. So 9 plus 2, that is 11 lakhs divided by adjusted total turnover. Adjusted total turnover will be 14 plus 9 plus 2, that will be 25 lakhs. So 11 divided by 25. So how much it comes to? 4,50,000 into 11 by 25. That will be 1,98,000. So 1,98,000 will be taken as the refund, or 1,50,000 or 3,25,000, whichever is lower. Therefore, the refund amount will be 1,50,000. Understood here? Sometimes they may merge these two and also ask. Such a kind of question is also there. So that is in this question. Question number 7, you can see this is a question where everything will be applicable. It's a comprehensive question. Kailash Global Private Limited supplies various goods in domestic and international markets. It is engaged in both manufacturing and trading of goods. The company is registered under GST in the state of Karnataka. The company exports goods without payment of tax under letter of undertaking in accordance with the provisions. So they are going for which option? They are going for option 2. So they are going for the company exports goods without payment of tax under letter of undertaking. They go for option 2. The company has made the following supplies during a tax period. Export of product A to UK, $10,000. Assessable value under customs is somewhere they have given 7 lakhs. Export duty is levied on product A at the time of export. So export upon payment of export duty, they will not get refund under option 2. Option 1 they are not going. They will not get refund under option 2. Option 1 they are not going because their company policy is not to go for refund under option 1. So due to that reason there is no refund. There is no refund in this case. Okay. Then domestic supplies of taxable product B during the period excluding tax at 5%. So inputs used in manufacturing such goods are taxable at 18%. So inward supply 18%, outward supply 5%. It's an inverted tax structure. And is it a notified product not eligible for refund? No, not notified as a product in respect of which refund shall not be allowed. So we will get the refund. So we will get the refund of ITC in this case. Then number 3, supply of goods to EOU. It's a deemed export. Supply of goods to EOU is a deemed export. In case of deemed export, either supplier can claim refund or recipient can claim refund. But if you see here, they have taken the ITC. When they have taken the ITC, which means that we have charged the GST from us. So therefore, who will be claiming refund? The recipient will be claiming refund. So recipient claims refund. Recipient claims refund. When recipient claims refund, for supplier there is no refund. For supplier there is no refund because the recipient is going to claim the refund. Then export of exempted supplies, basically it is exempted, but the moment it is exported it will become zero rated. Value of like goods domestically supplied by similarly placed supplier is rupees 5 lakhs. So now whether we will get refund, of course refund of ITC we will be getting, that is on the 6 lakhs. Now then the ITC available for the above tax period is as follows: on inputs including 50,000 on export of exempted supplies, on capital goods, on input service including 18,000 on outdoor catering 2 lakhs, but they cannot take ITC on outdoor catering because outdoor catering is a blocked credit. Had this question is related to deemed export refund, they can claim ITC on even blocked credit and they will get the refund. And now determine the maximum amount of refund admissible to Kailash Global for the given tax period. So if you see here, first we will take refund on account of zero rated supplies. Refund on account of zero rated, it will be net ITC into in zero rated by inverted tax, like net ITC into zero rated by adjusted total turnover. What is the net ITC? Inputs and input services. So whether this 50,000 also will be taken? Yes. The moment when you are exporting exempted supplies it will become zero rated. So we will get the ITC even on 50,000. So take entire 3,50,000. But on input services don't take 2 lakhs, take 2 lakh minus 18,000. So 2 lakh minus 18,000 should be taken, that is 1 lakh 82,000. So 3 lakh 50 plus 1 lakh 82,000, 5 lakh 32,000 into zero rated turnover, which is zero rated turnover here only one, that is 6 lakhs, because this is not zero rated, it is inverted. 6 lakhs or 5 lakhs into 1.5, whichever is lower. 5 lakhs into 1.5 is 7 lakh 50. 7 lakh 50 or 6 lakhs, whichever is lower will be 6 lakhs divided by adjusted total turnover. So 7 lakhs we will take and 10, so 5 and 6. So total everything is there turnover only, nothing is exempted in this. So therefore 28 lakhs. So 5 lakh 32,000. 5 lakh 32,000 into 6 divided by 28, that comes to 1 lakh 14,000. This will be zero rated. And then we have inverted turnover. So inverted turnover. So inverted turnover will be what? In case of inverted turnover, we need to get 5 numbers. Number 1, net ITC. What is the net ITC? Net ITC will be only inputs, that is 3,50,000 minus 50,000 or 3,50,000. 3,50,000. Don't take minus 50,000, take entire inputs. Number 2, inverted turnover. What is the inverted turnover? 10 lakhs. 10 lakhs will be inverted turnover. And number 3, adjusted total turnover will be 28 lakhs. And number 4, tax on inverted turnover. Inverted turnover 10 lakhs, 10 lakhs into 5%. So 10 lakhs into 5%, that will come to 50,000. And number 5, tax on inputs and input service, already we know 5 lakh 30 ITC on inputs and input service, already we know 5 lakh 32,000. Now we need to do the computation. 1 into 2 by 3, that is 3,50,000 into 2 by 3, that is 10 divided by 28, that is 1,25,000 minus, so 1 into 4 by 5, that is 3,50,000 into 50,000 divided by 5,32,000, that will be 32,895. So the balance minus 1,25,000 will be 92,105. So 92,105 is the refund on account of inverted tax structure. 1,14,000 is the refund on account of zero rated supplies. Okay. So any of these 3 questions can come. One individually inverted, another zero rated, another merging of these 2. Okay. So that is about refunds under GST, and we have say this one last topic, ethics and other provisions. We'll complete it quickly and then take break. So look into this, page number 209, ethics and other provisions, segment 22. So this ethics and other provisions, I don't know to what extent a question may come in this, because these are some miscellaneous areas, but as there is ethics added, so maybe one small question could be given. So what is the role of chartered accountant in ensuring ethics under GST? So there are some code of ethics, the fundamental principles to be followed. So by COP, B for behavior, professional behavior, I for integrity, and C for confidentiality, O for objectivity, and P for professional competence. So they should exhibit the professional competence in doing the work. So these are the fundamental principles to be followed for ensuring ethics in GST. What is the disciplinary action on CA for not following ethics? So there will be penalty under section 122 1A. So that is a person at whose instance the offence is committed and who is a beneficiary of these offences, then will have 100% of the ITC evaded, or 10,000 whichever is higher as the penalty. Then 122 subsection 3, suppose if they are not retaining any benefit, or they are not like at their instance the offence is not committed but they are a party to the offence, then 122 subsection 3 up to 25,000, or the general penalty also may come. And imprisonment under 132, why? Abetting to commit an offence, abetting to commit an offence, under that ground they will be getting imprisonment also. This is under CGST Act, whereas under ICI Act 1949 they will be deemed to be guilty of professional misconduct if they are not exercising due diligence and they are grossly negligent, or if they fail to obtain sufficient information for giving opinion or certification. This is an auditing part. Okay, then what will happen? Either they will be reprimanded, or their name will be removed from the members directory permanently or for a period of time, and a fine will be imposed up to 5 lakhs. This is as per ICA Act. So merging these two, you need to write the answer whenever you get a question on disciplinary action on CA. Then what are the areas where CA has to ensure ethics in GST? In GST, the areas where their work will be divided into 3: advisory, compliance, and litigation. In terms of advisory, so taxation advisory, that is number 1. So SURA, remember SURA. S for structuring the transaction. Structuring the transaction means how the process should be. They will set the process flow so that, you know, from tax point of view it will become easy. For example, I am making sales to you, you are making sales to me, and we will do net off and we will settle, but that is not at all agreeable. So therefore I need to make sales to you, I need to raise invoice. You need to make sales to me, you need to raise invoice, and the ITCs will be getting affected here. So for that reason, so properly they will structure the transaction. Then understanding the client's operations, then registration, that is whether they are required to register or not, they will advise, and assessing the impact on supply chain, then pricing strategies and financial reporting. These are the areas where they will work, and they should ensure ethics in GST. Compliance, remember tracer, T for TDS TCS compliance, returns, A for anti-profiteering, C for certifications, E-way bill, and R for records. Then litigation, they can appear before the GST officer or appellate authority or GST, but a CA cannot appear before the High Court and Supreme Court. Then what are the certifications by chartered accountant in GST? So first certification is ITC 1, availment of ITC on closing stock if the ITC exceeds 2 lakhs. Then ITC 2, to certify whether the transfer of business is with specific provision for transfer of liabilities. Then ITC 3, to certify that the market value, that is generally in case of reversal of ITC, when there is no invoice, we need to replace invoice value with market value. In that case, they need to certify that the market value is considered for reversal of ITC instead of invoice value. Then RFD 1, refunds. So whenever we need to prove unjust enrichment when the ITC claim exceeds 2 lakhs, then we need to get a certification. Then special audit under section 66. One more point also you can add because of that credit note. In case of credit note, okay. So reversal of ITC exceeds 5 lakhs in a financial year. Reversal of ITC exceeds 5 lakhs in a financial year on account of credit notes. So then also they need to certify. Okay, these are the areas where they will be doing certification in GST. So maybe you may get again a theory question. So these 4 parts are there, na? That is role of CA in ensuring ethics. But please remember the heading also, because the point is that to which heading what answer we need to write, you should know. So role of CA in ensuring ethics, disciplinary action, or areas where CA has to ensure ethics, and certifications. Mostly I think certifications is a question which they can ask. Then next look into section 144, presumption as to documents in certain cases. What does it mean? Any document. So this is actually for protection of the department. So suppose if department is telling, sir, we have a evidence against a person, like that they will bring one paper. So now they don't have to prove whether this paper is genuine or not. They don't have to prove whether this paper is correct or not. You should prove that this paper is not correct. You understood? Really, that is what they are telling. Any document which is produced by any person under CGST Act or any other law, produced by any person, seized from the custody or control of the person under CGST Act or any other law, received from any place outside India in the course of any proceeding, okay, that documents tendered by the prosecution in evidence against such person or any other person who is tried jointly with that person. So they don't have to certify that these documents are correct or genuine, etc. It's the presumption that these documents are correct documents. Now you need to argue that these documents are not correct, and it is on the part of you to defend, okay. So they will just submit the documents, you need to argue that these documents are incorrect, okay. That is the presumption here. Next, what are those three documents? Any document which is submitted by any person, and documents which are seized under the custody of any person, or documents which are received from any place outside India. Then section 169, what are the modes of service of notice? So either it will be communicated to his email address, and that is, these are all R, under R. Under R means any one or more methods they can use. Either they can communicate to the email address, or they can put it in the newspaper circulating in the locality of that person, or it can be registered post with acknowledgement due or courier with acknowledgement due, or it can be on the common portal they can upload, or directly they can send it through a messenger, so including courier. If, write down, if any, all or any of the above is not feasible, if all or any of the above is not feasible, then one more point is also there, then they can display the same in their notice board. Yes, if they are not able to give, they can put it in their notice board. It is deemed that the notice has been served. If any or all of the above is not feasible, then they can display the same in their notice board. Then look into the next one, anti-profiteering. What is anti-profiteering? There are multiple situations where we come across anti-profiteering. Situation 1, reduction in rate of GST but the benefit not passed on to the recipient. So which means that, so say you went to a restaurant, before change in rate, the rate of GST on restaurant is 18%. So the food value is 500, 18% 90, total value 590. Now the GST rate has been reduced to 5%. Even then they are charging the same food value of 590, which means the GST has reduced but the food value before GST has increased, which means they are making a value addition, that is without any change in like a process, they are just earning the profit. So profited amount without any value addition will be 62 rupees. This is known as profiteering, that is reduction in rate of GST but benefit not passed on to the consumer, thereby the profit got increased. Another case, increase in ITC but benefit not passed on to the recipient. For example, purchase price 1 lakh, old ITC 15,000, so net purchase price is 85,000, but they are selling for 1,50,000. 1,50,000 minus 85, 65,000 was the previous profit. Now the ITC has increased. When ITC gets increased, the purchase price should come down, then sale price also should come down, but they retain the same sale price. Purchase price 1 lakh, new ITC 25,000, net purchase price 75, but the sale price they retain the same, because of which their profit has increased. This is also known as profiteering. So profiteering comes in two situations. Number 1, reduction in rate of GST but benefit not passed on to recipient, increase in ITC but benefit not passed on to recipient. Then to recover this profited amount from that person, so they have established an anti-profiteering authority. Such authorities used to exist on 30th November. So therefore with effect from 1st December 2022, they have delegated this work to Competition Commission of India to regulate the profiteering. What are the functions of Competition Commission of India? Actually you will be the last attempt if at all you get a question on this, because from November 25 exam onwards this chapter is omitted. So anti-profiteering itself is omitted. There is no anti-profiteering, okay. So maybe if at all they can ask, this is the last statement they can ask, so therefore they may ask one question on this, okay. Functions of Competition Commission of India. What functions they will be doing? First, they will identify the person who has not transferred the benefit. So to determine whether any benefit has been transferred or not, or to identify the registered person who has not passed on the benefit, and to order the reduction in prices, to return to the recipient the benefit not passed on. And suppose if the recipient is not identifiable, they will be crediting it to the consumer welfare fund. And imposition of penalty, how much penalty they can impose? 10% of the profited amount, or they can do cancellation of registration. These are the functions. So this is an important theory question, you can make note of it. And this 10% of the profited amount, so not payable if you pay the profited amount within 30 days of passing the order. Then next, application and process flow. What will happen? There will be standing committee on anti-profiteering and state level screening committee. Suppose if the issue is of local in nature, state level screening committee. If the issue is of national in nature, standing committee on anti-profiteering. So the complainant will make an application. So first they will give it to SLSC, that is state level screening committee. If the issue is of local in nature, they will forward the application to standing committee on anti-profiteering. How many months it will take? 2 months plus 1 month, because I need to walk and go na. So 3 months it will take, and thereafter the standing committee on anti-profiteering will take 3 months to examine whether the evidence is proper or not, and if the evidence is proper they will accept, otherwise they will reject. So whether the application gets rejected or not itself, it will take 1 attempt for us. Okay, that means 6 months. Okay, so 3 months plus 3 months, and thereafter if they reject the application, okay. So if they are accepting the application, it will be forwarded to Directorate General of Anti-Profiteering, and they will take 9 months, 6 months plus 3 months for what? No, not for giving order. So to forward it to the report, investigation report to Competition Commission of India. That Competition Commission of India will take 6 months from the date of report of DGAP to pass the order, and in this process they may ask for even fresh investigation. That's the reason why they have shut down this, okay, completely. So they thought it is of no use to anyone. And then next one, disclosure of information by public servant, section 158. As per section 158, there are certain informations which are classified as confidential information. Those information should not be shared by any person. Number one, any statement made by the taxpayer, or any return furnished by the taxpayer, or audit report, audit of tax receipts and refunds, and record of evidence. Record of evidence means, so whenever a statement is given, so that statement recordings will be there, that, and record of any proceedings, that is assessment proceedings or adjudication proceedings, etc. So all this data which is with the tax officer is confidential, that should not be shared with any person. However, in certain cases that information can be shared for the purpose of execution of their duties. So above confidential information can be disclosed in the following cases. For what purpose? For prosecution. For prosecution means what? For the purpose of levying any imprisonment against that person, or for carrying out the objects of the act. What is the object of the act? Recovery. So object of the act is recovery, for doing any recovery. Then for giving any notice or passing the demand order, or for court proceedings, or to check whether the tax is properly collected or not. If the superior is asking, the subordinate cannot say, no sir, confidential information I will not share. So he need to share that to his superior. So that is for inquiry of conduct of officer, for audit of tax receipts, or for lawful exercise of power. Then for conduct of inquiry of an officer means when officer has really passed the proper order or not, he need to submit the data for that. And for data entry, these details will be given to the people who are working in GST network for uploading the details in the portal. And in public interest, this can be publicized in the newspaper also. Okay, so this is the reasons why this confidential information can be disclosed. Again, this can be tested as a theory question. And next, consent based sharing of information, section 158A. So 158A says that whenever we give the consent to share our information to the portal will share the information to financial information users like banks or financial institutions or mutual fund companies, etc. whenever you apply for a credit card also, so they will be asking your GSTIN. When you open a loan account also, they will be asking your GSTIN. So what they will do, they will grab the returns data from our portal. For that we will be giving consent to the portal, that is this. But the consent every time we will not be giving. So one consent we will be giving to these two people. Account aggregators are public tech platform for frictionless credit. These are basically RBI subsidiary company. To them we will give the approval. So they will take the data from our portal, that is income tax portal, GST portal, or from insurance, mutual fund, banks, etc. These are financial information providers. From there the data will be grabbed and shared to financial information users, that is wealth management, robo-advisors, personal finance management, or NBFCs, banks, etc. That is about this consent based sharing of information. Then following details of supplier or recipient may be shared by the common portal. So under this consent based sharing of information, what data can be given by the common portal? Registration particulars, return details, documents uploaded during inspection. No action shall lie against government for sharing this information. Suppose if this information has been shared and it has been misused by any other person, so now you cannot blame government or you cannot take any action against the government. Okay, who asked you to give the consent? You understood? You gave the consent, so the data will be given, and thereafter you cannot blame them. So then don't give the consent. If you are not giving consent, you cannot take loan. You understood? Comparison of different provisions as to rectification of mistakes. So there are three places where we come across rectification of mistake apparent on the face of the record. Section 161, rectification of mistakes apparent on the face of the record, it's a general provision. Section 102, any advance ruling that is pronounced can be rectified. Section 113, rectification of appellate order. So these are the three places where we have rectification. First look into section 161, nature of provision, general provision. Who is the authority making the rectification? Any GST authority, including appellate authority, adjudication authority, or revision authority. Any authority can make the rectification. Subject matter of rectification, what can be rectified? The notice issued can be rectified, or the order passed can be rectified, or the certificate issued can be rectified. Okay, and finding of mistakes, how they will find the mistakes? You just make the correction there, small alignment error. Point number 1 is suo moto. Point number 1, suo moto. Suo moto means voluntarily they can identify. Number 2, brought to notice by other officer, or number 3, brought to notice by taxpayer. Now time limit for bringing it to the notice of the authority or GST 80. So first and second case, suo moto or brought to notice by other officer, no time limit, anytime, but brought to notice by taxpayer, 3 months from the date of communication, the taxpayer should tell. For example, the interest rate is given as 24% per annum in the order. Is the interest rate 24% per annum? Do we have such an interest rate? No. By mistake they have given 24% per annum. But can we make a request for them to rectify this order for 18% per annum? Yes. Within 3 months from the date of order, you don't need to go for appeal on this and all. No need to go for appeal on this. You just make a request to them that, sir, you made 18%, so they can rectify. For that, no need to go for appeal. That is the objective of this section. Okay, and 3 months from the date of communication. Time limit for rectification. So you brought it to their notice within 3 months. How much time they will take to rectify? So if it is arithmetical or clerical errors, no time limit. Any other cases, 6 months from the date of communication. Okay, so whatever this error is not arithmetical or clerical error, so this rate they have taken as 24%, considering 24%, but when we ask them, so they can rectify whenever we notice them, like we will communicate to them from the date within 6 months from the date of communication. Suppose if they have written it as 8,20,000, okay, 8,20,000 in English they have written 8,20,000 rupees, like that. But in the amount, if you see 80,20,000 is there. You understood or not? 8 lakhs have become 80,20,000. It's a arithmetical error or a normal clerical error. In that case, what they can do? They can definitely rectify without any time limit. So arithmetical or clerical errors, no time limit. Then opportunity of being heard. Definitely opportunity of being heard is yes, if that rectification has any adverse effect. Okay. Then look into next one, section 102, rectification of advance ruling. So now who will do this rectification? Advance ruling authority, either authority for advance ruling or appellate authority for advance ruling. So which one they will rectify? The advance ruling pronounced will be rectified. So how? Same, brought to their notice, that is suo moto, or brought to notice by authority for advance ruling or brought to notice by applicant. Suo motu no time limit, but in the other two cases 6 months. Slight difference between this and this. Can you see that? Here first and second no time limit, here first case no time limit, second and third case 6 months, here it is 3 months. And once you bring it to their notice within 6 months, thereafter they need to rectify any time limit? No. But opportunity of being heard should be given. Then last, rectification of appellate order. Who will rectify this? GST appellate authority, appellate tribunal will pass an order. That order can be rectified. How? Same. Suo motu, brought to notice by commissioner or brought to notice by appellant. First case no time limit, second and third case it is 3 months from the date of communication. Slight differences are there, that's why I gave you this table. Maybe suppose if a question is asked on this, why we need to miss this, that's why. And time limit, no time limit for rectification, and opportunity of being heard will be yes if such rectification has the adverse effect. Understood? So we completed all the miscellaneous provisions. We'll take a break, and post break I will be starting with a very important chapter, that is input tax credit. Okay, so kindly take a break and come back with good energy. We will complete input tax credit also. 15 minutes. After 15 minutes we'll meet. Okay, we'll start. So relating to that question, sorry I opened the wrong file. Relating to that question, I have opened the correct file now only. They gave clearly, ICA has given the view that so no interest is payable in the given case, like that they have given. Okay, so which means we need to make the correction in the solve workbook. So initially they have not given anything, but they have corrected that. So in this question number 3, page 328, so interest shall not arise here. Interest shall not arise. Interest shall not arise. Interest shall not arise as there is sufficient balance. As there is sufficient balance in electronic cash ledger, which means they are taking the assumption that in any head if the balance is there, that is okay, not necessary in that head only the balance should be. Any head the balance can be there. Then next we are moving on to the next chapter for discussion, that is segment 9, input tax credit. In input tax credit also very good number of amendments are there, and there are possibility of asking questions on this also. In this total we have section 41, 49, then 16 to section 21. So these are all the various sections that we have. First we need to talk about availment of ITC, and then utilization of ITC, condition for availment of ITC, apportionment of credit, blocked credit, then availment of ITC and reversal of ITC in special cases, job work provisions and input service distributor. These are the areas. First look into availment of ITC in GSTR-3B. So first, what is input tax credit? GST paid on inward supplies is known as input tax credit, that can be availed as ITC in GSTR-3B and utilized for payment of liability on our outward supplies. So how we will avail ITC in GSTR-3B? So rule 36 sub rule 4, section 41 read with rule 36 sub rule 4 says we can avail the ITC only matched ITC. What is matched ITC? That ITC which is reflected in the GSTR-2B. So that is called as matched ITC. How it will be reflected in 2B? Based on the GSTR1 of the supplier. So in this regard we need to know few returns. GSTR1, that is containing the details of output supply filed by every registered person. GSTR2A, so based on the GSTR1 of the supplier, so in 2A the inward supply details will be made available based on GSTR1 or IFF, invoice furnishing facility. A person who is under QRMP is required to file quarterly return, but if they file GSTR1 quarterly, their recipients also will take ITC on a quarterly basis. For that purpose they can file monthly IFF, invoice furnishing facility, so that the recipient can avail the ITC based on that. So therefore 2A will get the details of inward supplies based on the outward supplies of the supplier in GSTR1 and IFF furnished by every supplier. Recipient can generate a statement of inward supply in 2A, and this 2A is auto populated from GSTR1 filed by the suppliers. And GSTR-2B is a static document that is also containing the inward supply details. Both 2A and 2B contain the same details, but 2A will get updated very frequently, which means it is like a dynamic document, but 2B is a static document. If the GSTR1 is filed by the cutoff date, so then only the details will be reflected in 2B. So GSTR2A is just for reference purpose, but 2B is for the purpose of availment of ITC. So 2B is a static month-wise auto-drafted statement for regular taxpayers. It is like 2A, but it remains static. GSTR3B is actually the return in which we will be reporting our details of tax and ITC, and we will be paying the tax also at the time of filing this return. At the time when we file GSTR1, the tax payment shall not arise, but at the time of filing 3B, the tax payment shall arise. What is the difference between 2A and 2B? So type of document 2A is dynamic and 2B is static. TDS, TCS details will be reflected only in 2A but not reflected in 2B. Details of invoices if GSTR1 filed after due date. If GSTR1 filed after due date also 2A gets updated automatically, but 2B will not get. It will be reflected in next month 2B. However, it is reflected in subsequent 2B. And what is the purpose of 2A? It is just for reference, and 2B is for the purpose of availment of ITC. As per rule 36 sub rule 4, only that ITC which is reflected in 2B can be taken. So supplier will file the outward supplies in GSTR1. Based on the GSTR1 of the supplier, if it is filed by the due date, the data is reflected in 2B of the recipient, and this data or ITC is known as matched ITC. This should be taken as the base. So avail ITC in 3B. So ITC in 3B will be self-assessed ITC. How that self-assessed ITC will come? First we will take ITC as per GSTR-2B, and there are three things which should be eliminated, even though it is reflected in 2B, but it should be eliminated. So what are they? Blocked ITC. There are some ineligible ITCs that then used for non-business purpose or used for exempted supplies, because the portal don't know whether it is a blocked ITC or it is used for non-business purpose or it is used for exempted supply. For that reason they will be giving it to you in 2B, but you should not be taking it, even though it is reflected in 2B, but it is ineligible, we should not take. Whereas there are three ITCs which will not be reflected in 2B, right? They are not reflected in 2B but eligible, not reflected in 2B but eligible. What are those three things not reflected in 2B but eligible? That is GST paid under RCM. Whatever GST we have paid under RCM, then re-availment of ITC reversed earlier, ITC not availed in earlier periods but reflected in 2B of that period. Okay, so which is like, whenever I pay GST under RCM, my supplier will not report in GSTR1. As my supplier not reporting in GSTR1, it will not come in my 2B, even though it is not coming in my 2B, but GST paid under RCM can be availed as ITC. But definitely we will get an error message in the portal that we are taking the ITC in excess. At that time we will get a notice in terms of rule 88D, but we need to reply to the notice accordingly that this is the GST paid under RCM which we can take as ITC. Then next, re-availment of ITC reversed earlier. That is, first we have availed the ITC, and because of certain contraventions we are reversing the ITC. Again, upon fulfillment we can re-avail the ITC, but when we re-avail the ITC, so this will not be coming in this month 2B, it's okay, but even we can take. There are two cases where we will reverse and re-avail. Situation number 1, if the recipient is not making payment to supplier within 180 days from the date of invoice, so much of the ITC availed by recipient needs to be reversed, and again as and when recipient makes payment to supplier, the recipient can re-avail the ITC, and this re-availment need not be there in 2B, but they can take this, and this is given in rule 37. Then rule 37A is there, that is, whenever the supplier has not filed GSTR-3B by September 30th of the next financial year, then whatever ITC already availed by recipient needs to be reversed, and again as and when supplier files GSTR-3B at a later point of time, the recipient can re-avail the ITC. Again it will not be in 2B, but it can be taken as ITC. Then next one is about the ITC pertaining to a particular month, not availed in that month, but we are availing now. Because we have not availed at the time, maybe we are of the opinion that we are not eligible for ITC, but now we are availing the ITC, or there may be other reasons like we can avail ITC only when the goods and services are actually received based on invoice, we may not avail the ITC, but it came in 2B of the earlier month, not availed in that month, and now if we are availing, can we take that? Yes, we can definitely take that, but it may not come in this month 2B. So these are the three things, even though it is not reflected in this month 2B, we can avail the ITC. This is known as self-assessed ITC. And next one we have rule 37A. This is what I was referring to. Section 41 read with rule 37A. So far what we have seen is section 41 availment of ITC read with rule 36 sub rule 4. Therefore, how much ITC we can avail in GSTR-3B? Availment of ITC means taking credit in GSTR-3B. For that we have taken ITC as per 2B, and we will make the adjustments, and that is called as ITC availed in GSTR-3B. Got it? Now we are discussing as to what will happen if the supplier has not filed 3B. If the supplier has not filed 3B, so that is given in section 41 read with rule 37A. So look into this chart. Supplier reports the invoice in GSTR1, and that invoice is filed, that return is filed within the time limit. As soon as the supplier files GSTR1, automatically it will come into the recipient's ITC. It will be reflected in 2B of the recipient, and whenever it reflected in the 2B of the recipient, what recipient will do? He will avail the ITC in his GSTR-3B. Thereafter, supplier is not filing 3B by September 30th of the succeeding financial year. He filed 1, but he did not file 3B. As he did not file 3B, by September 30th of next financial year. So therefore the recipient should reverse the ITC. How will recipient know that the supplier has not filed GSTR-3B by September 30th? So that data will be made available to the recipient in his GSTR-2B. In his GSTR-2B, whose GSTR-2B? Recipient GSTR-2B, there will be 3 columns: ITC available, ITC not available, ITC reversal, like that. In that ITC reversal, when they see, they will identify as to who are all the suppliers who has not filed the GSTR-3B by September 30th. That data will be available, which means the recipient should open this GSTR-2B when? So after September 30th for the previous year. For example, previous year 24-25. For previous year 24-25, after September 30, 2025, when they open the 2B, they will be able to see ITC reversal. In that ITC reversal, who are all those suppliers who did not file 3B by September 30th, that data will be reflected here. That amount he need to reverse. By when he need to reverse? He need to reverse it by November 30th. Means he has only 2 months time. And if he is reversing it by November 30th, no issue. If he is not reversing by November 30th, then he need to pay interest. Interest at the rate of 18% per annum. From which date to which date? From the date of utilization of ITC till the date of reversal. You can see here. So, if the supplier not filed 3B by September 30th of next financial year, the recipient should reverse the ITC after September 30th of next financial year, but before November 30th of next financial year. And what if the 3B is filed after September 30th? Then again he can re-avail the ITC. ITC reversed earlier can be re-availed without any time limit. Remember, generally there is a time limit for availment of ITC, that is 30th November of succeeding financial year or date of filing and written, whichever is earlier. But in case of re-availment of ITC reversed earlier, so we don't have any time limit. Even beyond that also we can re-avail this ITC. And here, suppose if the recipient is not reversing the ITC by November 30th, what will happen? They need to pay interest. So interest at 18% shall be payable from the date of utilization till the actual date of reversal or payment. Then what is the manner of utilization of credit? So far what we saw is availment of ITC. Now we are looking into utilization of ITC. First we have taken the ITC, but there are some restrictions with respect to utilization. So principle number 1 says that IGST credit, there is no restriction. Means IGST credit can be utilized for payment of any GST liability. Same way any GST credit can be utilized for payment of IGST liability. But with respect to other 3, that is CGST, SGST and UTGST, there is a restriction of cross utilization, which means CGST credit only for CGST, if not IGST. So then SGST for SGST, UTGST for UTGST. But compensation cess has got one special point, that it cannot be adjusted with IGST also. Compensation cess can be utilized only for payment of compensation cess. That is with respect to this principle number 1. And principle number 2 with respect to the priority, that is I have IGST credit. IGST credit for what purpose I should use? I can use it for any purpose, but first it should be utilized for payment of IGST liability, and thereafter between CGST, SGST, UTGST in any manner, any proportion depending upon its liability you divide. For example, here you can see, say I have some gross liability, so of CGST, SGST, IGST, I have a gross liability of say 5,000, 5,000 and 5,000, and I have an ITC of 2,000, 2,000 and 10,000. So now I have excess credit of IGST. Now which credit I need to exhaust first? Always remember, there is one principle number 3 which says that before utilizing CGST and SGST credit, the credit of IGST should be completely exhausted. So therefore this IGST credit I need to exhaust completely. So therefore what will I do? First I will be taking my gross liability. So the gross liability will be 5,000. Okay, gross liability will be 5,000. So CGST, SGST, IGST. So my gross liability I will take, so gross GST payable, what is that gross GST payable? 5,000, 5,000, 5,000. Which credit I need to utilize first? Minus IGST credit. What is that IGST credit that I have? 10,000. But first I should use it for payment of 5,000, because the principle number 2 talks about the priority. IGST credit first for IGST payable. So 5,000 I have utilized. Still I have 5,000. that 5,000 don't utilize for CGST fully or SGST fully, because you observe what is their liability. So this small computation you need to make. What is their liability? 5 minus 2, 5 minus 2, that is 3,000, 3,000. Equal liability na, so you equally split. You equally split. So that is like 2,500 and 2,500. And thereafter you will be utilizing CGST and SGST credit. CGST and SGST credit we have utilized, that will be 2,000 and 2,000, so that we will get net GST payable. So net GST payable will be 500, 500, 0. So the total will be like 1,000. So now whenever you do this computation in exam, kindly put the total column also, because what happens, there will be multiple answers possible. When multiple answers are possible, they may not award the marks if it is not matching with the key, because not all educated people are evaluating. Okay, uneducated, illiterate buffoons are evaluating. They will not read properly. Okay, they see whatever is there in the key, for the sake of some 200 rupees and all, they will pledge our career. Got it? So for that reason, so please put one more total column, and in this total column, so that if you are writing that 1,000 rupees, maybe they will see, so somewhere it is similar to the key, they have written something like that, at least they will consider. Okay, so one total column don't forget to add in exam, because there are multiple answers which is possible. We don't know the person who is giving the key will take what assumption, we don't know, because the problem with this exam is that the one who is setting the question paper is not setting the key, and the one who is setting the key is not doing the correction. So therefore they will create question paper in one way, these people will give the answer key in another way, and thereafter evaluator will get the key and he will do the evaluation. So God only knows. In the top of this, there is a discussion that why can't we use artificial intelligence for evaluating. Ayyo, super. And we don't know what will happen. Okay, so better clear before that all these things comes. So therefore, that is this. So we can utilize it. And how to know whether our answer is correct or not? 5,000, 5,000, 5,000, total is 15,000. 2,000, 2,000, 10,000, 14,000. So 15 minus 14,000, 1,000. So 1,000 should be our net liability. If you are able to achieve that, then your answer is correct. That is with respect to this. And so therefore IGST credit should be first utilized for payment of IGST, then for CGST, SGST, UTGST. CGST credit first for CGST, SGST first for SGST, UTGST first for UTGST. If you have any balance, that will be utilized for payment of IGST. Principle number 3, we should exhaust IGST completely before utilizing CGST, SGST credit. Last principle is I have all the credits but only one liability, that is IGST liability. Which credit I need to use first? I need to use IGST credit, and thereafter CGST credit, and thereafter SGST or UTGST credit. So IGST credit after utilizing for payment of IGST liability can be used for payment of CGST, SGST in any manner, any proportion. So multiple answers are possible. My view is that depending upon the CGST, SGST liability, it should be apportioned. And GST compensations can be utilized for payment of GST compensations only. So therefore, whenever in your outward supply you have GST compensations, then only you can take credit of GST compensations on inward supply. So in exam they will give some inward supplies with GST compensations. Now you need to analyze the outward supplies, whether in anywhere in the outward supplies there is GST compensations, then only you take the credit of GST compensations on inward supply. Is it clear? And for example, I am a dealer of car. When I am a dealer of car, when I am selling the car, I will be charging GST compensations. When I am purchasing the car from manufacturer, he will also charge me GST compensations. Can I take that as credit? Of course, I can take as credit, because in my outward supply also GST compensations is there. Whereas I am into the business of renting of motor vehicles. When I am into renting of motor vehicles, on renting there is no compensations. So therefore, whenever I am purchasing car, on the GST compensations is there. Even though for a person who is into business of renting a motor vehicle, they can take ITC on motor vehicle, but GST compensations cannot be taken. Reason being, in their outward supply there is no GST compensations as liability. Then Next one, section 16. Section 16 talks about conditions for availment of ITC. In that, there are total 8 conditions. Condition number 1, only a registered person can avail ITC. Of course, unregistered person cannot avail ITC. Condition number 2, the inward supply should be used or intended to be used in the course or furtherance of business. Used means used for existing business. Intended means something which we are going to use in future, but we purchase it now, we can take ITC. It is not like, depreciation section 32, put to use only we can claim depreciation, not like that. Here, even though you have not used, we can take the ITC, full ITC we can take. So used or intended to be used in the course or furtherance of business. Furtherance means some business which we are going to start in future. Then number 3, that is, recipient should be in possession of tax paid document. What is a tax paid document? Either tax invoice or debit note or ISD invoice, input service distributor invoice, which will be given by the head office, which takes ISD registration and distribute the credit to the branch offices. So that ISD invoice, then bill of entry. At the time of import, we will file bill of entry and we will pay customs duty along with IGST. That to take that IGST as credit, we need to be in possession of bill of entry. So that is this condition number 3. Recipient should be in possession of tax paid document. First 2 are the basic condition. Only a registered person can avail ITC. Inward supply should be used or intended to be used in the course or furtherance of business. Next 3 conditions to be fulfilled by the recipient. So what are those 3 conditions? Number 1, he should be in possession of tax paid document and he should have actually received the goods or services. So if the invoice is pertaining to January but the goods are received in March, he can take ITC only in March, he cannot take ITC in January. Same way, services, even though there is GST on advances, but can they take ITC with respect to services? No, only when the services are actually received, they will be able to take ITC. Then another condition is that to take the ITC, they need to file GSTR-3B. There is no other way in which they can take ITC. Only by filing 3B, they will be able to take ITC. So these are the 3 conditions, point number 3 and point number 4 and then point number 7. So recipient should have actually received the goods or services. Recipient should have filed the returns, that is GSTR-3B. Next 3 conditions is not in the capacity of the recipient, but it is to be fulfilled by the supplier. What the supplier should do, he should be reporting those details in GSTR1 and that GSTR1 should be filed by the due date. So what will happen if the supplier is not at all filing GSTR1? It will not come in 2B. If it is not coming in 2B, cannot be taken. Number 2, if supplier files GSTR1 but he missed the invoice, will it come in 2B? No, it will not come in 2B. So ITC cannot be taken. He reported the details in GSTR1 but he reported wrong details in GSTR1. Then also that amount will not come in 2B. Consequently, it cannot be taken as ITC. That is the reason why there will be a mismatch between whatever ITC that is there in records versus whatever ITC that is reflected in GSTR-2B. That is this point. So supplier should have furnished the details in GSTR1 and those details which are reported by supplier in GSTR1 should not be restricted in GSTR-2B, means it should not come under ITC not available. Why the hell it will come under ITC not available? Because of section 38. This section 38 is a contravention which is done by the supplier, because of which in GSTR-2B, as I told you, in GSTR-2B there are 3 columns. ITC available, ITC not available and ITC reversal. So it should come in ITC available column, then only we will be able to take ITC. If it is in ITC not available, means supplier filed GSTR1 but he made some contraventions, because of which it is coming in ITC not available. So we will not be able to take ITC. What are those contraventions? That is given in section 38. As per section 38, in few cases ITC shall be restricted in 2B. What are those few cases? You can see in section 38, which is in returns chapter. So just turn some pages, you will be able to find this information in returns, that is page number 150. Page number 150. So you give the page number reference here if you want. In the following cases, even though supplier declare the details of outward supplies in GSTR1, ITC can be restricted in GSTR-2B as per section 38. What are those cases? Supplier is a newly registered person. So supplier is newly registered person. So whenever you are buying from that newly registered person, even though he has filed GSTR1, but it will be coming in your 2B under ITC not available. And thereafter, whenever he regularizes his return, it will be going to ITC available. So this is actually a temporary exercise. Means right now it is under ITC not available, but at a later point of time it will be moved to ITC available. So supplier is a newly registered person. So therefore it comes in your ITC not available. Number 2, supplier has filed GSTR1 but not not filed GSTR-3B for some earlier periods, because in past and all, so without filing GSTR-3B of the previous month, we can file the GSTR-1 of this month, but that provision that without filing 3B of the earlier month you cannot file GSTR-1 of this month came now only. So but in the past it was not. So in the past what they have done, they have filed lot of GSTR-1s, but they have not filed GSTR-3B. Now they are filing GSTR-1. Even though they file GSTR-1, we will not be able to take ITC. It will come under ITC not available, because they have not filed 3B for the earlier months. Okay, then next one, supplier liability in GSTR-1 is greater than liability in 3B, means, one second. Okay, listen. So what has happened is that supplier has filed GSTR-1 and he also filed GSTR-3B. If the supplier has filed GSTR-1 and if he has not filed 3B, which is already covered there in the second point, but if he filed both, GSTR-1 also he filed, GSTR-3B also he filed, but what happened is that the liability in GSTR-1 is greater than the liability in GSTR-3B. So even though he filed GSTR-1, but we will not be able to take ITC because it will be coming under ITC not available. And fourth point, supplier has availed ITC in his 3B, which is more than the ITC as per his 2B, means he has taken more ITC in 3B. Then when you are buying from such a person, so even though he filed GSTR-1, but you will not be able to take ITC because it comes in our ITC not available. Then supplier has defaulted in payment of taxes, means there is some demand and recovery, and there is some notices or order which is passed against that supplier, and even though he filed GSTR-1 for this month, but we will not be able to take ITC because there is demand notices and he defaulted in payment of tax and the default continues. And there is one provision called as Rule 86B, which says that every person whose taxable turnover exceeds 50 lakhs in a particular month should pay 1% of their liability through electronic cash ledger. If that supplier has not fulfilled that point of payment of 1% of liability through cash ledger, now from such supplier you have made a purchase, you will not be able to take ITC. So these are the 6 situations where even though your supplier has reported details in GSTR-1, but you will not be able to take ITC. So what are those first points? Like first 6 cases. So supplier is a newly registered person, supplier GSTR-1 filed but 3B not filed, supplier liability in 1 greater than 3B, supplier ITC in 3B greater than 2B, supplier default in payment of tax and the default continues, and supplier has not paid 1% of liability through cash ledger. These 6 cases, it will come under ITC not available. Can we take ITC? No, we cannot take ITC. What is the recourse mechanism? So initially itself, you should have got the KYS, know your supplier. You understood how they will be getting know your customer. You should be getting know your supplier. So you should have asked the supplier, are you fresh? Yes sir. Then I will not buy from you, means newly registered persons. And like that you should have asked them, and then only you should have purchased from them. So therefore you purchase. What is the recourse mechanism? Now after it is coming in ITC not available in 2B, so you will call that supplier and you will ask, boss, what is it? It is coming in 2B, are not available, so do something. So for which supplier will rectify these mistakes, any of these mistakes, but which mistake we also don't know, he also don't know, got it? But he need to rectify that mistake. Based on that, it will be going into ITC available and we will be able to take ITC. You got it? So it is like our hair in their hands. What if hair is not there, sir, like you? No problem. So that is this. And coming back to this, so whenever the supplier files GSTR-1 and he reports it in GSTR-1, but the problem is that it will be restricted in 2B. GST paid on inward supply should not be reflected in 2B under ITC available and should not be restricted. So then third condition in the hands of supplier is that he should have paid the tax. But when he should have paid the tax? By September 30th of the succeeding financial year. Only then we can take ITC. No, first itself we can take ITC, but if he is not paying tax by September 30th of next financial year, we need to reverse the ITC. Supplier should have paid tax with respect to such supply within September 30th of next financial year. Then these are the 8 conditions to be satisfied. In these all 8 conditions, except 6th condition, all other 7 conditions should be fulfilled at the time of availing ITC, but this 6th condition alone should be fulfilled later point of time. Okay, so this condition not to be checked at the time of availing ITC, not to be checked at the time of availing ITC. So not to be checked at the time of availing ITC, got it? So therefore that is only the special point here, but in all other 7 cases the condition needs to be checked at the time of availing ITC. Then input tax means what? So tax paid under FCM or tax paid under RCM. Even whatever GST we paid under RCM, can we avail it as ITC? Of course yes. In the same month, can we avail as ITC? Yes. So default in the same month we can take as ITC. If the question has any other information, then we need to go by that information. Otherwise, this month we are paying GST under RCM means this month itself we can take ITC, because now they have brought in one very important amendment. In case of RCM, you can take ITC only as and when you give invoice to your supplier. So previously and all, this provision was not there. Previously, as and when we pay GST under RCM, in that month itself we can avail the ITC. But now they have brought in invoice. Invoice means what? Whenever you gave invoice to your supplier, in case of RCM, supplier is unregistered, recipient is registered, the recipient should give self-invoice to the supplier within 30 days from the date of receipt of goods or services. So whenever the recipient gives invoice, then only recipient can take ITC. So this point may be tested. That's what I told you. Check for the question. If the question is silent, you take the month in which the tax is paid. In that month itself, you can avail the ITC under RCM. So input tax means CGST, SGST or UTGST charged on supply of goods or service or both made to a registered person. It also includes tax paid under reverse charge basis and IGST charged on import of goods. Even IGST paid on import of goods also can be taken as credit, but it does not include tax paid under composition scheme. First of all, a person who is opting for composition scheme should not charge GST. Even if they are charging GST to us, we should not be taking ITC. That is this point. Then we should be in possession of tax paid document. What is a tax paid document? Tax invoice. Whether all the tax invoice details should be there in that tax invoice, then only we can take ITC. No. So any document which has some minimum details, then it will be considered as a tax invoice for availment of ITC. What are those minimum details? GSTIN of supplier, GSTIN of recipient should be there. Then in like value should be there, tax should be there, and description also should be there. Finally, place of supply should be there. So to know whether it is intrastate supply or interstate supply, date is mandatory. Apart from date, these are the minimum details that should be present. Description of goods or services, value, tax, GST of supplier and recipient, and place of supply in case of interstate supply. Then it will be called as a valid document for availing the ITC. HSN details not there, it's okay, we can take ITC. SAC details not there, it's okay, we can take ITC. Now, what if the supplier has not given e-invoice? Instead of giving an e-invoice, he gave a normal invoice. Can we take ITC? No, we cannot take ITC with respect to that. That point I connected in e-invoice. Even though the supplier has given invoice, he reported the details in GSTR1, but we cannot take ITC because he has not given e-invoice. He gave a normal invoice. Got it? Next, what are the inward supplies means? Inward supplies means capital goods, inputs and input services. Capital goods means any goods which are purchased and capitalized in the books of the person is known as capital goods. Inputs means other than capital goods, that is which are charged to P&L will come under inputs. Input services means any services received will be coming under input services, but all these should be used or intended to be used in the course or furtherance of business. Okay, then deemed delivery. So this is like generally when the goods are received or the service are received, then only ITC can be availed. But in case of bill to ship to transaction, what will happen? I am delivering the goods to my billing address or shipping address. Shipping address means a third person, but I am raising invoice to my billing address. So billing address cannot take ITC because they have invoice but they have not received the goods. Same way shipping address cannot take ITC because I have received the goods but the invoice is not in their name. So which means literally both cannot take ITC. For that reason they have created this deeming fiction, which means that the the date on which the shipping address has received the goods or services, it is deemed that the billing address also has received the goods or services. Consequently, the billing address can take ITC. So in bill to ship to transactions, who will take ITC? Billing address will take ITC. Even though they have not received the goods, it is deemed that they have received the goods on the date on which shipping address has received. And service also it will be applicable. For example, I am raising invoice to your chartered accountant, but I have provided lectures to you. In that case, can your chartered accountant can take ITC? Yes, because the date on which you received the services on behalf of your chartered accountant, so that is CA firm, then the date on which you received services, CA firm has received the services, so CA firm can definitely take ITC under this deemed delivery concept. But only thing, you should be in the articleship, means it should be in the course or furtherance of business. For the CA firm, then only the CA firm can take ITC. That is this: when goods are delivered to any person or service are provided to any person on the instructions of the recipient, the date on which such person has received goods or services, it is deemed that the recipient has received the goods or service and they can take ITC. That is, in case of bill to ship to transactions, billing address can take ITC. Then there is one query here, sir, in case of import of goods, it is not notified under 9(3). So therefore, should we take it under RCM? That's what I told you. So previously and all, ICAI used to take the situation that import of goods on which IGST paid, they were not taking under RCM liability. But of late, in some other questions, they have added that is IGST paid on import of goods as a part of the RCM liability. So therefore, I told you right now, so you need to follow that. So whatever IGST that we pay on import of goods, you take it as a part of RCM. But because of that, your answer will not get affected, because whatever IGST you paid under RCM, that you will take as ITC and you will adjust it against your FCM liability. But anyhow, that RCM you need to pay, and therefore that is not going to affect your answer, but the total etc. and all may change. But trust me, ICAI has taken the same view in the recent questions also. In RTP also they have given that. So happily you take that. IGST paid on import, you take as your RCM liability. Then next, goods received in lots or installments. Say for example, you placed an order for 100 units and 40 units got delivered in first month, 30 units in second month and 30 units in the third month. Then when can you take ITC? So proportionately can we take ITC? No, only on receipt of last lot we can take ITC, provided all these things are with respect to an invoice. What if separate invoices are given? When separate invoices are given, accordingly we can take ITC. So please write down, ITC shall be availed only on receipt of last lot or installments with respect to an invoice. This provision is applicable only for one invoice if they are delivering in multiple lots. Okay. Then reversal of ITC, this is rule 37. When the payment is not made to supplier within 180 days from the date of invoice, so much of the ITC available by recipient needs to be reversed. Now say for example, you have made the payment of 60% within 180 days and 40% you have not made within 180 days, then how much you need to reverse? Only proportionate to 40%. And suppose if you have not at all paid 100% within 180 days, so you need to reverse the ITC. Again, thereafter you paid 30% to the supplier. How much you can re-avail as ITC? That 30% can be re-availed as ITC. So the proportionate calculation we need to check. What if the contract says that the credit period is more than 180 days? Even then this 180 days will be applicable? Yes, this 180 days only will be applicable. So the contract should not be seen in this case. So that is about this. If recipient has not made payment to supplier within 180 days from the date of invoice, then so much of the ITC proportionate to the amount not paid to supplier availed by the recipient shall be reversed along with interest at 18% per annum. From which date to which date? From the date of utilization. What is the date of utilization? That month in which the balance sheet ITC falls below the wrongly availed ITC. To that extent, ITC is utilized till the date of reversal. However, if the availed ITC is not at all utilized, which means to this extent every month there is a balance. Should we pay any interest? No, interest payment shall not arise. Interest not payable if the availed ITC is not utilized. And there are three cases where this particular 180 days condition is not applicable. What is that? Supply without consideration. There is no consideration at all, wherefrom recipient can make payment to supplier within 180 days. So therefore this is not applicable. Then the liability is on the recipient. When recipient is required to pay GST under RCM, so therefore payment to supplier is not at all a condition here. Due to that reason, again 180 days is not applicable. Then 3, payment already made by the recipient to some other person on behalf of the supplier. For example, you are making payment to a creditor on behalf of me. In value of supply we discussed. You made payment to my creditor on my behalf. In that case, so definitely that is my indirect consideration 15(2)(b), it should be included in the value. So whether I should receive it, no, already my creditor has received it on my behalf, some other person has received it, so again don't apply 180 days condition. Payment to third party on behalf of supplier 15(2)(b). These are the three cases where this above proviso will not be applicable. Again, ITC can be reavailed as and when payment is made to supplier after 180 days, but the interest paid cannot be reavailed as ITC. Interest paid is gone, that is a complete loss. And if you don't want to pay interest, you maintain that sufficient balance in the ITC. There is no time limit for this reavailment. Then next section 16 subsection 3, that is while computing the depreciation under section 32 block of assets method, when we add the asset, we should not add the asset along with the GST component. For example, we purchase capital goods for 10 lakhs and GST will be 1,20,000. So in the block of assets, how much should be taken? 11,20,000 or 10 lakhs? 10 lakhs. If you take 10 lakhs, then 1,20,000 you can take ITC. If you take 11,20,000, then ITC is not available. So this similar point is there in 32 also, which says that if you avail ITC, you should not add 11,20,000 in the block like that. So if depreciation is computed on 11,20,000, then ITC of 1,20,000 is not available. Then time limit for availment of ITC, the time limit is 30th November of succeeding financial year or date of filing annual return, whichever is earlier. But this time limit is not applicable in case of reavailment of ITC reversed earlier. Now, in case of debit note, which date should be taken for the purpose of deciding the time limit? Whether the invoice date should be taken or the debit note date should be taken? Definitely debit note date only should be taken. So even though the invoice is given for the debit note some 4 years before also, but see the debit note date. So there is no time limit for debit note? Of course yes. For credit note only there is a time limit. So because credit note leads to reduction in liability, so there is a time limit. So because it's a loss to government, whereas debit note leads to increase in liability, gain to government. Why they will give time limit? Yeah, after 100 years also you give debit note, no issue. So therefore some debit note is given now for 10 years before invoice. In that case, based on debit note only we need to see for availment of ITC, not the invoice date. So in case of debit note, availment of ITC depends on the debit note date but not on the date on which invoice related to such debit note is given. Then this is the point I was referring to in case of RCM, where registered recipient issues invoice to unregistered supplier. Remember, self-invoice concept is there, that's an amendment now. Previously also it was there, but previously there was no clarity as to what is the time limit within which the self-invoice needs to be given. Now they have amended section 31 subsection 3 clause F accordingly with the rules, and they are telling that in case of self-invoice, first of all, when self-invoice, if the supplier is unregistered and the recipient is registered, then the concept is known as self-invoice, and the recipient should make payment to the supplier and recipient should pay GST under RCM, but he need to give invoice also. Now what is the time limit within which invoice to be given? 30 days for goods or services, anything. Whenever supplier is unregistered, the recipient is registered, the service or supply of goods is covered under RCM, the recipient should give invoice to the supplier within 30 days from the date of receipt of goods or services, and based on that the recipient can avail the ITC also. But to avail the ITC, what should be taken as the relevant date for the purpose of availment of ITC? So for that reason they gave a clarification in case of RCM, where the registered recipient issues invoice to unregistered supplier. Generally who will give invoice to whom? Supplier to recipient, but here supplier is unregistered and the recipient is registered. The date on which recipient issues invoice is relevant for determining the time limit for availment of ITC, but not the date on which the supply is made, etc. and all. So now this is the amendment, so which you need to keep in mind. So related to this, I have given one question. So generally, lot of students were asking me, literally torturing me, sir, amendments like that. But the problem with amendments is that I cannot take separately amendments. If you observe, everything is interconnected. If I take also, I cannot justify as to, amendment. See, I can take for the sake of use, for the sake of convincing my students, I can take, but it should be fruitful, na? End of the day it should be fruitful. That's the reason why I asked them, wait pa, I will take rocket revision. Sorry if I have made you wait, because now you will understand the importance, because I am connecting many places. This is very much required in CA final exam, that's why. Fine. So look into this question on amendment related to this RCM provision. I think it is question number 1 second. Question number 15. Question number 15. Infosys Limited this we discussed yesterday. I think in this I told you, correct, in this itself I told you when they can take ITC like that. In this itself I told you, that is in case of RCM, yesterday itself we completed this discussion. In case of RCM, the invoice needs to be given within 30 days, okay, within 30 days from the date of receipt of services. So when can they take ITC? So whenever they issued the invoice to the supplier, they can take ITC with respect to that, okay. So that is this, but somewhere etc. I discussed it. Fine. So when we see the other questions, it will come there. I will explain, no issue. So that is about this RCM case. Then the time limit for availment of ITC for certain financial years. So these two sections were newly added by Finance Act 2024, and this will be applicable so immediately itself. So time limit for availment of ITC for certain financial years. This is like a small provision for a stopgap arrangement. So 2017-18 to 2020-21, from financial year 2017-18 to 2021, if ITC is availed beyond the time limit, what happened at that time 17-18 to 2021, there was a huge dispute about the time limit for availment of ITC, because at that time it was 30th September of the succeeding financial year for which return was required to be filed. Return means GSTR-3B was the assumption, but GSTR-3B was not at all considered as a return at that time. At that time return was only GSTR-3, which was not notified. So due to that reason, so many people were having a doubt about availment of ITC. Even they are not required to file annual return time limit also got extended from time to time, and for that reason they took the ITC even beyond the time limit. So at that time, which year 17-18 to 2021, when they took the ITC beyond the time limit, all those ITCs were rejected. So because it was beyond the time limit, so this was rejected. These people went to the appeal, and when they went to the appeal, the many writ petitions were filed. Finally, so what happened, the case went to Supreme Court also, and Supreme Court said no, definitely ITC should be given to them. Thereafter, what GST finance minister did, GST department, they asked the GST department to give the benefit, whatever refunds that, like whatever ITCs that you have rejected, now you give the ITC back to them. But for which financial years? 17-18 to 2021. But by what time they should have availed the ITC? Okay, they availed the ITC beyond the time limit, but maximum by what time limit they should have availed the ITC? November 30, 2021. So they should have availed the ITC by November 30, 2021, which got rejected, and now we will be giving them the benefit. It is allowed even though it is in violation of section 16 subsection 4. Got it? And so which means it is for that past period, now they are giving the benefit. Then same way, section 16 subsection 6 also they have given time limit for availment of ITC in case of revocation of cancellation of registration. So what is the time limit for availment of ITC? So see this first, say this, that is, registered person can claim ITC on such invoice or debit notes in any written file within regular time limit or 30 days from revocation order, whichever is later. Let me give you the background of this. Initially what has happened, so time limit for availment of ITC was regular time limit 30th November, date of filing return, etc., whichever is earlier. Now what happened, my registration got cancelled. When my registration got cancelled, so I cannot file the return. As I cannot file the return, I could not take the ITC, but I was eligible to take ITC before the date of cancellation of registration. I had some inward supplies. I can take the ITC, but I missed to take ITC, and now I want to take, but I cannot take because my registration is cancelled. So I made an application for revocation and say 3 months window after 3 months they have revoked my cancellation. So they have given a revocation order. Now in these 3 months I could not take ITC and the time limit got expired. Say for example September 1st they have given the cancellation order, and I have made the revocation application and they have given the revocation order on December 31st. But in this September to December I cannot file return, but November 30 over, that is the time limit for availment of ITC got expired. Now in that case I could not take ITC. Okay, now what they are telling, it's okay even if that November 30th got expired, but they have added one more point. What is that one more point? What is the date on which I got the revocation order? 30th December or 31st December I got the revocation order. Na? From there within 30 days also I can avail the ITC. That is this 30 days from the date of revocation order, whichever is later. Whichever is later. This is another place where we have whichever is later provision, that is the time limit by which I can avail the ITC. Is it applicable for past periods also? Yes. For past periods also where we could not take ITC because of the time limit, now they are giving. Sir, what is the time limit, sir, by which I need to make this application for taking these 2 credits? Again I am repeating, please concentrate. Section 16.5 and section 16.6. These 2 are applicable for past periods also, and it is not only for the current period. Actually 16.6 is for the current period as well as past period, whereas 16.5 is only for the past period. And how to take these 2 ITCs, for that they have given one procedure. So that procedure you can see in the next chart. Registered person to whom ITC is available under 16.4 or 16.5, they made an application by 7/4/2025. They should make by 7/4 till time limit is there. Even now also you can tell to your CA firms and to the clients that 7/4/2025 still time limit is there for making application. So we are in what? Just March only. 7th April they have given the time. So we can still take the ITC. So an application should be made, and moreover this is not online form, this is offline form only, and to our jurisdictional officer who has rejected our ITC claim, to that person only we need to make application. Officer who passed the order of disallowance of ITC, if satisfied within 3 months, they will pass a rectified order and we can enjoy the ITC. Otherwise, suppose if they are not satisfied, if they are of the opinion that no, we should not get, even we are not covered under these 2 sections, then they will reject the application. Rejection of application after giving opportunity of being heard. Now you don't have to remember this application date, but remember this process of 3 months. Within 3 months, if satisfied they will give, otherwise they will reject. And this is about section 16.5 and section 16.6. Related to this section 16.6, I gave one question, so please have a look into that question. It is there. That is related to revocation of cancellation. Yes. TechPro, question number 17. TechPro Solutions Private Limited, a registered person under GST, had its registration cancelled by the proper officer on June 1, 2024 under section 29 of CGST Act. Yes, section 29 of CGST Act deals with cancellation of registration. Due to non-compliance with filing of returns, the company has received the input services for which it was eligible for ITC during the financial year 23-24. For financial year 23-24, what is the time limit for availment of ITC? 30th November 2024 or date of filing annual return, whichever is earlier. As the question is silent about date of filing annual return, usually when the question is silent about date of filing annual return, you take the due date of filing annual return itself as the date of filing annual return. What is the due date of filing annual return? 31st December 2024, whichever is earlier, that is 30th November 2024 is the time limit for availment of ITC for this financial year. Got it? But from June 1st, what has happened? 30th November 2024 is the time limit. From June 1st, what has happened? See the question. From June 1st, our registration got cancelled. Okay. Then, so therefore, on August 25, 2024, TechPro Solution applied for revocation of the cancellation of its registration under section 30 of CGST Act. The registration was revoked by the proper officer on September 5, 2024, allowing TechPro to continue its business operations. However, during the period of cancellation, TechPro Solutions received several invoices and debit notes for supplies made between June 1, 2024 and August 25, 2024. This is the facts of the case. Now, the company is now considering the possibility of claiming ITC on invoices pertaining to the supplies made during the period June 1st to August 25, 2024. That is the period of cancellation. For this, the regular provision only, no issue. What is a regular provision? What is the financial year for which this invoices pertains to? Not 23-24, 24-25. For 24-25, anyhow we have a time limit for availment of ITC, that is 30th November 2025, or date of filing and return, whichever is earlier, that is 30th November 2025 time limit is there. Happily we can take ITC with respect to that by the time limit, correct or not? That is the answer. Time limit for availment of ITC in respect of invoices for the period 1st June 2024 and 25th August 2024, that is the period of cancellation of registration, that is invoices pertains to financial year 24-25, A 30th November, or B date of filing and return, assume that it is 31st December 2025. So the time limit for availment of ITC will be what? Whichever is earlier. Which is earlier? 30th November 2025. Is it clear? Understood here? This is for which period? This is for the period June 1st 2024 to August 25 2024, that is the period of cancellation of registration. For this they have not given any amendment. This is normal, this is there, even before also it is there, now also it is there. But second point, you see, debit notes issued during the financial year 23-24 but not availed before the date of cancellation of registration. For 23-24 we should have availed the ITC at the time, but we missed. When we missed, we have a time limit by which we could have taken, but what happened? Cancellation of registration came, so we could not take. Now can we take? For that only they have brought in amendment. A, the regular time limit. What is the regular time limit? 30th November 2024, or date of filing and return, whichever is earlier, that is 30th November 2024. B, 30 days from the date of revocation order. What is the revocation order? September 5, 2024 plus 30 days, that is October 5, 2024, whichever is later is 30th November 2024 only. So the regular time limit is only later. So 30th November 2024 only will be taken. Is it clear here? So the regular time limit or the 30 days from revocation order, whichever is later, that is 30th November 2024. Now suppose if this question is modified, and in that they are asking what if revocation order is passed on 15/12/2024, then what would have happened? Then in that case the regular time limit is 30th November 2024, or the date of filing and return, whichever is earlier, is 30th November 2024, or 30 days from revocation order. The revocation order will be 15/12/2024 plus 30 days, that is 14/1/2025, whichever is later. So 14/1/2025 is the time limit by which they can avail ITC. Understood here? So like this they can definitely make a question on this time limit connected with cancellation of registration because of the amendment. Then look into the next one, apportionment of credit. Apportionment of credit and blocked credits. In this apportionment of credit, what happens is that when you are purchasing some inward supplies which is used purely for taxable and business purpose, can we take ITC? Of course we can take ITC. If the inward supplies are used for exclusively exempted supplies or non-business purpose, can we take ITC? No, we should not take ITC. When inward supplies are partly used for taxable, partly used for exempted, yes, proportionate ITC we can take. Same way when inward supplies are used partly for business and partly for non-business, then also we can proportionately take ITC. That is this. These two cases we can take proportionate ITC. And how do we take proportionate ITC? Don't take the ITC directly. So there is rule 42 and 43, and everywhere it is clearly given that first we need to follow ITC availed minus ITC reverse, then only we will get the net eligible ITC. This is the format we need to follow. For example, common ITC. The common ITC is somewhere 1,50,000, and the taxable turnover and exempted turnover is given. the taxable turnover is say somewhere like 40 lakhs and exempted turnover is 20 lakhs. Taxable turnover 40 lakhs, exempted turnover is 20 lakhs. Then in that case, we will be taking the ITC. So how we will take the ITC first? ITC avail. ITC avail. What is the ITC avail? Full ITC you take, 1,50,000 you take, minus ITC reverse. What is ITC reverse? Proportionate to exempted. That is 1,50,000 into exempted turnover 20 divided by total turnover 60. This needs to be reversed. Okay. So 1,50,000 into 1,50,000 into 20 divided by 60, that will be 50,000. So when you reduce 1,50,000 minus 50,000, 1 lakh will be taken as the net eligible ITC. So this is the format you need to follow. Directly also 1,50,000 into 40 by 60 we can take, but that should not be followed. This is the format in which you need to avail the ITC. So ITC avail minus ITC reverse, net eligible ITC. So that is only given here. Proportionate ITC. And what about zero rated supplies? Zero rated supplies will be treated as taxable supplies for the purpose of availment of ITC. That's the reason why when a product is exempted or a service is exempted, the moment it is exported, it will become zero rated and we can happily enjoy the ITC on our inward supplies. That is this. Then section 17 subsection 3 deals with meaning of exempted supplies. So there are certain transactions, even though it is not a supply, even though it is taxable supply, but we are treating it as exempted supply. This meaning of exempted supply is only for the purpose of ITC chapter, because generally the meaning of exempted supply, so meaning of exempted supplies we have in two places. One, general throughout the GST law, that is given in section 2. So usually whenever a definition is given in section 2 of an act, that will be applicable throughout the act. Whereas whenever a definition is not given in section 2 but it is given in some other place, then which means it will be applicable only in that particular chapter. So for that purpose, so like that, meaning of exempted supply which is given in section 2 is applicable throughout the GST law. What is the meaning of exempted supply? 3. Notified as exempted, nil rated, non-taxable. Government from time to time will be giving certain notifications for exemption, that is notified as exempted. Nil rated means the rate of GST is nil. Non-taxable, that is alcoholic liquor for human consumption and petroleum products. These three are treated as exempted for payment of GST. But for ITC purpose, we have same three we have: notified as exempted, nil rated, non-taxable. In addition to that, there are 4 transactions which are not at all supply but treated as exempted supply. What are they? Concentrate, sale of land, sale of building. When sale of building, where entire consideration is received after obtaining completion certificate or first occupation, whichever is earlier. And then sale of securities. Securities are neither goods nor services, but it will be treated as exempted for the purpose of ITC. Then supply of warehoused goods under customs. Sale of warehoused goods under customs. In this regard, they have added one point, that is there is a duty-free shop. Duty-free shop which is in the international airport. Duty-free shop in international airport is treated like a warehouse, customs warehouse only. Now that particular duty-free shop, when they are selling to incoming passengers goods, then it will be treated as sale of warehoused goods under customs, because that incoming passenger who is purchasing from a duty-free shop need to pay baggage duty, because as if these goods are imported from outside India to India, they need to pay baggage duty. Anyhow they are paying baggage duty. So for this duty-free shop, when they are making sale to the incoming passengers, it will be treated as not a supply, excluded from supply. You got it? So when it is excluded from supply, even though it is excluded from supply, but it is treated as exempted supply. What if the duty-free shop makes sale to outgoing passengers? Then that is treated as export. So it will be treated as zero rated supply. As it is zero rated supply, they can enjoy the ITC. So connecting these 2 points, I have given one chart below. You can see this. There is a duty-free shop in international airport, and that duty-free shop in international airport is making sale to incoming passengers as well as sale to outgoing passengers. Sale to outgoing passengers is treated as zero rated supply. And in that case, can they take ITC? Of course, yes. Can they get refund of ITC? Yes, they will get refund of ITC. Whereas they are making sale to incoming passengers, which is supply or not a supply? It is not treated as supply. It is treated as sale of warehouse goods under customs. Even though it is not supply, it is treated as exempted supply for reversal of ITC. And this duty free shop to sell, they may be purchasing some goods locally. So purchases by them within India chargeable to GST and they can avail the ITC. Now that much of ITC attributable to zero rated supplies, they will get the refund, whereas that much of ITC attributable to the sale to incoming passengers is treated as exempted and they need to reverse the ITC. That is the meaning of this. What it? So sale of, so 4 transactions, these are the 4 transactions, 5, 6, 7, 8, sale of land, sale of building, sale of securities, supply of warehoused goods. So these 4, even though not a supply but treated as exempted supply. For land, what should be taken? Stamp duty value. Building, what will be taken? Same stamp duty value. Securities, we will take 1% of sale value of securities. In case of the sale of warehoused goods, whatever is the price at which they are selling, that only will be taken. Then first 3 notified as exempted, nil rated, non-taxable. Next these 4. Then one more point, that is supply covered under RCM. When my outward supply is covered under RCM, it is taxable, not in my hands, my recipient hands, but for me it will be treated as exempted and I cannot take ITC on my inward supplies. That is this supply covered under RCM. Supplier of RCM supplies cannot take any ITC, but recipient can take ITC with respect to whatever GST they pay under RCM. So these are the 8 transactions which are treated as exempted for the purpose of ITC, computation of ITC. But in this also, there are 2 exceptional points you need to remember. That is, there are 2 transactions which are exempted, but it will be treated as taxable for ITC purpose. Number 1, interest on loans, advances, deposits. So this is actually exempted for payment of GST, but while computing ITC, it should be treated as taxable. So thereby your ITC reversal gets reduced. But to whom they need to give this benefit, to whom it will be more? Interest on loans, advances, deposits, banks, financial institutions, NBFCs, correct? But for them this provision is not applicable, got it? So to whom they have to give, they did not give. Interest on loans, advances, deposits will be treated as exempted for payment of GST, but for ITC purpose it will be treated as taxable. But for other than banks, financial institutions, NBFCs, which means for banks, financial institutions, NBFCs, it is treated as exempted both for payment of GST as well as for ITC purpose. Same way. Number 2, sale of duty credit scrips. The sale of duty credit scrips in customs. So duty credit ledger, we get a e-scrip. That e-scrip can be transferred to any other person. This is actually exempted. So sale of duty credit scrips is exempted. It's a supply, but it is exempted. Even though it is exempted for payment of GST, but for ITC purpose it will be treated as taxable. So consequently we can enjoy the ITC. That's what they are trying to convey. So first 8 points you need to remember. Then these 2 transactions, even though it will be exempted, but it will be treated as taxable. Then apart from that, one more point already we know, zero rated supplies. Zero rated supplies, even though the burden becomes 0, but it will be treated as taxable for the purpose of availment of ITC. Next, we have Rule 42, that is manner of availment of ITC with respect to inputs and input services. But this Rule 42, simple, we will see later, but I wanted to give you one question related to this, discussion of meaning of exempted supplies. So you can take that in comprehensive questions. Let's do one question so that you will get an idea. So in the solved workbook, it is there in question number question number 10, page number 614. So we have some comprehensive questions I have given for 14 marks question types, how they can give. So you can see one question out of that which is connected to this meaning of exempted supply. Question number 10, Adityanath Private Limited is registered person under GST in the state of Uttar Pradesh. It is engaged in supplying 3 products, product alpha, product beta and product gamma from its factory located in Rampur, Uttar Pradesh. product alpha and product beta are taxable, whereas product gamma is exempt from GST. Besides, it also supplies cigarettes from its factory located in Kanpur and owns a petrol pump in Lucknow. It is also engaged in supply of certain services. It has furnished the following information with regard to supplies made by it in the month of August. So they have given lot of outward supply details. So what you need to do is that whenever you get a question like this, so even in IBS also follow the same strategy. So what is it you need to do? First you need to read some initial paragraph. After reading initial paragraph, you will come to know that what business they are doing, etc. and all. Then you need to go to the last. When you go to the last, you will know what is the requirement that you need to do in that question. So see there, with the help of above mentioned information, compute the gross GST payable of Adityanath Private Limited for the month of August on the outward supplies made by it during the said period, gross liability. Now you add one more point here, compute net liability. Okay. Even though the question is about gross liability, let's modify the question. So compute net liability, write down, compute net liability if common inputs is rupees 75 lakhs and common input service is rupees 25 lakhs excluding applicable GST. Let's add this part and do the recomputation of this question. So we need to compute net liability. When we need to compute net liability, what is it we need to take? First we need to take gross GST under FCM, and thereafter any RCM liability and even ITC, everything we need to do in this case. Okay. And they have also given some rates. Assume the rates of GST on outward supply of goods and services is 12% and 18% respectively unless otherwise specified. Ignore CGST, SGST and IGST for the sake of simplicity. Exports made by Adityanath Private Limited, if any, have been made to persons other than distinct persons and are made by furnishing LUT without payment of IGST. That is, generally whenever they have given only exports, but the question is silent, so then we need to take any option. So my recommendation is that go for export without payment of IGST, but in question definitely they will clearly give which option they are going for. So here they are going for furnishing LUT without payment of IGST. Fine. Now we need to compute net GST payable. For that we have lot of outward supply data. So always we need to prepare one working note when you have lot of outward supply data. One for payment of GST what it is, and for computation of ITC what it is, because we have some sale of land, sale of building, etc. and all. So we need to prepare a working note like this. Okay. So what is that working note? So before proceeding to this question, before commencing the answer for this question, we need to prepare this working note so it will become easy for us. So we are preparing a working note. In this working note, we will see particulars, that is what is the transaction about, and then we will take what is the value, and then for payment of GST, that is little bigger column because we need to compute GST liability, and thereafter one last column for availment of ITC, So in this value column is useful for the purpose of computing the exempted turnover, total turnover details, etc. and all. And for payment of GST is useful for the purpose of computing our gross GST payable. So everything we can put it in one working note so that it will become easy for us while doing the answer. Now, so first we need to start with transaction number 1. Transaction number 1 is supply of product alpha. Product alpha is 50 lakhs. They have not given anything that this product alpha is exempted. Clearly they mention gamma is only exempt from GST, but alpha and beta are taxable. So supply of product alpha taxable, so 50 lakhs. And what is the rate of GST applicable to goods? For rate of GST for goods is 12%, service is 18%. So therefore we need to take 50 lakhs into 12%. So supply of alpha, that is value 50 lakhs. And for payment of GST it is what? Taxable. And as it is taxable for payment of GST, definitely it will be taxable even for ITC purpose. So whatever special points we discussed is 10 points. Apart from the 10 points, any other transaction, if it is taxable for payment of GST, it will be taxable for ITC also. Okay. And so as it is taxable, we need to compute the GST liability 50 lakhs into 12%, that will come to 6 lakhs. 6 lakhs is the liability. Then next transaction, supply of product gamma. So supply of gamma, and gamma is actually what? Exempted, correct? So clearly it is given in the question itself, gamma is exempted. So 1 crore is exempted, but whether we will take it in the amount column? Yes. we need to take in the amount column. So it is exempted for payment of GST. When it is exempted, we don't have any liability. So when it is exempt for payment of GST, it is covered anywhere in the special points? No. So means it will be exempted even for the purpose of computation of ITC. Then next transaction. Next transaction is supply of management consultancy services, 50 lakhs. They have not given anything. Nothing is given means it will be taxable. So what is the rate of GST? 18%. So management consultancy services. Management consultancy, how much? 50 lakhs. And what is it? Taxable. As it will be taxable for payment of GST, we need to take GST. How much? 50 lakhs into 18%, that will be 9 lakhs. As it is taxable for payment of GST, definitely it will be taxable even for ITC purpose. Next one, renting of commercial complex to local traders of electronic goods. So basically remember, whenever we are giving commercial property on rent, there is one amendment now. In case of renting of commercial property, if the supplier is unregistered and if the recipient is registered, it will be covered under RCM. But here the supplier is registered, so RCM will not come, it will be FCM. So Adityanath Private Limited is registered under GST. So renting of commercial complex is a service, that is 30 lakhs. Renting of complex, that is 30 lakhs, and it will be taxable. We don't have any exemption with respect to renting of commercial property, and 30 lakhs into 18%, that will be 5,40,000. As it is taxable for payment of GST, definitely it will be taxable even for ITC purpose also. Export of product beta. Product beta is taxable and it is exported. So they are going for which option? Without payment of IGST, wherever possible without payment of IGST. So therefore export of beta. So export of beta, what is the value that is given there? Export of beta will be, so 1 crore, and 1 crore it will be what? Zero rated and under bond or LUT. So there is no GST in this case. Even though there is no GST, it will be treated as taxable for the purpose of ITC, computation of ITC. So because it comes under those 10 special points. Next one, renting is 50 lakhs only. Okay, I took 30 lakhs, sorry. Renting is 50 lakhs, then it will be taxable, so 9 lakhs will be taken. Then next one, can you help me? Export of consultancy services, including exports made to Nepal based company of rupees 5 lakhs. Payment is received in Indian currency in the said case. So generally export of services is for a consideration in convertible foreign exchange, but wherever it is permitted by RBI, it can be in Indian rupees. Where is it permitted by RBI? Two cases it is permitted by RBI: services to Nepal and Bhutan, and payment received in rupee Ostro account. When the payment is created in rupee Ostro account, which is maintained by a bank outside India, even then the payment is received in convertible foreign exchange. Here Nepal, it is export of services, and in this case whether it will be under bond or LUT? Yes, LUT. So again there is no GST, same. Export of services 20 lakhs. Export of services 20 lakhs, and it will be what? Zero rated. Whether we need to pay GST or not required to pay GST, not required to pay GST, but for ITC purpose it will be treated as taxable. And next one, sale of building excluding stamp duty of 2,50,000 being 2% of the value adopted for paying stamp duty. Entire consideration is received post issuance of completion certificate. So which means it is not a supply, but it will be treated as exempted supply for ITC purpose. How much should be taken as the value? In case of sale of building, we need to take stamp duty value. What is the stamp duty value here? 2 crore 50 lakhs is not stamp duty value. 2,50,000 is 2%. So which means 100% is how much? 2,50,000 is stamp duty. So means we need stamp duty value. So therefore 2,50,000 divided by 0.02, that will be 1 crore 25 lakhs will be taken as the sale of building. Sale of building we need to take 1 crore 25 lakhs as the value, and it is not a supply. As it is not a supply, payment of GST shall not arise, but for ITC purpose it will be treated as exempted. Then next one, interest received on investment in fixed deposits in money bank. Interest on FD is exempted, but for ITC purpose it will be treated as taxable because they are not bank financial institution other than bank financial institution NBFC. So interest on fixed deposits, interest on deposits, what is the value of interest on deposits? 10 lakhs, 10 lakh 50,000. It is exempted, it is exempted for payment of GST, so liability is not there, but for ITC purpose it will be treated as taxable. And next one, sale of shares of a public company, purchase price of that share is 2 crore 40 lakhs, so 2 crore 50 lakhs is the sale price. So sale of shares is actually not a supply, but it will be treated as exempted. Sale of shares not a supply. What is the value of sale of shares? 1% of sale value. Don't take full amount, take only 1% of sale value. So 2 crore 50 lakhs into 1%. So 2 crore 50 lakhs into 1% will be 2 lakh 50,000, but for ITC purpose it will be treated as exempted. Then next one, supply of cigarettes, GST being levied at 28%, including excise duty of 12 lakh 50,000, so 1 crore. Supply of cigarettes is taxable for payment of GST. Even for ITC purpose also it will be treated as taxable. So supply of cigarettes, what is the value? Supply of cigarettes will be 1 crore. And what is it? It is taxable for payment of GST. So goods or services are goods. Goods means 1 crore into 12% will be 12 lakhs. But for ITC purpose, as it is taxable for payment of GST, even it will be treated as taxable. But you made a mistake. It should not be 1 crore, because while computing the ITC, so old indirect taxes should not be taken into turnover. Okay, there are 4 old indirect taxes that should not be taken into turnover while computing the ITC. So this point I have given here. So you can see this. Page number 106 of your pocket book, that's it book, you can see that is while computing turnover under rule 42, 43 and section 20. Rule 42 is applicable in case of reversal of ITC on inputs and input services, 43 is in case of capital goods, and section 20 is input service distributor. Old indirect taxes, what are the old indirect taxes? Central excise duty, state excise duty, then central sales tax and value added tax. That should be excluded, it should not be taken into account, but actually it is contradiction with section 15(2)(a). Section 15(2)(a) says all taxes, duties and cess by whatever name call other than GST should be included in the value. Okay, so this is actually exception to section 15(2)(a). This is exception to section 15(2)(a). Section 15(2)(a) says all taxes, duties and cess by whatever name call other than GST should be included in the value, means consequently this old indirect tax also should be included in the value, but we should not be taking this for the purpose of ITC computation, which means while computing GST you should include it or not? Yes, but while computing ITC it should be excluded. Right now we are taking the amount column, so in the amount column you need to take out how much is the value of this excise duty? 12 lakh 50,000. So 12 lakh 50,000 you take out from 1 crore, so that will come to 87 lakh 50,000. But you need to compute the GST on 1 crore only. You need to compute GST on 1 crore only, because for computation of GST it should be included. So 1 crore into 12%, that will be 12 lakhs. Okay, for computation of GST it should be included. For ITC purpose only it should not be included. So that is about supply of cigarettes. Then next one what we have is supply of petrol and diesel. Petrol and diesel are non-taxable supplies, so we don't have to pay GST. But again here also same, they have given including VAT and excise duty. So what should be taken as the value? Do that and tell me. Sale of petrol and diesel. sale of petrol and diesel, actually it is exempted. We don't have to treat it as taxable because it is non-taxable, and then we need to take value as how much? 80 lakhs. 80 lakhs minus VAT and excise duty will not come. While computing the turnover for ITC purpose, VAT and excise duty will not come. So minus 5 lakhs minus 12 lakh 50,000, that will come to 62 lakh 50,000. So 62 lakh 50,000 will be taken as the value. Okay. Next one, we have amount received from Durgadas Private Limited of Lucknow. It has sponsored the business exhibition organized in Delhi by Adityanath Private Limited. Basically, in case of sponsorship services, if the recipient is body corporate or firm, it will be covered under RCM. So it's a sponsorship service. For sponsorship service, only one exemption is there. That is, if the sponsorship is with respect to recognized sporting event. Here it is not a recognized sporting event. Due to that reason, this sponsorship service will be taxable. And as the recipient is body corporate, it will be covered under RCM. Means it will not be taxable in the hands of Adityanath Private Limited. So even though it is taxable under RCM, but for ITC purpose, it will be treated as exempted. Okay. So sponsorship services. What is the value of sponsorship services? 6 lakhs. Sponsorship service is 6 lakhs and it is actually taxable under RCM. Means don't add it to this person's liability, but for ITC purpose it will be treated as exempted. Okay. And so in case of cigarettes, rate of GST is 28%, sir, but why you have taken 12%? Because the rate is given in the question as 12%, that's why we are taking 12%. And we don't know, really I don't know what is the rate applicable to cigarettes also. So this guy, in the question it is given. So but see this note, assume the rates of GST on outward supply of goods and services are 12% and 18% respectively, unless otherwise specified. So is it specified? Yes. GST being levied at 28%. So 12%, 18%, but unless otherwise specified. Here it is specified as 28%. Due to that reason we are taking 28%. So one mistake we did. What is that? We have taken 12%. So it should have been into 28%. So that will come to 28 lakhs. 28 lakhs. Next one, anything else in the outward supply? No. Amount received from Durgadas Private Limited of Lucknow, that's it. Now we completed this working note. So far what we completed is only working note. We have not completed the answer. Now we need to write the answer. What is that? First, statement number 1. Computation of GST payable on outward supplies. Computation of gross GST payable on outward supplies. Computation of gross GST payable on outward supplies. What is that gross GST payable on outward supplies? Here already we did the computation. Just take that 6 lakhs plus 9 lakhs plus 9 lakhs plus 28 lakhs. So how much? 6 lakhs plus 9 lakhs plus 9 lakhs plus 28 lakhs. That will come to 52 lakhs. So 52 lakhs already we did the computation. That is the help of working note. So once you prepare the working note, this step will become easy. Okay. Is there any inward supply under RCM? Nothing. There is no inward supply under RCM. GST payable on inward supply. GST payable on inward supply under RCM is statement 2. That is 0. That is 0. We don't have anything in this question. Then third statement, computation of ITC availed and reversed. Computation of ITC availed and reversed. So for this, first we need to know, for ITC purpose, for ITC reversal, what is the taxable turnover? exempted turnover and total turnover. Tell me, taxable turnover, already you see the working note. Exempted turnover, and then total turnover. Total turnover, taxable turnover, exempted turnover and total turnover. What is taken as taxable turnover? So wherever it is given as taxable, you take those amounts. So that's the reason why we prepared a value column. Wherever it is taxable, that is 50 lakhs we will take, and then again next 50 lakhs we will take. Thereafter next 50 lakhs we will take. So 1 crore 50 lakhs, then next 1 crore, then 20 lakhs. Thereafter we have 10 lakh 50,000, then 87 lakh 50,000. Next, that's it now. So 3 crore 68 lakhs is taxable turnover. Then exempted turnover we need to get. What is that exempted turnover? 1 crore. Then next one is 1 crore 25 lakhs. Thereafter 2 lakh 50,000. Then 62 lakh 50,000 plus 6 lakhs. That will come to 22 crore 96 lakhs. 2 crore 96 lakhs plus 3 crore 68 lakhs will come to 6 crores 64 lakhs is the total turnover. Now ITC availed, ITC availed, ITC availed, that is given in the question. So that's what we have added, 75 lakhs and 25 lakhs. So 75 lakhs into goods, so into 12%. Okay, so 75 lakhs into 12%. What is it? 75 lakhs into 12%, into 12%, that will be 9 lakhs. Then input services, input services is how much? 25 lakhs into 25 lakhs into 18%, that will be 2 lakh 4 lakh 50,000. So this is ITC avail, 9 lakhs plus 4 lakh 50,000, that is 13 lakh 50,000 minus ITC reversed. ITC reversed. What is the ITC reversed? 13 lakh 50,000 into, because everything is common, exempted by total. What is exempted? 296 divided by 664. So 13 lakh 50,000 into 296 by 664, that will come to 6 lakh 1,807. We need to reverse. So this is called as the net eligible ITC. Net eligible ITC for set off. So will be 7 lakh 48,193. Now liability we got 52 lakhs. So last statement, computation of net GST payable. Computation of net GST payable. What is the taxable turnover? What is the taxable turnover? Excluding zero rated. Excluding zero rated, because for rule 86B, we need to check, for rule 86B we need to check taxable turnover excluding zero rated. So we need to take only taxable. Zero rated should not be counted, exempted should not be counted, non-taxable should not be counted. Okay, only taxable, purely taxable, excluding zero rated. If you see, so first one 50 lakhs, then 50, 1.5, and zero rated should not be taken. Okay, zero rated should not be taken. So definitely it is more than 50 lakhs, correct? More than 50 lakhs. More than 50 lakhs means rule 86B is applicable. But the problem here is, anyhow they have to pay more liability, because if you see their gross liability 52 lakhs, 52 lakhs into 1%, 52,000. But if you see their credit just 7 lakh 48,000, anyhow naturally they will pay net liability more than that. So that's why no need to apply rule 86B here. Got it? This is one step which we need to follow. So gross GST payable. So what is the gross GST payable? Gross GST payable here will be 52 lakhs. 52 lakhs minus what is the ITC utilized? ITC utilized will be 7,48,193. When you adjust that, you will get net GST payable. So what is that net GST payable? 52 lakhs minus 7 lakh 48,193, that is 4 lakh 44 lakh 51,807. Okay. So hope you understood as to how we need to arrive at the answer in case when we have a question like this. Okay. So I am expecting a question of this sort because it's quite a long time they have not asked, because last time if you see mostly the question was on place of supply. Last time 14 marks question, most focus is on place of supply, and like that one attempt 14 marks question will be given on one focused area. Like that input tax credit related focused area also many times many attempts the questions came. So this time also I am expecting a focus area of input tax credit. So this question, this type of question can be asked because it has a meaning of exempted, reversal of ITC, even one circular also related to old indirect taxes. Okay, so they can test a question like this. Understood na? Yes. So we'll take a break and we will meet at 2:40. Now time is only 1:40, that's why. Okay, we'll meet at 2:40 and we'll start with rule 42, 43, etc. and please eat less and come. Thank you. And 1 second pa, 1 second. Okay, we'll continue with the discussion. So far we have seen apportionment of ITC. Now we need to move on to Rule 42. Rule 42 deals with manner of availment and availment and utilization of ITC in case of inputs and input services. In case of capital goods, it will be Rule 43. So for inputs, what we need to do is that first we need to see what is the total GST paid on all inputs. That total GST paid on all inputs will be denoted with T1, and this T1, T, and this T you can make note there itself just some numbers in order to know as to what is the process in which we are doing. First we need to see in the question whatever is the inward supplies on which GST is paid, whatever inward supplies on which GST is paid will be denoted with T. That will be, say for example, 10 lakhs is the T, that is total tax paid on inward supplies. This 10 lakhs we need to segregate into 4, T1, T2, T3, T4. T1 refers to inward supplies used for non-business purpose. Say we have some 1,50,000 rupees of inward supplies used for non-business purpose, and inward supply used for exempted outward supply, say 2 lakhs, and then blocked ITC is 50,000. Now with these three we need to take out. So total 10 lakhs is the tax paid on inward supply minus inward supply is for non-business purpose 1,50,000 minus exempted supplies 2 lakhs minus 50,000 T3. Now what you get balance is 6 lakhs. That 6 lakhs is known as ITC availed in GSTR-3B. So this is the ITC that will be availed in 3B. Thereafter we need to separate inward supply used for taxable and business purpose. Say inward supply used for taxable and business purpose is 4 lakhs. So minus 4 lakhs. What is the remainder that is left? 2 lakhs. That 2 lakhs is known as common credit. So T refers to total tax paid on inward supplies, and T1 non-business purpose, T2 exempted supply, T3 blocked credits, and if you reduce T1, T2, T3, you will get ITC availed in 3B 6 lakhs, and thereafter inward supply exclusively for taxable and business purpose. If you separate, you will get common credit. Common credit means partly used for business, partly used for non-business, partly used for taxable, and partly used for exempted. So this common credit you need to check how much is attributable to exempted supplies. So for that we need to take exempted turnover. Say exempted turnover is somewhere like 40 lakhs and total turnover is somewhere like 60 lakhs. Then what we need to do? So out of this 2 lakhs proportionate to exempted. What is proportionate to exempted? 4 by 6. So 2 lakhs into 4 divided by 6, that will be 1,33,333 needs to be reversed, and thereafter out of this common credit there is one invoice. Out of this common credit there is one invoice which is partly for business, partly for non-business. Then the entire common credit into 5% we need to reverse. So therefore entire common credit is 2 lakhs. 2 lakhs into 5%, that will be 10,000. 2 lakhs into 5%, that is 10,000. But remember, out of this common credit there should be at least one invoice which is partly used for business, partly used for non-business. Suppose if you know exactly how much is used for business and non-business, say 1/3 is used for non-business, means 1/3 we will keep in T1 itself. So 1/3 is used for non-business, like that if you know, you segregate it in T1 stage. So therefore 2/3 will not be coming here, 2/3 will come in T4, or it may come in common also, but this 5% point is not required. This 5% point is required only if out of the common credit there is one invoice or one inward supply which is partly used for business and partly used for non-business purpose. Then we need to do this reversal. So what is the ITC availed in GSTR-3B? ITC availed in GSTR-3B is 6 lakhs in this example. 6 lakhs is the ITC availed in 3B. And what is the ITC to be reversed? So to be reversed is 1,33,333 and 10,000 rupees, that is 1,43,333 is the ITC to be reversed. And what is the net eligible ITC? So C1, that is ITC availed in 3B minus D1 and D2, 1,43,333, that will be 4,56,667 will be taken as the net eligible ITC for set off. Okay, so 4,56,667, and this particular computation above shall be computed separately for ITC of CGST, SGST, UTGST and IGST, and D1 and D2 will be computed again at the end of the year. Whatever we are doing, this D1 and D2 is only for month on month basis. Again we need to do this computation at the end of the year. When we do this computation at the end of the year, so what will happen? Whatever we have already reversed is provisional, say for example that is some 5 lakhs, and what we need to reverse at the end of the year, that is D1 and D2, again we need to recompute. So because of the ratio it may change, and we may be having to reverse 5 lakh 50. What we have reversed is 5 lakhs. What we need to reverse is 5 lakh 50. So that 50,000 rupees we need to reverse along with interest at the rate of 18% per annum from the 1st April of succeeding financial year till the date of payment. What if we have already reversed is 5 lakhs, what we are supposed to reverse is only 4 lakhs, means we have excess reverse, that excess reverse 1 lakh can be availed as ITC. So that is, if the amount is less than amount added to output tax liability every month, the additional amount paid has to be claimed back as credit in the return of any month till September of the succeeding financial year. Usual time limit is November, but in this case it will be September only we can avail the ITC. That is, by September we need to avail the ITC. This is about Rule 42. So in case of Rule 42, please keep in mind that you need to just stick on to the format. So this format, if you do, you will know C1, that is ITC availed in 3B, D1 and D2 is ITC reverse. So that balance is the net eligible ITC. Then Rule 43. Rule 43 is manner of availment of ITC with respect to capital goods. I am purchasing some capital goods which is exclusively used for taxable supply or business purpose. Can I take ITC with respect to this capital goods? Yes. I am purchasing some capital goods which is used for exempted or non-business purpose. I cannot take ITC with respect to this capital goods. If I am buying some capital goods which is partly used for taxable and partly used for exempted, I can take ITC, but full ITC I cannot enjoy. Over a period of 60 months, I need to reverse the ITC. So therefore, I need to take monthly ITC. So see the treatment in case of capital goods too. So first you avail the 100% ITC with respect to GST paid, and that you will transfer it to electronic credit ledger. Thereafter you need to compute monthly ITC. What is a monthly ITC? Total ITC divided by 60. You will get monthly ITC. So here the life of the capital goods is assumed to be 60 months. Can we take a period less than 60 months also? Yes. In the question, suppose if they have given 36 months or 48 months, you go by that 36 months or 48 months. If the question is silent, then only you need to take 60 months. So if the question is 60 months, you take 60. If the question is silent also, you take 60 months. So ITC avail divided by 60. For example, we are purchasing capital goods for 10 lakhs. On that capital goods, 1,80,000 is the GST. So 1,80,000 divided by 60, 3,000 rupees will be taken as monthly ITC. That monthly ITC, we need to see what is the exempted turnover of that month divided by total turnover of that month. For the next 60 months from the rate of purchase, compute monthly ITC attributable to exempted supply. How to compute monthly ITC attributable to exempted supply? Monthly ITC into exempted supply for that month divided by total supply for that month we need to take. This above amount to be added to output tax liability for every month for the next 60 months along with interest. But in this case, the interest will be computed at the rate of 18% per annum from the date of availment of ITC till the date of addition to output tax liability is paid. And what will happen if this particular capital goods within the 6 months is sold, within the 60 months it is sold? Whenever the capital goods are sold, always 18 subsection 6 will come into picture. What does 18 subsection 6 says? So much of the ITC availed minus 5% for every quarter or part thereof from the date of purchase till the date of disposal, or GST payable on sale value of such capital goods, whichever is higher. So the above procedure is not required from the month in which the capital goods are sold, as GST is payable as per 18(6). Then say this, initial purchase you are using for CG1 means what? Initially I purchased some capital goods. Say for example, on 1/4/2023 I purchased some capital goods, and this capital goods purchased is used for CG used for taxable. CG used for taxable. Okay. So on 1/4/2023 we purchased capital goods and it is fully used for taxable. What is considered as the life of the capital goods? The life of the capital goods will be taken as 60 months or 5 years. Means the life of the capital goods is up to 31st March 2028. That is 60 months. And at a later point of time, say after 2 years, from 1/4/2025, we started using it for both taxable and exempted. CG used for both taxable and exempted. Now tell me what is the treatment to be followed. Again I am repeating. First, initially we purchased capital goods and we have used it only for taxable. At a later point of time, say on 1/4/2025, it is used for both taxable and exempted, which means for what period it is used only for taxable? 2 years, and for 3 years 3 years, it is used for both taxable and exempted. So 3 years or 36 months. Now, at the time of purchase of capital goods itself, ITC availed or ITC not availed? ITC availed. So now don't take the ITC because ITC already availed. Just recognize it as common ITC. Just recognize it as common ITC from 1/4/2025. Thereafter, for next 36 months, 3 years or 36 months, what you need to do for the next 36 months? You need to do the monthly reversal. So monthly ITC, so that is how to calculate monthly ITC. Say for example, we purchase this capital goods for 10 lakhs excluding GST at 12%, so that will be coming to 1,20,000. So 1,20,000 into exempted turnover divided by total turnover of that month. So 1,20,000 divided by 60 or divided by 36. Divided by 60 only should be taken, not divided by 36. Why not divided by 36 should not be taken? Even though we are going to reverse it for 36 months, but the life of the capital goods will not change. The life of the capital goods will be same. So 1,20,000 divided by 60 into exempted turnover of that month divided by total turnover of that month. So that particular month, for that month, we need to reverse. Is it clear? So this we need to reverse for a period of 36 months along with interest. At what rate? 18%. From which date? From 1/4/2025, not from the date of availment, because the date of conversion will be taken as the date of availment here. So therefore, from 1/4/2025, the interest computation shall arise. This is in case when initially the capital goods are purchased and used for CG1, at a later point of time used for CG2. ITC already availed at the time of purchase, so no need to avail common credit. Monthly ITC equals to original ITC divided by 60. Proportionate reversal from the month of conversion for balance useful life. And for computation of interest, consider ITC availment as the date of conversion. So whenever it got converted, that is taken as the date of availment of ITC. This is about the first situation. Then another special case, that is initial purchase, you are using it for CG3. That is same story, but what happened is that initially I have purchased and I have availed ITC. Initially purchased and I used it for exempted. Okay, initially I purchased and used it for exempted. Now when I have used it for exempted, whether I would have availed ITC, I have not availed ITC. Definitely ITC is not availed. ITC not availed. Now can we avail the ITC? Say after 2 years, CG is used for both taxable and exempted. Can we avail the ITC? Yes. So avail the ITC. ITC availed. How much is the ITC availed now? So how much to be taken? 1,20,000. Full ITC you take. Full ITC you take. But for the last 2 years, it is used for what purpose? For the last 2 years, it is used for exempted. So for that purpose, you need to do the reversal. This is past reversal. What is the past reversal? The past reversal will be 5% for every quarter or part thereof from the date of purchase till the date of conversion. So how many quarters? 2 years means 8 quarters. So therefore, 1,20,000 into 5% into 8 quarters, we need to reverse. So 1,20,000 into 5% into 8 quarters, that will be 48,000. This is past reversal. So right now we will avail the ITC of 1,20,000 and thereafter we need to do the reversal for the past period 48,000, and again future reversal also will arise. What is that future reversal? Same for the next 36 months. For the next 36 months, we need to do the same monthly ITC 1,20,000 divided by 60 into E by F of that month. So which means that, so past reversal also is there and this is future reversal. This is future reversal. Future reversal. Whereas in case of the previous situation, it is only future reversal. There is no past reversal because in the past it is used only for taxable, but here it is used for exempted. So that's the reason why first we will take ITC, past period we will reverse, even future also we will do the reversal for the balance life. That is with respect to this. And so you can see here, initial purchase, ITC not available at the time of purchase, so it should be availed now. That is original GST paid. Ineligible ITC ineligible ITC to be reversed for the period it is used for exempted, GST paid into 5% into number of quarters or part thereof from the date of purchase till the date of conversion. And here the month-wise quarter means what? That is like depending upon the calendar quarter we need to take, and monthly ITC equals to original ITC divided by 60 months, proportionate reversal from the date of conversion for balance useful life, interest to be computed from the date of conversion. So this is about capital goods, and here there could be some special situations. What is it? Special situations? Initially I purchased and used it for exempted, later on I am using it for taxable, then what should I do? Then in that case, so I need to go for 18 subsection 1 clause D, 18(1)(d). Initially I purchased and my outward supplies was exempted, and at a later point of time my outward supply became taxable, that is covered under 18(1)(d), availment of ITC on closing stock including capital goods. Same way, initially I purchased used for taxable, at a later point of time it is used for exempted, then I need to reverse the ITC on capital goods as per 18 subsection 4. Whereas initially I purchased and used for common, now I am using it for only taxable. Simple, you don't have to do the E by F reversal. Initially I purchased and used for common, now I am using only for exempted. Simple, fully you do the reversal because you are not going to use it for taxable at all. Then here there is one rule 32 sub rule 4 which we discussed in value of supply, which says that for a life insurance business there is a special valuation methodology wherein they will not pay GST on entire premium. In case of single premium annuity policy they will pay GST only on 10% of the single premium. In case of reinvestment policy, premium collected minus amount allocated for investment will be taken as a value. Whereas in case of any other policy, first year premium into 25%. Very good. Then subsequent year premium into 12.5%. Now there is a clarification in this regard. As they are not going to pay GST on the remaining part, for example, first year premium 25% means 75% premium they are not paying GST. Same way single premium annuity 10% they are paying means in the remaining 90% they are not paying. Should that be treated as exempted turnover for the purpose of reversal of ITC? For which CBIC clarified no. Whatever we are determining itself is the value, and that itself is the full value. So therefore there is nothing like that called exempted turnover here, which means an insurance company can take the entire ITC. So even though they are not paying GST on entire premium, is it clear or not? So see this, whether ITC to be reversed by a life insurance company on the portion of premium not included in the value as per rule 32 sub rule 4, premium value not included in the taxable value is not considered as exempted or non-taxable supply. Therefore ITC reversal shall not arise in terms of rule 42 or 43. Based on that, I have given one question, so that is connecting valuation and this ITC point. They can make one question, you can have a look into this. So question number Question number 21, page 659. HDFC Life Insurance Company Limited, a registered entity under GST, offers life insurance policies. They compute the value for payment of GST in terms of rule 32 sub rule 4 of CGST rules. In July 2024, HDFC Life Insurance received total premium of 60 lakhs from customers for various life insurance policies. 30 lakhs of this premium pertains to risk cover policy. How much should be taken as a value? How much should be taken as a value out of this 30 lakhs? 30 lakhs into, so full 100%. Why full 100%? Because it's a risk cover policy, so entire 30 lakhs will be taken. Whereas 20 lakhs of this premium pertains to first year policies. First year policies means 25%, so which means only 5 lakhs will be taken. And 10 lakhs of this premium pertains to policies issued in earlier years. So into 12.5%, into 12.5%, which will be 1,25,000. Now you see the total of this. So 30 lakhs plus 5 lakhs plus 1,25,000, that will come to 36,25,000. So this 36,25,000 should be taken as the value, and on the GST will be payable. Now the point is, remaining 75% we are not paying. Can we consider it as exempted? No. So the company has 5 lakh of total ITC. Can they enjoy the total ITC? Yes. So you can see here 36,25,000 the rate of GST 18%, so 6,52,500 minus this entire ITC can be utilized because of the CBIC circular. As per CBIC circular, reversal of ITC shall not arise owing to reduction in value, so 5 lakhs. So net GST payable will be 1,52,500. Like that, they can blend valuation related provision to this circular. Okay. Then next one, you can see special provision for availment of ITC by a banking company, financial institution, including NBFC. We all know that banking company, financial institution, NBFC, interest income will be exempted, but it will be exempted even for ITC purpose also. Whereas the other income for the bank, financial institution, NBFC, like documentation charges, processing fee, NEFT, credit card charges, etc. and all, that will be taxable. So means part of their outward supply is exempted, part of their outward supply is taxable. They have two options. This is only for bank, financial institution, NBFC. What is option number 1? Proportionate ITC method, which means they will take ITC proportionate to their taxable turnover. Whereas another option is there, that is ad hoc ITC, means flat 50% of the eligible ITC they will take, remaining 50% will be lapsed. So you can see option 1, avail proportionate ITC, option 2, avail 50% of the eligible ITC. In this regard, you need to remember some key points. What is that? This option they need to select in the beginning of the financial year, and option 1 selected will remain throughout the financial year. That is normal, that you know. But another point is there. What about blocked credit? Will we take blocked credit in option 1? No. Option 2 also will not take blocked credit. And inward supply used for non-business purpose, whether we take in option 1? No. Option 2 also we will not take inward supply used for non-business purpose. Whereas inward supply used for taxable, in case of option 1 we will take full ITC, but in option 2 we will take 50% ITC. Inward supply used for exempted in option 1, we will not take ITC, but in option 2 we will take 50% ITC. Common ITC in option 1 we will take proportionate, but in case of option 2 we will take 50%, which means in option 2, inward supply exclusive used for taxable, inward supply exclusive used for exempted, inward supply used for both taxable and exempted, everything will be taken as 50%, which we are not doing in proportionate ITC. In proportionate ITC, inward supply used for taxable we are taking full, and inward supply used for exempted we are not at all taking, and common credit we are taking proportionate. That is a huge difference here. So in case of option 2, inward supply exclusive for non-business purpose and blocked credit, ITC should not be availed. 50% compute on the remaining ITC, including used exclusively for exempted supply and used exclusively for taxable supplies. And then one more difference is there, that is in case of inward supply from a distinct person. In proportionate ITC we will take proportionate ITC, but in ad hoc ITC option we will take 100%. In case of option 2, restriction of 50% shall not apply to tax paid on supplies made to another registration within the same entity, that is inward supply from a distinct person. That is no need to reverse 50% of ITC with respect to inward supply from distinct person, and this option 1 excise cannot be withdrawn during remaining part of the financial year. So this key point please keep in mind, that is inward supply exclusively for taxable we will take fully, but here we will take only 50%. Inward supply exclusively for exempted we will not take, but here we will take 50%. Okay, next. Now we are moving on to blocked credits. So blocked credits are crucial for the purpose of computation. Mostly MCQs, again in 14 marks question, this blocked credits connection will be there. At least 1 or 2 points will be tested out of this blocked credits. Blocked credits means what? Even though there are some inward supply used for business purpose, but you cannot take ITC with respect to these inward supplies. That is known as blocked credits. So blocked credits are divided into 3 parts. Number 1, motor vehicle related block credit. Number 2, that is construction related block credit. Number 3, other blocked credits. So first one, motor vehicle related block credit. Motor vehicles are divided into 3. Motor vehicle used for transportation of persons, vessels and aircrafts, and other motor vehicles. Other motor vehicles means trucks, road rollers, or cranes, or overhead this forklift trucks. All these are other motor vehicles on which definitely ITC can be availed. Even ambulance will also come under other motor vehicles. Why won't it come under transportation of persons? Because in ambulance how much money you pay also they will not transport you unless you are a patient. So it is mainly for providing the first aid. How much ever, for example 2 o'clock exam or 1:45 exam, so 1:30 it is over, can we book an ambulance? I will pay 5,000 rupees also. Not possible. So they will not transport you. So it is mainly for providing first aid during the travel. That's why it will come under other motor vehicles and ITC available. But even then, they cannot enjoy the ITC. You know why they cannot enjoy the ITC? Because healthcare services, including ambulance service, is exempted. So due to that reason, they cannot take ITC with respect to that. Then next, caravan. Caravan which is used by the celebrities or actors for the purpose of changing their dress or makeup, etc. Because they will not have like short-term accommodation in every place wherever they are going. For that purpose, they will be buying this caravan. Can they take ITC with respect to caravan purchased? Yes. That is not for transporting persons, it will be others. So ITC can be taken. Moreover, they are registered and they are using it for business purpose. They can take ITC on that. Then motor vehicles which is used for transporting persons, if the capacity does not exceed 13, it's a block credit. If the capacity exceed 13, it's not a block credit, ITC available. What is capacity exceed 13? Stage carriage, contract carriage, that is buses and all. What is the intention behind giving this motor vehicle? If you can remember the intention, it is easy for you to remember this. That is basically motor vehicles which is used fully for business purpose they are giving, and which is partly business, partly non-business, etc. and all, like personal purpose and all they can use. That's the reason why they are restricting it. If you see, no one will go in truck, lorry for marriage functions or personal function for shopping, etc. And same way they will not take bus and all also for shopping. So it cannot be used for personal purpose. Purely that can be used for business purpose. That's the reason why they are telling that these are all the cases where ITC is available. Whereas motor vehicle capacity does not exceed 13. While doing the capacity, whether we need to include driver or exclude driver, include driver. Wherever we use the word passengers, there only it will be excluding driver, otherwise it will be including driver. Capacity does not exceed 13, it's a blocked credit. However, 3 exceptions are there. Number 1, further supply. Further supply means, so I am in a car dealer. I am engaged in inward supply of cars and outward supply of cars. I can definitely take ITC because the inward supply of car is used for further supply, and supply also includes renting. I am into business of renting. Can I take ITC on the cars purchased? Yes. Cars is a motor vehicle for transporting persons. Capacity does not exceed 13. So definitely ITC available if it is further supply. Number 2, used in the business of transportation of passengers. Example, Ola, Uber drivers can definitely take ITC with respect to the cars purchase. That driving schools also can take ITC with respect to cars purchase. So only these 3 cases, if the capacity does not exceed 13, ITC will be available. Whereas in case of vessels and aircrafts, you see, so in case of vessels and aircrafts, we have 4 exceptions. Generally, vessels and aircrafts are blocked credits. ITC not available. So these 3 exceptions are there here also. That is further supply, used in the business of transportation of passengers, driving schools, and used for transportation of goods. Used for transportation of goods is the exception where we can take ITC. For example, first flight couriers or Blue Dart courier is purchasing an aircraft for transporting the courier parcel. Can they take ITC with respect to that? Yes, they can take ITC with respect to that. And next, one more case. Suppose if there is a diamond merchant who is purchasing an aeroplane for the purpose of transporting the diamonds, can he take ITC with respect to the aeroplane purchased? Yes, because used for transportation of goods means they need not be in the business of transportation of goods. Whereas in case of transportation of passengers, they should be in the business of transportation of passengers. For example, Reliance purchased aircraft for transporting its director, cannot take ITC on the aircraft purchase because it is not in the business of transportation of passengers. But Indigo Airlines or Air India purchasing an aircraft for use in the business of transportation of passengers can definitely take ITC with respect to that. And others, ITC not available. This is about motor vehicle related block credit. Now, in that, suppose if there are 4 services in relation to motor vehicles, vessels and aircrafts. So what are those 4 services? Repair and maintenance service, insurance services, and servicing, authorized service center services, hiring, renting and leasing of motor vehicles. If the motor vehicle purchase is eligible for ITC, these 4 services also eligible for ITC. If the motor vehicle purchase is not eligible for ITC, then on these 4 services also ITC not available. For example, so if there is a Ola driver who purchased a car and for that car he has taken insurance, can he take ITC on the insurance? Definitely yes, because car purchased by him, capacity does not exceed 13 and it is used in the business of transportation of passengers, therefore they can take ITC with respect to that. Okay, whereas in case where it is servicing. As a motor vehicle purchased is eligible for ITC, so even this insurance also eligible for ITC. Then a chartered accountant purchased a car for use in his profession. Can he take ITC on the car purchase? No, because it is not covered under these three exceptions, so ITC not available. Now the chartered accountant is taking repair and maintenance in relation to car purchase. Can he take ITC on repair expenditure? No. As the motor vehicle purchased is not eligible for ITC, so these four services also not eligible for ITC. Then you can see below, while determining the capacity whether driver should be included or not, yes, it should be including driver. Further supply includes purchase and sale of motor vehicles or motor vehicles used in the business of renting, hiring or leasing. I told you already, further supply need not be only sale, it can be into renting of motor vehicles also. Repairs, insurance and servicing of motor vehicles received by a general insurance company is always eligible for ITC. Say for example, a person purchased a car, and with respect to that car, insurance company will give the insurance, and the car purchased, so he met with an accident, completely the car is damaged. Now in that case, who will bear the expenditure, repair expenditure? Insurance company will bear. Can the insurance company take ITC with respect to the repair expenditure? Yes, but they don't own the car. Even though they don't own the car, definitely they can take ITC with respect to the repair expenditure. You can see that repairs, insurance and servicing of motor vehicle received by a general insurance company is always eligible for ITC. In this regard, they have added one clarification. You can see in the next page, that is whether ITC available to insurance companies on the expenses incurred for repair of motor vehicle. So they are telling, if the invoice is in the name of the insurance company, definitely on that invoice insurance company can take ITC. But if the invoice is in the name of the insured, the insurance company cannot take ITC. And moreover, here there will be something called as reimbursement mode of claim. Reimbursement mode of claim means, for example, if I am the insured, first I will make the payment to the repair, garage or workshop, etc. I will make the payment, and thereafter I will get reimbursement from the insurance company. In that case, the invoice is in the name of the insurance company. Can the insurance company take ITC? Yes, they can take ITC, but there is one point, 180 days condition. The payment has to be made within 180 days from the date of invoice. Won't that restriction be applicable to insurance company? No, because they have made payment to the insured. So due to that reason, that 180 days condition is not applicable to the insurance company. They can take ITC. That is this reimbursement mode of claim settlement. Insurance company can avail ITC even though expenses initially incurred by insured. However, invoice for repair should be in the name of the insurance company. Then next one, suppose if repair cost is beyond approved claims, say 10 lakhs is the total repair cost. In the 10 lakhs, 2 lakhs is borne by insured, 8 lakhs is borne by insurance company. Then insurance company can take ITC only to the extent of 8 lakhs. Even though full invoice is the name of the insurance company, but to whatever extent they are reimbursing, to that extent only they can take ITC. So for example, 10 lakhs into 18%, 1,80,000, but they cannot take. So 8 lakhs into 18%, to that proportion only they can take ITC. Then what if invoice is in the name of the insured? If the invoice is in the name of the insured, so insurance company cannot take ITC. Whether insured can take ITC depends upon the motor vehicle. If the motor vehicle purchased is eligible for ITC, the insurance charges paid is also eligible for ITC. This one, insurance. So if the motor vehicle is eligible for ITC, insurance is eligible for ITC. If the motor vehicle purchased is not eligible for ITC, insurance also ITC not available. So ITC not available to insurance company as conditions are not satisfied, but insured it depends upon the motor vehicle. Got it? Then related to this, I gave one question. You can have a look into this. Question number 20. ABC Insurance Limited provides general insurance services for motor vehicles. A customer, Mr. Sharma, has a policy with ABC Insurance. His car was damaged and he chose a non-network garage for repairs, including a total repair cost of 1 lakh. The insurance policy approved a claim of 80,000, which ABC Insurance later reimbursed to Mr. Sharma. Now, scenario number 1, the garage issued 2 separate invoices, one for 80,000 to ABC Insurance and another 20,000 to Mr. Sharma. What is your answer? Determine the extent of ITC available to ABC Insurance Limited in scenario 1 and explain the condition under which ITC can be claimed. What is your answer? As the invoice is in the name of insurance company, they can take ITC with respect to 80,000 only. So 80,000 only they can take ITC. Then next, scenario number 2. the garage issued a single invoice for rupees 1 lakh to ABC Insurance, but ABC Insurance only reimbursed 80,000 to Mr. Sharma, even though the invoice is for 1 lakh, but they can take ITC only to the proportionate of 80,000. Okay. Then scenario number 3, the garage issued an invoice for 1 lakh directly to Mr. Sharma, who later got reimbursed 80,000 from ABC Insurance. Now ABC Insurance cannot take ITC because the invoice is in the name of insured. Now again from the beginning, so first case, Sharma has 20,000 invoice. Can he take ITC? No, depends. He is an individual. Basically, he is an individual. So when he buy a motor vehicle, he cannot take ITC. As he cannot take ITC on motor vehicle purchase, so he cannot take ITC on the 20,000. Second case, the question will not arise because the invoice is not in the name of Mr. Sharma. But third case, entire 1 lakh invoice in the name of Mr. Sharma, can he take ITC? No, because the motor vehicle purchased is not eligible for ITC, so he cannot take ITC with respect to that 1 lakh also. Is it clear? Insurance company definitely cannot take ITC because invoice is not in the name of insurance company. That is the answer for these 3 questions. Explain how the provisions of section 16(2) apply to these scenarios and the implication for claiming ITC. That is, in these scenarios, the payment is not made to the garage, but the payment is made to Mr. Sharma by the insurance company. Even the insurance company is not making payment to garage, but they can take ITC wherever possible. That 180 days condition is not applicable in that case. You read the answer. Even if payment is not made by Insurance Limited to garage, ABC Insurance Limited to garage, they can avail ITC, and the provision of section 16(2), that is payment to supplier within 180 days condition, is not applicable in this case. So that is about this. Then one more clarification that is related to availment of ITC on demo vehicles. On demo vehicles, can they take ITC? Definitely on demo vehicles they can take ITC, because even though the demo vehicles are not for further supply, lot of two-wheeler, four-wheeler dealers, if you see, they will be purchasing the cars, and those cars they will be keeping it in their showroom for the purpose of giving a, like test drives. So in that case, can they take ITC on those test drive vehicles? So if you see the provision, so first they are purchasing car used for transporting persons, capacity does not exceed 13. So is it covered under further supply? No, it is not covered under further supply. It is not used in the business of transportation of passengers, not for driving skills, then ITC not available. But the CBSE has clarified that even though it is not in further supply, but it assists in further supply, because this particular car is used for the purpose of making the sale of other cars. Moreover, this demo car also will be sold in future when a new model is launched. When a new model of that particular vehicle is launched, so we will be selling the old model. So due to that reason, ITC should definitely be given on the demo cars. That is, ITC available on demo vehicles if they are used for promoting further supply of vehicles. And if demo vehicles are capitalized, ITC is available. Why demo vehicles are capitalized? Won't it be coming under stock in trade? No, it will not come under stock in trade. So the remaining cars will come under stock in trade. So on that depreciation we will not claim. For your information, section 32 depreciation we will not claim on stock in trade. You know that na? Super. Then only on those assets which are capitalized, which means on stock in trade we will not claim. So the question of capitalization will come only on the demo car only. So if the demo vehicle is purchased, ITC is available unless depreciation under 32 is claimed on the tax component. So unless it is claimed on tax component, so that what is it they are telling? So unless depreciation, that is if demo vehicles are capitalized, ITC is available unless depreciation under section 32 is not claimed on tax component. Sorry. So ITC is available. ITC available. Okay. Unless, sorry, correct only. No, I said correct only. So unless depreciation is computed on tax component, correct only what I said. No need to correct it. So that is, if I have added the GST component and I claim the depreciation, then I will not get ITC. That's a usual point. Also, on sale of such capitalized demo vehicles, GST is payable in terms of 18(6). So why 18(6) will come? First I am purchasing the demo car, and that demo car GST paid I have capitalized I mean GST paid I have taken as ITC, and it is a capital goods on which ITC availed. When we are disposing of, we need to pay GST in terms of 18.6 that ITC availed minus 5% etc., or sale value, whichever is higher. If demo vehicles are used for non-business purpose means what? I have seen some dealers, what they will do, demo cars and all they will get, and these demo cars they will use for their personal purpose. Rather than giving it to the people for test drive, they will use it for their personal purpose, okay? And in that case, can they take ITC with respect to that? No. But how department will know all these things? If the demo vehicles are used for non-business purpose, they cannot take ITC, they are telling, or as a part of marketing services for the manufacturer. What is this marketing service for the manufacturer? If you see big malls and all, so even Phoenix Mall, like that one mall is there in Chennai. If you have been to that mall, so completely some 6 to 7 cars are there in the ground floor. Even airport also, if you see one car, they have kept as a display. So a lot of shopping complexes or shopping malls, they are keeping the cars for display. With respect to the cars kept for display, can we use it as a trial run? Say for example, that shopping mall, one car is there. Can I take a test drive there? Give me, sir, like Beast movie, I will go on a round and come. They will not give, correct or not? So therefore it is not for a test drive, and due to that reason ITC not available with respect to that car. As a part of marketing service for the manufacturer, ITC is blocked. Now related to that, I have given one question. You can see that it is question number 18. Question number 18, you can see ABC Motors, an authorized dealer for motor vehicle, purchases 5 demo vehicles from XYZ Auto Limited, a manufacturer, on October 1, 2024. These demo vehicles are used for test drives and to showcase features to potential buyers. Each vehicle has a value of 10 lakhs excluding taxes, and ABC Motors receive a tax invoice for the purchase, which includes the following: IGST on demo vehicles 1,80,000 per vehicle. So total purchase cost is 10 lakh plus 1,80,000, 11,80,000. ABC Motors plans to capitalize these vehicles in its books of accounts at rupees 10 lakh per vehicle and intends to use them for test drives for a period of 2 years before selling them as used vehicles at a written down value. After 2 years of usage, ABC Motors sells one demo vehicle for rupees 5 lakhs and IGST on the sale is applicable at 18%. Question number 1. Determine whether ABC Motors can claim input tax credit on the purchase of these demo vehicles if yes, compute the ITC avail. As per CBIC circular, demo vehicles which are purchased and used for trials will be coming under used for further supply, because as they assist in further supply, ITC is available. So in the present case, ITC will be 1,80,000 into how many vehicles purchased? 5 vehicles purchased. So 9 lakhs will be taken as the ITC. Then 2. What will be your answer? If the motor vehicles are capitalized in its books at 11,80,000 per vehicle. If it is capitalized in books for 11,80,000 per vehicle, then in that case, ITC available or not available? Not available. ITC not available. So therefore depreciation can be claimed under section 32 of Income Tax Act on that 1,80,000 component. Calculate the GST payable at the time of sale of demo vehicles. Suppose if ITC is availed on that, how the GST will be payable? So 18 subsection 6. So please see what is the ITC availed. 1,80,000. Only one car is sold na. 1,80,000 minus what is the number of quarters for which it has been used? 8 quarters. After 2 years they are selling. Please observe the question carefully. After 2 years they are selling. 2 years means 8 quarters. So 8 into 5, 40%. So 1,80,000 minus 40%, that will be 1,08,000. Or what is the sale price at which this vehicle is sold? So that is 5 lakhs. So 5 lakhs into 18%, that will be 90,000. Whichever is higher, which is higher, 1,08,000 will be taken. And can the buyer of such demo car can avail ITC? Of course, yes. They can avail ITC if eligible, because basically all these demo vehicles are purchased by travel agencies. because for travel agencies, they don't mind whether it is a used one or new one, etc. and all. They will buy because it will be available at a very cheap rate. So they will be purchasing it, and they are in the business of transportation of passengers. So definitely they can take ITC. So buyer of such demo car, if eligible, can avail ITC with respect to this 1,08,000. Now same question if they give, what if they have computed depreciation on the tax component? What if they have computed depreciation on the tax component? Then what is your answer when they are selling this demo vehicle? First, ITC not available, that's okay, but what will be taken as the value on which GST will be payable? You understood my question first? I am telling you, listen to the question first properly. They have purchased the demo car, 10 lakhs plus 1,80,000, 11,80,000. They purchased it, and they have capitalized the entire 11,80,000, and they claimed the depreciation also under section 32. Got it? Now they are selling the demo car as usual after 2 years. Then what should be taken as the value on which GST is payable? 5 lakhs into 18%. Wrong answer. WDV. Margin scheme is applicable. Notification 8 of 2018, which you have written. I made you write for this purpose only. Notification 8 2018 says, whenever motor vehicles, open your book and see. So you have written value of supply while discussing rule 32, sub rule 5. There I told you, notification 8 of 2018. Margin scheme is applicable. What is that margin scheme? Sale price minus depreciable value. How to compute the depreciable value? As if this is the only motor vehicle in the block, we need to compute the WDV. So, and ITC should not be availed, and here we are not availing ITC. So you count the depreciation, and I asked you also, what is the depreciation rate like that in income tax? You said 15%. Okay. So 11,80,000 minus 15% for the first year and minus 15% for the second year. Okay, but directly we cannot take na sir, because it is purchased on October 1, 2024. October 1, 2024 it is purchased means, is it put to use for more than 180 days? Yes. So we can take that full year 15%, and next year, that is next year 2025-26. So there also we can use, yes, because see here, date of purchase is October 1, 2024 to date of sale. Date of sale is October 1, 2026. So now in this case, first for 2024-25, for 24-25 you will claim 15%. Then again for 25-26 you will claim 15%, but thereafter few months are there na in 2026, for that proportionately 15%, no, that like that block of assets method and all is not there, only 15% we need to reduce. So therefore how much will be taken? 11,80,000 minus 15%, so minus 15%, that is 8,52,550, that will be taken as the WDV, and the sale price is 5 lakhs, margin is negative, so GST not payable. Is it clear? Sale price minus depreciable value, sale price will be 5 lakhs and depreciable value will be 8,52,550. So as the sale price is less than the depreciable value, we don't have to pay any GST on that. If at all ITC has not been taken and we have capitalized at full value. Is it clear? So they can connect this with notification 8 of 2018. So if they are nut and crack and all, they will ask. Next, look into the second area, because I asked that in my mock test. Okay, in my test series. So I have framed a question like that and I have asked. So really, if you want to know how the question paper could be, to what extent they can torture, just see the question papers which I have prepared for May 25 exam, so you will know. Then construction related blocked credit. Construction related block credit, that is any service works contract service or goods. These are the three inward supply. Purchased or received in relation to construction of an immovable property. ITC available or not available on those inward supplies. ITC not available on those inward supplies. What are the three inward supplies? Any service received, any goods purchased or works contract in relation to construction of an immovable property. ITC not available. And in this case, what is the meaning of works contract? Works contract means transfer of property in goods as well as provision of services for a single consideration. But there are three exceptions where we can take ITC on these three inward supplies. Exception number 1, the restriction is only to the owner of the property. The restriction is not applicable to the supplier, that is a builder. A builder who is receiving works contract service or a builder who is receiving any service for construction of immovable property for his client, or if the builder is purchasing any material for construction of immovable property for his client, definitely he can take ITC. But only the owner of the property cannot claim ITC, that is exception number 1. The above discussion is not applicable to supplier, that is if a works contractor receives construction service for construction of an immovable property, then ITC can be availed on construction services. Number 2, construction of plant and machinery, even though immovable, so they can take ITC provided it is a plant and machinery, but the plant and machinery excludes telecommunication towers and pipelines laid outside factory gate. For telecommunication towers or pipelines laid outside factory gate, even though it is plant and machinery, but for the definition of plant and machinery it is excluded. So due to that reason ITC not available for that. For example, construction of lifts, escalators, etc. If they receive any construction service, can they take ITC? Yes, because that is plant and machinery. Next, third exception, if the construction expenditure is charged to P&L, then also ITC cannot be availed on these inward supplies. And suppose if it is capitalized, ITC cannot be availed. If it is charged to P&L, then ITC can be availed. For example, if I am incurring some repair and renovation expenditure, that repair and renovation expenditure will definitely be charged to P&L. So can I take ITC on the construction expenditure? Yes. These are the three exceptions. Even though in the first exception, the builder can take ITC, but in turn that depends upon the rate of GST at which the builder will pay GST on his outward supplies. If the builder is paying GST on his outward supplies at 1.5% or 7.5%, that is real estate, residential real estate projects, they will be paying GST at 1.5 or 7.5, that is without ITC. They cannot take ITC on inward supplies. ITC not available, even though such inward supplies are not blocked ITC. Whereas if their outward supply is commercial projects, for commercial project the rate of GST is 12% or 18% with ITC, so they can take ITC. ITC available on inward supplies other than blocked credit under 17(5). In this regard, there is one amendment, that is usually telecom towers, what they will do, they will be installing these manholes and ducts for the purpose of laying down optical fiber lines. So they will dig and they will create a manhole, and inside that they will be putting one pipeline for the purpose of providing the optical fiber for all our internet, etc. and all today we are using so that broadband connections. So below the earth they are providing the optical fiber lines. For that purpose they are receiving this construction expenditure. So can they take ITC with respect to this construction expenditure for the purpose of ducts and pipelines or manholes, etc.? Yes, they can take ITC, because logically if you see, only telecommunication towers and pipelines laid outside the factory gate. First of all, it is not telecommunication towers, it is not pipeline laid outside factory gate, that is only for manufacturer. But for a telecom operator, definitely they can take ITC with respect to this. We don't have any restriction. You can see here whether ITC available on ducts and manholes used in network of optical fiber cables. Ducts and manholes which are integral part of optical fiber cables qualify as plant and machinery and can avail ITC on the same, even though used by the telecom companies, as only telecommunication towers are excluded from the meaning of plant and machinery. Even they do not fall under pipeline laid outside the factory gate. Then you can see this example related to that. Question number 22, XYZ Telecom Limited is engaged in providing telecommunication towers and is expanding its network by laying new optical fiber cables across various regions. The OFCs are housed within PVC ducts and service or connectivity manholes are installed as nodes in the network to facilitate maintenance and connectivity. The company has incurred significant expenses on purchasing these ducts and manholes. As they incurred significant expenses, definitely they will capitalize it. you are required to determine whether XYZ Telecom Limited can claim ITC on the purchase of ducts and manholes used in OFC network. So yes, as these are huge cost, they are capitalized in the books and they will fall under capital goods. Also it will come under plant and machinery other than telecommunication towers and pipeline laid outside factory. So therefore ITC available on this. Explain the rationale behind eligibility of ITC on these items referring to the relevant sections. The rationale for availment of ITC on all these things will be same. If something is not there in the block credit and it is used in the course or furtherance of business, we can definitely take ITC. So as the same is not covered under blocked ITC due to exceptions and it is used in the course or furtherance of business of telecom, they can avail ITC. Discuss whether there are any specific restrictions under 17.5 that would prevent XYZ Telecom from claiming ITC on these purchases. Yes, suppose if these parts are used for telecom towers, then they cannot take ITC with respect to that. Analyze the impact on XYZ Telecom Limited GST liability if these components were instead classified as excluded items under the definition of plant and machinery. If it is excluded from the definition of plant and machinery, then they cannot take ITC with respect to that. So that's how they can connect this particular circular. Then next, look into some special points. Only hiring, renting and leasing of motor vehicles is blocked ITC. However, leasing of any other items is not blocked ITC. For example, a company is taking immobile property on rent and on that rent they paid GST. Can they take ITC with respect to that? Yes. But immobile property constructed is blocked credit. Immobile property constructed is block credit, but renting is block credit, like that nowhere it is given. Only motor vehicles they have used the word. Hiring, renting and leasing of motor vehicle is block credit, that is specifically given. Hiring, renting and leasing of motor vehicles. That too, if the motor vehicle is eligible for ITC, they can take ITC with respect to hiring, renting and leasing. Then next, second point, works contract service confined only to immobile property. So whenever we are using the word works contract service, that is only in relation to immobile property. Then ITC available on construction of pipelines inside the factory. Then ITC available on rails. So because rails are not coming under motor vehicles, so on rails. So companies will be purchasing rail. So on that rail, mainly for the purpose of manufactured goods taken to the railway station, they will lay down a pipe, like they will lay down a network, rail network, and they will also purchase the wagons for the purpose of transporting the manufactured goods by them. Definitely on rails purchase they can take ITC, and 2 or 3 wheels with capacity up to 25 cc also ITC available. Why like that? Because 2 or 3 wheels with capacity up to 25 cc will not be considered as motor vehicles, and also I have not seen any such motor vehicles which is up to 25 cc. So on basic, any motor vehicle you take, it starts with somewhere 100 cc nowadays. So less than 25 cc means a cycle which is fitted with a motor may be coming under that category. Why will that be purchased? If they purchase, they can take ITC because that is not a motor vehicle. Next you can see other blocked credits. Other block credits, and there is one query, sir, whether ITC available for works contract service incurred and it is provided for rental. So that is one Supreme Court case here, and which is not there for exam. So don't worry. So there is one case which says that, so there is a company which is into renting of immobile property. As they are into renting safari retreats, okay, safari retreats case, if you search in Google you will get it, safari retreats case, and where they are into business of renting of resorts, and they have purchased, like they have received works contract services, whether they can take ITC with respect to that. So it went up to Supreme Court, and the Supreme Court is telling yes, they can take ITC with respect to that, like that. But on that, recently they have made an amendment in Finance Act to nullify that Supreme Court judgment. But this will not be applicable for your exam, so don't worry. Suppose, sir, if at all we get, what should we write? Write that ITC is available, okay? Write ITC available, because the restriction is only to the owner of the property, but here plant or machinery, so it will be coming under plant. So due to that reason they can take ITC, like that. There is one Supreme Court case, but actually it will not be tested, trust me, it will not be tested in exam, okay? Then, so only thing, this guy too much he is learning GST, so that's why he has come to know. Then inward supply, look into other blocked credits. Membership of a club, health and fitness center. Membership of a club, health and fitness center is a blocked credit, even though it is for business purpose. For example, a chartered accountant takes membership of a Rotary Club or a Lion Club for the purpose of expanding his clientele. He cannot take ITC because it's a block credit. However, if it is under a statutory obligation incurred by employer to employee, they can take ITC. Example, Naval Lignite Corporation has to mandatorily take membership of a health club for the purpose of upkeep of the health of their workers. Then in that case, that membership of a club, can they take ITC? Yes, because it is under a statutory obligation. Then next, travel benefits to employees on vacation. So this employees on vacation is a blocked credit. What if the employees are going on business visit? ITC available. Again, we have an exception here if it is under a statutory obligation by employer to employee. And what if that person is not an employee? For example, a statutory auditor is sent on a vacation by the company for which the company has incurred the travel expenditure. Can they take ITC? Yes, because statutory auditor is not an employee of the company. Then non-resident taxable person, who is NRTP, a person who is coming from outside India to India in order to provide services or supply goods in India, is known as NRTP, and they are required to get a registration, but they cannot take ITC on any inward supplies. Only on one inward supply they can take ITC, that is on import of goods. So now that IPL season has started, so now lot of foreign players will be coming to India for the purpose of playing in IPL matches. They are called as non-resident taxable persons because they don't have any physical place of business in India, and they will be engaged in supply of services, and they need to register and pay GST. And as they will be coming here and playing here, so they will be bringing their entire equipment, okay, the bat, etc. and all, they will be bringing in a cargo container. So that cargo container IGST will be paid. Can the IGST paid be taken as ITC? Yes, only that can be taken. And they will be receiving lot of inward supplies in India like hotel accommodation, food, etc. and all. Can they take ITC with respect to that? No. Then food and beverages. So food, beauty, insurance. Too much food if you eat, then health will be spoiled. So beauty treatment required, and insurance. You understood? Food, beauty, insurance. Okay. So food and beverages, outdoor catering. Beauty treatment, then cosmetic surgery, plastic surgery, hair transplantation. Then insurance. What insurance? Life insurance and health insurance. Okay. These three are blocked credits. Food, beauty, insurance. However, we have three exceptions. Exception number one, inward supply, outward supply in the same category. So I am into the business of food and beverages. I purchase food and beverages. Definitely I can take ITC because my outward supply also food and beverages, inward supply also food and beverages. Number two, exception number two, if inward supply is part or component of the composite or mixed outward supply. I am into the business of transportation of passengers, and I wanted to provide food and beverages to my passengers, and I purchase food and beverages. Definitely I can take ITC because my inward supply is part or component of the outward supply. Then third, provided by employer to employee under a statutory obligation. For example, if there is a factory which is mandatorily required to provide food to their workers who are working in the factory, for that purpose they received outdoor catering services. Can they take ITC? Yes, because it is under a statutory obligation. Then if I am purchasing from a person opting for composition scheme, I cannot take ITC. If I am purchasing any goods for personal consumption, I cannot take ITC. If I am purchasing any goods for the purpose of CSR obligation under Companies Act, I cannot take ITC. If the goods are lost, stolen, destroyed or written off or disposed of by way of gifts or free samples, ITC not available. Purchased goods lost in floods or lost in earthquake or lost in fire accident or destroyed, someone has stolen it, or it has become obsolete, so I have written off, or it has been distributed as gifts or free samples, I cannot take ITC. What if that distribution of gifts or free samples constitutes supply under 7(1)(c), then definitely ITC will be available. For example, there is an employer who is purchasing a smartphone. The value of the smartphone is 80,000 rupees plus GST. Now that smartphone is given by employer as gift to the employee. As the value of the gift exceeds 50,000 rupees, it will become supply under 7(1)(c). As it becomes supply under 7(1)(c) on the smartphone purchase, they can take ITC. What if the employer gives a normal smartphone which is of some 30,000 rupees plus GST? As the value of the gift does not exceed 50,000, it is not a supply. So on that 30,000, whatever GST is paid, the employer cannot take ITC. So if the gifts or free samples constitute supply under 7(1)(c), then ITC is not required to be reversed on the inward supplies. Also, GST paid under 74, 129 or 130 or any other recovery proceedings, such GST paid cannot be availed as ITC. That is, I have not voluntarily paid GST, but through 74 it has been recovered from me, or through 130 it has been recovered from me. Now in that case, can you take ITC? First of all, when I am not voluntarily paying, why will I report it in GSTR1? So I will not report in GSTR1. Consequently, it will not come in 2B. If it is not coming in 2B, you cannot take ITC with respect to that. And moreover, if I report it in GSTR1, these sections will not come. So these sections will come only if I am not reporting in GSTR1, correct or not? So therefore, it is irrelevant. That's why they have removed it for November 25 exam. So for May 25 exam also it will not be questioned, don't worry. Whether ITC available on goods purchased for free replacement during warranty period. So any goods which are purchased for free replacement during warranty period. So you need to understand here two aspects. Point number one, that is you are purchasing a car, and in that car purchase which is covered under a standard warranty. So there is a sensor which is not working in the car. The parking sensor is not working in the car. Now what you will do, say after 6 months of purchase of the car, as the parking sensor is not working, you will bring it to the service center, and I am the dealer. And what I need to do, I need to replace the parking sensor, and for replacement of this parking sensor, I will buy the part from the market. Can I take ITC on the part purchase? Yes. Even though I am not going to charge anything to you, I am going to give it for free, I can take ITC on this part purchase. And as I take the ITC and I gave it to you, will the 71C disposal of business asset on which ITC availed will come into picture? Actually speaking, it is a business asset on which ITC is availed and it is disposed of. So definitely permanent transfer disposal of business asset on which ITC availed will come, but the circular clarified that they can take ITC. Point number one. Point number two, no need to treat it as supply under 71C, disposal of business asset on which ITC is availed. What if they are collecting some consideration? Of course, that consideration whatever is collected, that will become supply under 71A and they will pay GST. Then instead of purchasing the part, what if the entire product is replaced? Say for example, I am an electronic shop and you purchased one rechargeable torch, and it was working properly in my shop, and you took it to your home and you kept it for charge, and thereafter it is not working. So again you will come to my shop and get the another one as a replacement. Now that replaced one also I am buying na, can I take ITC on that? Yes. Whether it is a part or the entire product, I can definitely take ITC with respect to that. And I am giving it to you. When I am giving it to you, so will it come under 71C? Again no, it will not become supply under 71C, and don't invoke disposal of business asset on which ITC is availed. You can see here whether a part, that sensor example, or entire product, so that rechargeable torch example is replaced during warranty, ITC can be availed on goods purchased for warranty irrespective of whether any consideration is charged or not with respect to such warranty repairs. Then next, where the distributor uses his stock for replacement, manufacturer replenishes the stock on which manufacturer can avail ITC. Some cases what will happen, so let's go back to that sensor example. In that sensor example, I will have in my stock some 50 sensors. So out of that 50 sensor, I will take one and I will replace. Means I am not purchasing this, and this sensor will be refilled, that is replenished by the manufacturer. For that manufacturer will buy. Can he take ITC? Yes. Even though I do the replacement under warranty, but he purchase it, he also can take ITC with respect to that. And when he is replenishing, he is sending it from his place to my place. Whether it will become supply? No, it will not become supply. Then that movement will be under the cover of a delivery challan. When distributor uses his stock for replacement, manufacturer replenishes the stock on which manufacturer can avail ITC. Then amount paid for extended warranty. So the first 2 points are related to replacement during warranty. The next 2 points they have given in relation to the additional charges collected for extended warranty. Sometimes what will happen, so usually electronic goods and all will come under a standard warranty. During that standard warranty, nothing will happen, everything will be working fine, and thereafter only the product will show its true colors. Okay, so for example, OnePlus phone and all, so suddenly one green line will come, or in Xiaomi TV and all, so TV will become green all of a sudden. Okay, so I purchased one TV, 1 year it was working, exactly warranty got over 2 weeks before. Now TV green color only. I doubted whether my eye gone or what, and thereafter So when I am asking, sorry sir, your product is not covered under warranty, like that they are telling, you should have taken additional warranty, you replace the TV. So they are telling, so I have to lose that. So that is why lot of people will pay extra amount for that additional warranty. What is the treatment of these extra charges for additional warranty? Whether it is paid at the time of purchase from the same dealer, same time, same dealer, it is treated as a composite supply. Treated as a composite supply. It is not a composite supply. It's not a composite supply, but it is treated as a composite supply, and the rate of GST applicable to that article will be applicable to that warranty also. In case of TV, never buy the warranty like that, because the rate of GST applicable on TV will be 28% and usually warranty rate will be 18%. If you buy the warranty at the time of purchasing the TV, on that warranty they will levy 28%. Is that clear? Whereas if you buy separately at the same time, if you buy from a separate person, or if you buy from the same person at a separate time, or different person at a different time, in all other three cases, same dealer, same time, that is composite supply. Same dealer, another time, that is separate, okay, different time. Same dealer, different time. Then same time, different dealer, different time, different dealer. In all these three cases, the warranty will be treated like independent supply. If the amount paid for extended warranty after purchase of goods, then it is treated as different supply, whether purchased from the same supplier or from a different supplier. You can see one question based on this. Question number 19. Question number 19. Samsung Electronics sells a smartphone to a customer with a 1-year manufacturer warranty. During the warranty period, the customer experiences a defect and visits an authorized distributor who replaces the defective smartphone with a new one from their own stock. Samsung later replenishes the distributor stock without charging any additional amount. Additionally, at the time of purchase, a customer buys an extended 2-year warranty from a third-party service provider, Warranty Plus, which begins after the manufacturer's 1-year warranty expires. You are required to determine the GST liability for Samsung on the replacement of defective smartphone under manufacturer warranty. So dealer is replacing, and for replacing out of his stock, whether he need to reverse any ITC? No, he don't have to reverse any ITC. Moreover, whether he need to treat it as supply under 71C? No. So see the answer for the first part. As per CBIC circular, when a dealer replaces a part or whole goods, GST not payable even though it is without consideration, as GST is already paid for the defective parts or goods. Also, dealer not required to reverse any ITC. Second part of the question you see, explain the GST implication for Samsung when it replenishes the distributor stock with a new smartphone. When he replaces with a new smartphone, what is the treatment in that case? Replenishment. Who? Manufacturer. So whether the manufacturer replenishing, can manufacturer take ITC? Yes. And manufacturer sending it to the dealer, that will not be treated as supply, and that will be under the cover of a delivery challan. As per CBIC circular, when manufacturer replenishes defective goods, that is smartphone, to the dealer, GST not payable by manufacturer. Also such manufacturer not required to reverse any ITC. Third part, discuss the GST treatment for the extended warranty provided by Warranty Plus. Warranty Plus, same person or different person? Different person. Warranty Plus is different person, considering it was purchased at the time of original sale but from a different supplier. It will be treated as independent supply, and GST payable at the rate applicable to warranty, that will be 18%. If extended warranty charges is paid to different supplier at the time of purchase of product, or at a later time it is treated as separate supply and chargeable to GST at the rate applicable to extended warranty services. Analyze how the GST liability would change if the extended warranty was purchased from Samsung directly at the time of original purchase. Then it will be treated as composite supply. From the same supplier at the same time of purchase, it is a part of composite supply, and GST payable at the rate applicable to the principal supply. What is the principal supply here? That smartphone. Whatever is the rate applicable to smartphone, that will be applicable even on the warranty charges also. Then look into the next one, input tax credit in special cases, section 18. As per section 18, subsection 1, we can avail ITC on closing stock. So in 4 situations we can avail ITC on closing stock. 18(1)(a). So a person is liable to get registered and he makes application for registration within 30 days. Say for example, a person crosses his threshold limit for registration on 1st of January, and within 30 days from 1st of January he need to make application for registration. In that case, before 1st of January, that is 31st December of the previous year, whatever is the closing stock, on that closing stock GST paid can be taken as ITC. What is the meaning of closing stock? Inputs as such held in stock, inputs in the form of WIP held in stock, inputs in the form of FG held in stock, and this person at that time purchase, he was not a registered person, so therefore a matching is not required. So naturally it will not be reflecting in 2B, because at the time when he purchased he was an unregistered person, he would not have given his GSTIN. Consequently, the supplier would not have reported it under B2B, but he would have reported it under B2C. That's why matching is not required. But which date closing stock should be taken? Immediately before the date on which he is liable to get registered. Then 18(1)(b). In case of 18(1)(b), the treatment is same. The situation alone will differ. 18(1)(b), a person voluntarily get registered. So voluntarily he is making application for registration. Now from which date he is liable to pay GST? From the date he gets registered. So therefore from the date when he get registration certificate. So which date closing stock should be taken? Before the date he get the certificate of registration, immediately before the date of registration. Here also matching not required and the entire treatment will be same. Whereas 18(1)(c), 18(1)(c) and 18(1)(d) will be applicable to a registered person. Okay. So 18(1)(c), a registered person migrated from composition scheme to normal scheme. And when a registered person is migrating from composition scheme to normal scheme, during the time when they were under composition scheme, they were not eligible to take ITC on their inward supplies. The moment when they go into normal scheme, they can take ITC on their inward supplies. So before the date of migration, so there will be some closing stock. So that closing stock, GST paid can be taken as ITC. What is that closing stock? Inputs as such held in stock, inputs in WIP held in stock, inputs in FG held in stock. Even on capital goods also they can take ITC. But how much ITC they can take on capital goods? You can see below. On capital goods they can take GST paid minus 5% for every quarter or part thereof, from the date of purchase till the date of migration or conversion. So like usual depreciation 5% we reduce na, like that we can reduce and take ITC. Whether matching is required or not, of course matching is required, because he is a registered person. Even at the time when he was under composition scheme, he was a registered person. So therefore matching is required. Whereas which date closing stock should be taken? Immediately before the date of migration. 18(1)(d). 18(1)(d) is when a person, registered person's outward supply is exempted and it becomes taxable. Registered persons exempted supplies becomes taxable. He also can take ITC on inputs as such held in stock, inputs contained in WIP held in stock, inputs contained in FG held in stock, and even on capital goods also they can take ITC. And same ditto, everything is same for 18(1)(c), 18(1)(d). And which date closing stock should be taken? Immediately before the date of such conversion. Now what is the difference between 18(1)(a)(1)(b) versus 18(1)(c)(1)(d)? In case of 1(a)(1)(b), matching not required, 1(c)(1)(d) matching required. In case of 18(1)(a)(1)(b), 1(a)(1)(b), so whether capital goods can be taken as credit? No, but in 1(c)(1)(d) they can take credit on capital goods, and 1(a)(1)(b) is only for a unregistered person, whereas 1(c)(1)(d) will be applicable to a registered person. Okay. These are the differences. Then all these 4 cases, the time limit should be within 1 year prior. Means all this closing stock whatever we have discussed, this closing stock should have been purchased within 1 year prior to the date of the closing stock. The above closing stock including capital goods should have been purchased within 1 year prior, and that is the invoice date to the closing stock date should be 1 year. And ITC with respect to GST paid on inputs and inputs, like inputs can be availed as ITC, but for capital goods only we need to reduce. For inputs don't reduce. Full whatever GST paid we can take as ITC, but capital goods we need to reduce 5%. And how to take this ITC in 3B? No, not in 3B. We need to file electronic declaration. What is that electronic declaration? ITC 1. It should be filed within 30 days from the date on which you are eligible. In case of 18 year, when are you eligible? Whenever you get the registration certificate. 1B also whenever you get the registration certificate. 1C whenever you are migrating from composition scheme to normal scheme. 1D whenever your exempted supplies becomes taxable. From the date within 30 days, we need to file this ITC 1, and it can be for a extended period, further extended period by commissioner. And this particular declaration, that is ITC 1, should be certified by a CACMA if the claim of ITC exceeds 2 lakhs. If the claim of ITC does not exceed 2 lakhs, self declaration. If the claim of ITC exceeds 2 lakhs, CACMA certificate. Similar provision we have in refunds also. If the refund amount does not exceed 2 lakhs, self declaration. If the refund amount exceeds 2 lakhs, CACMA certification. Same logic. Then transfer of ITC, section 18(3). Whenever I am transferring the business with specific provision for transfer of liabilities, so then in that case, remember the transfer of business should be with transfer of liabilities, means all assets and liabilities should be transferred. Then in that case, whatever is the unutilized ITC in the electronic credit ledger of the transferor will be transferred to the electronic credit ledger of the transferee. So that will be transferred, but remember it should be with specific provision for transfer of liabilities. What is the form that is required for the purpose of transfer of this ITC? ITC 2. Whether that ITC 2 should be certified by CACMA always. Always it should be certified by CACMA that this business is transferred with the specific provision for transfer of liabilities. Then remember, in case of merger there won't be any problem. For example, A Limited and B Limited is getting merged into, A Limited and B Limited is getting merged into AB Limited. Then in that case, A Limited also can transfer ITC, B Limited also can transfer ITC to AB Limited. Now, say for example, AB Limited is getting demerged into A Limited and B Limited. Then in that case, whatever ITC that is there with the AB Limited will be transferred to A Limited and B Limited in what ratio? In the assets ratio. So A Limited and B Limited assets ratio we need to see as on the date of demerger. In that assets ratio the ITC will be transferred. So in case of demerger, credit shall be transferred to the new entities in the ratio of net assets. What is the meaning of net assets? Net assets means total assets minus ITC. Total assets minus ITC. We are transferring ITC only. For that purpose only we need to get. So all assets minus ITC. That is the meaning of this net assets. All assets, total assets minus ITC, that should be taken. And whether ITC is availed or not on that assets, we need to take all the assets. For example, land is also will be there in the assets, building also will be there in the assets, but on land and building we will not take ITC now. So therefore all assets should be taken. And which date the asset should be? As on the date of demerger. As on the date of demerger we need to see the assets ratio. Don't see thereafter, because thereafter individually they might also have purchased the assets. So that should not be taken as the criteria. So we need to see the assets ratio only as on the date of demerger. Then next, in case of transfer or change in ownership of business will include transfer or change in ownership due to death of sole proprietor. Say there is a sole proprietor who is dead and his son has taken over the business. Then in that case, so when the son is taking over the business, he need to get a new registration, because permanent account number is connected to GSTIN. So whenever the person changes, so definitely GSTIN also should change. So the son should get a new registration even though he continues the business, and from father's registration to son registration, ITC can be transferred. In that case, the son only will file ITC 1 in the name of the father, ITC 2 in the name of the father, and the ITC gets transferred. That is this. Then transferor and transferee should be in the same state. For example, I am having a e-commerce business. That e-commerce business is like, and I am from Tamil Nadu. E-commerce business, there is no place of business. It is a website or it is an app. Anywhere to anywhere it can be transferred. So transferor Tamil Nadu, transferee is in Maharashtra. I am transferring this e-commerce business to transferee in Maharashtra. The transfer of business is possible, but the ITC cannot be transferred. So the transferee should also be in the same state. So transferor is in Tamil Nadu. So transferee should also be in Tamil Nadu. Then only the ITC can be transferred. That is this. Then when a single registration is getting converted into multiple registration. So far within the state, I am having single registration for 4 places of business. Now I want to go for separate registration. From single registration, whatever ITC is there, that will go to all the 4 registrations in what ratio? Just like demerger, in the assets ratio. In this case, the form will be ITC 2A, and ITC 2A need not be certified by CACMA. When a single registration gets converted to multiple registrations within the state, then also ITC against a single registration can be distributed to multiple registrations by filing ITC 2A. Assets ratio as on the date of registration should be considered for this purpose. And you can see some special points in this regard. ITC 2 to be certified by CACMA irrespective of the amount of ITC, but ITC 2A is not required to be certified by CACMA. And in case of demerger, balance in ITC as on the date of transfer, very very important. For example, demerger has taken place in July 2024. Demerger has taken place in July 2024, and ITC transfer they are doing it somewhere in October 2024. Okay, now we need to take the assets as on which date. We need to see the assets ratio as on which date. So July 2024, you see assets ratio. You see the assets ratio as on July 2024. But ITC balance as on which date should be seen? July 2024 or October 2024? October 2024. ITC balance you need to see as on October 2024. See there, in case of demerger, balance in ITC as on the date of transfer. When the date of transfer? October 2024. And the ratio of assets on the date of demerger. What is the date of demerger? July 2024. Got it? Understood? This point also can be tested in MCQ. Then next we have 18 subsection 4 read with 29 subsection 5, that is reversal of ITC on closing stock. This reversal of ITC on closing stock is opposite of 18.1D and 18.1C. 18.1C is what? Composition scheme to normal scheme. Now reverse, normal scheme to composition scheme. 18.1D, exempted supplies to taxable. Now opposite, taxable supplies to exempted supplies. One more case also, section 29 subsection 5, cancellation of registration. In all these three cases, we will reverse the ITC on closing stock. There we avail the ITC on closing stock. Here we will reverse the ITC on closing stock. What is the ITC on closing stock? Inputs as such held in stock, inputs in WIP held in stock, inputs in FG held in stock. Whatever ITC we have availed, that much we need to reverse. Whereas capital goods also we need to reverse. How much credit we need to reverse with respect to capital goods? ITC availed on that capital goods, and the life of the capital goods should be taken as 60 months, and see the balance life of that capital goods. To that extent we need to do the reverse. So ITC availed divided by 60 months into balance life. This much is the ITC we need to reverse. Now concentrate. There is one question one student has asked me in the morning, that is, sir, I am reversing this ITC. Will I have to pay this literally? No. You have some balance in ITC. See, whenever you are migrating into composition scheme, you were under normal scheme means some ITC balance will be there. And whenever you are going into, like exempted supplies, so far you were under taxable means some balance will be there. When your registration is getting cancelled also some balance you are having. Say, like this you need to reverse 1,50,000. But the balance that you have in your ITC is 1 lakh. Then what you will do? 1,50,000 you will adjust from 1 lakh. Remaining 50,000 you will pay out of your pocket. Is it clear or not? Suppose if the 1,50,000 needs to be reversed, but you have a balance of 1,75,000. So from 1,75,000, this 1,50,000 will be adjusted. So balance 25,000 will be lapsed. Okay, that is the meaning of this. So inputs and capital goods can be purchased any time. While availing the ITC on closing stock, they brought in a time limit of 1 year. Means within 1 year prior it should have been purchased, because availing ITC is lost to government. So that's why 1 year time limit. While reversing the ITC, even if you purchase 3 years before or 4 years before also reverse, it's okay, reverse. So because reversal of ITC is gain to them, so no time limit, you reverse. Inputs and capital goods can be purchased any time on which ITC availed. If ITC not availed, then you don't have to reverse. On such inputs and capital goods, then reversal shall not arise. If capital goods are purchased before 5 years, then already the life has been over. Original the ITC availed divided by 60 months into balance life. Beyond 5 years means 5 into 12, 60 months over. So therefore there won't be anything to be reversed. Then what if invoice is missing, and in case of 18.1C1D matching is required, correct? So matching is required, then only we can take ITC. But in this 18 subsection 4, no matching. If you have the asset, you reverse. If you have the asset, that is if you have the closing stock, if you have the capital goods, you need to reverse. Sir, I don't know the invoice. Ayyo, don't know invoice. Today, whatever is the market value, you take and you reverse. Okay. If invoice pertaining to such inputs is not available, then market value you need to take. Sir, I don't know market value. Go to CACMA, they will tell. Can be considered and practicing CRCMA, required to certify in that case. What is the form in which we need to submit reversal of ITC? ITC 3. ITC 1 for availment of ITC on closing stock, ITC 2 transfer of ITC in case of transfer of business, ITC 2A single registration getting separated into multiple registration, ITC 3 reversal of ITC on closing stock. If there is any balance in ITC after reversal, that shall be lapsed. If there is any shortfall for reversal, then such shortfall shall be payable using cash ledger, and we need to do this computation separately for CGST, SGST and IGST. Then next one, GST payable under 18(6), already we know how to compute. But in this, there is one special point, that is, if there are refractory bricks. Refractory bricks are used for the purpose of construction of commercial kilns where we heat the raw material. That refractory bricks, molds and dies, jigs and fixtures, if these three are sold as scrap, don't compare ARB whichever is higher, just take the sale value of this scrap into GST rate. So generally for capital goods on which ITC avail, we need to take ARB whichever is highest, but in this case of refractory bricks, molds and dies, jigs and fixtures sold as scrap, then normal GST payable on sale value. Then next, section 19 read with section 143 of CGST Act. This is related to job work provisions. So in case of job work, what will happen? So there will be a principal manufacturer and who is a registered person. He is purchasing some inputs and capital goods. Just look into the chart, that is sufficient. So there is a principal manufacturer who is purchasing some inputs and capital goods, and at the time of purchase of these inputs and capital goods, the principal will take the ITC with respect to that, and the principal manufacturer is sending the inputs and capital goods for job work to the job worker. When he is sending the inputs and capital goods to the job work, whether the principal manufacturer is required to reverse any ITC? No, they are not required to reverse any ITC, and they will be just sending it to the job worker. And what is the implication on job worker? So job worker, when they receive it, they need to convert into processed goods, and within 1 year they need to send back the processed goods. What is the time limit? 1 year, and this 1 year can be extended for a further period of 1 year, and it will be returned to the principal. In case of capital goods, what is the time period within which it should be returned to the principal? 3 years, and it can be extended for a further period of 2 years. So processed goods 1 year plus 1 year, capital goods 3 years plus 2 years. If the job worker is not returning within 1 year plus 1 year or 3 years plus 2 years, what will happen? Then it will be deemed as supplied by principal to the job worker. On which date? On the date it is dispatched to job worker. If inputs and capital goods not received within the time limit, deemed as supply under section 19, on which day? On the date of dispatch to the job worker. It is like after that 1 year or after that 3 years or after the time limit. So the principal will come to know that the supply has happened long back. It is like, so CA final exam you are going to write. Now you got to admit card for intermediate. So it is like that. So over, time is over, and they are telling now you should have paid. How much torturous it will be? So means last 1 year, last 2 years, I need to pay the interest. You understood? Mainly for the sake of interest, they created this provision that for the last 1 year, 2 years, I need to pay interest. How much, sir? 18%. Whose father's money? I don't know whose father's money. And that has to be paid on the date of dispatch to job worker. If the goods are directly received from the principal of the supplier of the principal, sometimes what will happen? The principal will not be dispatching it to the job worker. There will be one supplier. There will be one supplier to this principal. From supplier place directly the job worker will receive. Then from the date of receipt of job worker, we need to count that 1 year or 3 years as the case may be. And on the date of receipt by job worker, it is deemed as supply. Say this. If the goods are directly received from the supplier of principal, then the date of receipt by job worker is deemed to be the date of supply. Then this principal should report all these details of goods sent on job work and received from job work in one form. What is that form? ITC 4. And this ITC 4 should be filed on a yearly basis if the aggregate turnover during previous year does not exceed 5 crores. Annually by 25th April of next financial year. If the aggregate turnover during the previous year exceeds 5 crores, half yearly by 25th of the month following every half year. For example, so April to September by 25th of October, October to March by 25th of April. So mainly this is useful for MCQs and theory purpose only. Okay, you need to remember this time limit, and you also should remember what will happen if the goods are not received within the time limit, and you need to remember the time limit for ITC 4. Then look into the next one. Some special points in this regard. Such goods should be sent to job work under the cover of a delivery challan and e-way bill, because it is not a supply, and e-way bill always required irrespective of the value. Two cases I told you, handicrafts and goods sent on job work, always e-way bill is required. Even if the goods are directly received by the job worker, ITC can be availed by principal. Why? Bill to ship to. When the goods are received by job worker, it is deemed that the principal has received the goods, and the principal can take ITC with respect to that. Now, for doing this process, job worker will purchase some goods. Can the job worker take ITC with respect to those goods? Yes. Job worker can avail ITC on the inputs and input services used for job work. If the processed goods or capital goods are returned by the job worker after 1 year or 3 years. Now see what happened, as the goods are not returned within 1 year or 3 years, so principal is treating it as supply and he will pay GST along with interest. Now after 1 year or 3 years, as the case may be, the job worker will return. At that time it is treated as a new sale made by the job worker. Again job worker should pay GST on that. Okay, so they were smoking something writing this provision. So if processed goods or capital goods are returned by job worker after 1 year or 3 years, it is treated as new supply by job worker and chargeable to GST, which can be availed as ITC by principal. If job worker is not registered, the principal should declare the job worker's place as additional place of business of principal. Why? Because the goods, taxable goods are in that place. So that's why principal should show job worker's place as principal's additional place of business. And jurisdictional officer must be intimated about the job work contract. Processed goods may be brought back to principal's place or can be sold directly from job worker's place. That is what. So goods need not be brought back. Even if the goods are directly sold from job worker's place also, it is deemed that the goods are received back within 1 year or 3 years. And this time limit of 3 years and 2 years is there na capital goods. That is not applicable in case of molds and dies, jigs and fixtures and tools. Okay, so here we have molds and dies, jigs and fixtures, refractory bricks. In the place of refractory bricks they have added tools. Then ISD section 20 and section 21. Who is an input service distributor? Input service distributor is a head office which will receive the inward supplies for input services. Remember, only input services. It is not input distributor. It is not capital goods distributor. It is input service distributor. The head office can take ITC only with respect to input services and distribute the credit to the branch offices. And in what ratio they need to distribute the credit. If the inward supply is attributable only to one division, the entire credit will be distributed to that division. If the inward supply is attributable to more than one division, it will be distributed to all the divisions in their turnover ratio, not assets ratio, turnover ratio. Okay, say this. There is a ISD, input service distributor, and they need to get a separate registration, and they need to receive tax invoices for input services, and this ITC they will take and distribute it to their divisions under the same permanent account number. Distribution of ITC of CGST, SGST, UTGST, ISD, IGST by issuing a ISD invoice. I told you this ISD invoice is also one of the tax paid document for the purpose of availment of ITC. And very important point is that, say if the ISD is located somewhere in Tamil Nadu, that is head office is in Tamil Nadu, and there is a branch office which is also located in Tamil Nadu, then in that case CGST distribute as CGST, SGST as SGST, IGST as IGST. Suppose if the branch is located in Karnataka or the branch is located in Maharashtra, then in that case what they will do? So they will distribute CGST, SGST, IGST, everything as IGST only. Okay. So therefore to Tamil Nadu, CGST, then SGST, then IGST, it will be distributed like this. Whereas to Karnataka and to Maharashtra, it will be distributed only as IGST. That point I have given below, you can see. CGST and SGST distribute as CGST, SGST for unit in the same state of ISD, and distributed as IGST if the unit is in the different state than that of ISD. And suppose if the input service is attributable only to one unit, then the ITC is distributed to that unit entirely. If the input service is attributable to 2 or more units, then the ITC is distributed to such 2 or more units in the turnover ratio. If the input service is attributable to all units, then ITC, that is common, like advertisement services, statutory audit services or marketing services, etc., then it's a common service. It will be distributed to all units which are operational based on turnover ratio. Which turnover should be taken? Either you take the turnover of previous year or you take the turnover of the last quarter based on the availability. Then ITC to be distributed on a monthly basis and return to be filed in GSTR 6. So ISD is required to file a return in GSTR 6 by 13th of the month following every month, and that data will be reflected in 2B, 2A, 2B of the divisions. Okay. So then excess distributed ITC can be recovered by issuing a ISD credit note. Sometimes what will happen, by mistake they would have distributed excess credit. To reduce that credit, they need to give a ISD credit note. To whichever division they have given less, they will be giving ISD debit note or invoice. Shortfall in distribution can be distributed using ISD invoice. Distributed credit should not exceed the credit available for distribution. For example, if 1 lakh is ITC, 1 lakh only should be distributed. If they distribute extra, that is an offence. Penalty will come. ISD default. Hope you remember. Next, if the ISD has distributed excess credit to any recipient, the excess can be recovered from the recipient with interest, not from the head office. They are telling they are going to recover from the recipient along with interest. ISD should obtain compulsory registration irrespective of their aggregate turnover. And this is one point which I told you, that is while computing turnover under rule 42, rule 43, and here also we have come across turnover, we should not take old indirect taxes. What are the 4 old indirect taxes? Central excise duty, state excise duty, CST and VAT. And there is one circular. This circular is applicable only for May 25 exam. Thereafter the circular will not be applicable. ISD or cross charge, because with effect from 1st April 2025 they have made ISD mandatory. So means everyone should go for ISD only. Up to that 31st March 2025 they have given either they can follow input service distributor or the cross charge. Cross charge means what? That is one branch or one division will receive the invoice. There is no concept of ISD. One branch or one division or one head office will receive the invoice and in turn raise the invoices to the other branches. For example, we have say 3 branches, branch 1, branch 2, branch 3, and a chartered accountant raised invoice for audit services to branch 1. Now what branch 1 will do? Will in turn raise invoice to branch 2 and branch 3 and will enjoy the ITC. This is called as cross charge. So previously what they used to do, chartered accountant will be raising invoice to corporate office, from corporate office they used to get the credit. But now like this, what is the advantage of this? The advantage is that they don't have to follow turnover ratio. They don't have to follow the turnover ratio. Directly to whatever extent branch 2 and branch 3 is having liabilities, to that extent they can transfer this. That is the advantage in cross charge, and that advantage only they have removed now. So CBIC circular on ISD or cross charge, either ISD or cross charge can be followed by head office for distribution of credit to branch office. In case of cross charge, normal invoice raised by head office to branch office normally, and turnover ratio need not be followed. But very important point is that these services should be attributable to the branch office. That is there. means it should be common services. It should not be attributable to one division only. It should be common services that they can distribute by way of cross charge. And with effect from 1/4/2025, ISD is mandatory and cross charge cannot be followed. With this, we completed input tax credit. In input tax credit, so that warranty I discussed, that was actually one old provision. Now, whatever I have discussed with you is recently added. Previously also we had some provisions, but that provision to this provision, what is the difference, sir? Simple. In previously, only a part was given. Now, entire product replaced also they have added. Previously, so about 7(1)(c) they were silent. So, ITC can be availed, that was there previously also. But 7(1)(c) can be invoked or cannot be invoked. So, that was silent at that time. Now, they clarified that you should not invoke 7(1)(c) because what department started doing, they were telling, okay, pa, you take the ITC, but you pay GST on that, like that. They were telling, sir, why should we pay GST? Because it is disposal of business asset on which ITC avail. So that's why they gave a clarification stating that it is not a supply, so they don't invoke 7(1)(c). Then one more point about manufacturer sending the replenishment of the stock, there was no clarity at that time. So it was required to raise invoice and e-way bill, and invoice and e-way bill means unnecessarily they need to pay GST on that. Now that is also clarified, and they are telling due to replenishment of the stock, just delivery challan is sufficient. They don't have to raise any invoice, and e-way bill of course is required, but it is delivery challan. It will not be treated as supply. Then another dispute was there. Can the manufacturer take ITC on their purchases? Replacement is done by dealer. Can the manufacturer take ITC on their purchases? That clarity was also not there. Now they have given that clarity also. Yes, manufacturer can definitely take ITC even though the replacement is done by the dealer or distributor, etc. The next one is with respect to that additional charges. Additional charges, there was no clarity about, if it is from the same dealer or different dealer, same time or different time, like that. For that also now they gave a clarity. Same dealer, same time only composite supply. All other cases individual supply. Okay. So I have fun or what to tell you that this is an amendment. Really it is an amendment, pa. So it was there because one student asked me, sir, already it was old amendment only. Why are you telling it as a new amendment? Trust me, pa. Mother promise, pa. It is an amendment only. So that is about this. Next. So we'll take a break, and then we will continue with one interesting topic, composition scheme. Small one we will discuss. Too much overload, na. For me also throat pain is there here. I am also standing only. So take a break for 15 minutes, and I can understand one more day only. Today some part, tomorrow we are going to complete. Okay. Majorly we completed. I don't know whether you have seen or not index. Majorly we completed. You don't know that you are happily listening because I am entertaining you that much. Okay, we'll meet after 15 minutes. Okay, we'll start. See this, the next area that we are going to discuss is composition scheme. It's one simple chapter. So composition scheme is given under section 10 of CGST Act. A person who is under composition scheme, rather than paying GST at the regular rates, they will be paying GST at the reduced rates. First we need to understand that composition scheme is optional, that it is not mandatory. So if the person is thinking that the composition scheme is going to give them a benefit, then they can go for composition scheme, otherwise not required. And what are the disadvantages of composition scheme? The advantage is only one, that they will not be charging GST to the customer and they will be paying GST out of their pocket. Because of it, the customer will be very happy that there won't be any GST burden on customer. What are the disadvantages? Disadvantage of composition scheme is that they cannot avail ITC on their inward supplies and they cannot charge GST to the recipient. So that is the disadvantage of composition scheme. And you can see here there are two composition schemes, that is under 10.1 and 10.2a. When they can go for composition scheme under 10.1, if their aggregate turnover during the previous year does not exceed 150 lakhs or 1.5 crores, and in case of 8 states it will be 75 lakhs. What are those 8 states where the limit will be 75 lakhs? That is M, T, N, U, SAM, Manipur, Mizoram, Tripura, Nagaland, Uttarakhand, Sikkim, Arunachal Pradesh and Meghalaya. These are the states where the limit will be taken as 75 lakhs. Okay. So this states related information we are coming across in multiple places. I am just giving you a compilation of all those states related information. You can quickly make note of it somewhere. So first, what are the special category states? First we need to know what are special category states. So special category states as per Article 279A, Article 279A of Constitution. Article 279A of the Constitution, we have some special category states. What are those special category states? That is M, T, N, Manipur, Mizoram, Tripura, Nagaland. Then A, Assam, Sikkim, Arunachal Pradesh, Meghalaya, Himachal Pradesh, Uttarakhand, Jammu and Kashmir. Okay. These are the special category states as per Article 279A of the Constitution. Manipur, Mizoram, Tripura, Nagaland, Assam, Sikkim, Arunachal Pradesh, Meghalaya. These are actually northeastern states. These are northeastern states. And then H for Himachal Pradesh, U for Uttarakhand and J for Jammu and Kashmir. These are considered as special category states. Then next one, so what are the states for which reduced limit of 75 lakhs will be applicable? That is aggregate turnover during previous year less than or equals to 75 lakhs, can opt for composition scheme under section 10.1. What are those states? That is 8 states, M, T, N, that is constant, MMTN. Instead of A SAM, it is U SAM, that is Manipur, Mizoram, Tripura, Nagaland, U for Uttarakhand, S for Sikkim, A for Arunachal Pradesh, M for Meghalaya. This is aggregate turnover during the previous year does not exceed 75 lakhs. They can go for composition scheme under section 10.1. Okay. Then next one, what is the aggregate turnover limit for registration? So that is one place where we have come across, that is aggregate turnover during current year. Aggregate turnover during current year exceeds 10 lakhs, then they are liable to be registered. What are those states where their aggregate turnover exceed 10 lakhs? They are liable to be registered. Only MMTN, M, T, N. These are the 4 special category states for which the limit will be 10 lakhs and they are liable to be registered. Then next one we have aggregate turnover during current year exceeds 20 lakhs, then they are liable to be registered, So what are those places? That is U stamp states. U for Uttarakhand, same. S for Sikkim, same. T for Telangana, that is extra. So far we have not come across that. Telangana. S, T. A, same. Arunachal Pradesh. And M, Meghalaya. P, extra, that is Pondicherry or Puducherry. So U stamp states. Then next one we have come across this in exemptions, that is starting point or ending point, starting point or ending point in airways, economy class, comma, transportation of passengers is exempted. If the starting point or ending point is in airways in economy class, the transportation of passengers is exempted. What are those cases? Northeastern states, that is M, T, N, A, Sam and Bagdogra in West Bengal. So these are the places where if the starting point or ending point of the passenger in economy class, that is important, so then the transportation of passenger service is exempted. So these are the places where we have come across, where we will be coming across in entire GST the places related information, so that I just have compiled in one place. Okay, then you can see here. So for the purpose of composition scheme, 10(1), aggregate turnover during previous year should not exceed 1.5 crores and 75 lakhs should be taken in case of 8 special category states. Okay, and what are those special category states? This MMTN, USAM. Then to whom it is applicable? 10(1) composition scheme is applicable to manufacturer, trader, supplier, food service provider, and they can also provide any other services. What is the limit up to which they can provide services? 10% of turnover during previous year or 5 lakhs, whichever is higher. To that extent they can provide service. Their main business should be manufacturer, trader or supplier, food service provider, but they can provide any other services, and the limit for that service is 10% of turnover during previous year or 5 lakhs, whichever is higher. Then what is the benefit of reduced rates? If they are a manufacturer, they will pay 1% on total turnover, means 0.5% CGST, 0.5% SGST on total turnover, and if they are supplier of food service provider, then 5% on total turnover, that is 2.5% CGST, 2.5% SGST on total turnover, and if they are a trader or they are providing service up to the limit, that is this 10% or 5 lakhs, whichever is higher, then the applicable rate will be 1% on taxable turnover, that is 0.5% CGST, 0.5% SGST. You remember the rate as 1%, 5%, 1%, but when you are writing, you have to write 0.5, 0.5 like that, because they cannot make interstate supplies, they can make only intrastate supplies due to that reason. So manufacturer 1% on total turnover, trader 1% on taxable turnover, supplier food service provider 5% on total turnover, and services up to the 10% limit will be 1% on taxable turnover. And current year limit for reduced rates, current year up to that 150 lakhs or 75 lakhs they will be into composition scheme, and thereafter they need to go for normal scheme. And difference in the condition, so there are some cases where they cannot opt for composition scheme. Composition scheme under 10(1) is not applicable in some cases. So all these restrictions we need to see for the current year during which they are opting for composition scheme, not for the previous year. So in that you remember this, like S9 RCM, section 9 is RCM. Okay, so like that, S9 RCM, yes for service providers other than supply of food. If my core business or if my main business itself is other than supply of food, I cannot go for composition scheme. Or if my core business is manufacturing, trading or supply of food, but I want to provide other services beyond 10% limit, then also I cannot go for composition scheme. That is this, yes, service providers other than restaurant service or service up to limit allowed. Then N for NRTP, non-resident taxable person, that is a person who is coming from other place to this place and is not having any physical place of business in this state, is NRTP. Are they required to register? Yes, they are required to register, but they cannot opt for composition scheme. Then I, interstate supplier of goods or services, whether it is taxable goods or exempted goods, they cannot opt for composition scheme. N, that is non-taxable supplies, that is alcoholic liquor for human consumption and petroleum products. Then E, that is supplier of services through e-commerce operator, and that e-commerce, which e-commerce operator? E-commerce operator liable to deduct TCS under section 52. So not normal e-commerce operator, that e-commerce operator who is deducting TCS. So if I am a restaurant, and I can definitely go for composition scheme under 10(1), but if I want to supply food through Swiggy, can I opt for composition scheme? Is it possible for me to opt for composition scheme? Yes, because TCS is not applicable in that case. Section 9 subsection 5 wherever applicable, TCS is not applicable. So in case of housekeeping services, accommodation services, transportation of passenger services and eating food in a restaurant, section 9(5) is applicable, where liability to pay GST is on e-commerce operator. In that case TCS is not applicable, but the problem is that I am not at all required to get registered because I don't have the liability. The liability is on e-commerce operator. But with respect to direct supplies, I have to register now when my aggregate turnover exceeds threshold limit. At that time, can I go for composition scheme? Yes, I can go for composition scheme. Suppose if I am making supplies of goods through e-commerce operator, can I opt for composition scheme? Yes, very much yes. The restriction is only for supply of services through e-commerce operator. Then next, R for RCM under 9(4), non-paid stock held as on the date of opting for composition scheme. That is like, so whenever there is a registered person who is making purchase from an unregistered person, they need to pay GST under RCM. And if they have not yet paid the GST, only in one case 9(4) will be applicable. That is inward supplies of a promoter or builder from an unregistered person. So they have to pay GST under RCM under 9(4). If they have not paid GST under RCM 9(4), they cannot opt for composition scheme. Naturally also they cannot opt for composition scheme because by selling one flat itself their turnover will cross easily 150 lakhs. So they cannot opt for, but this point is redundant. Then C, casual taxable person also cannot opt for composition scheme. Then M, manufacturer of certain notified goods. Who is a casual taxable person? A person who is coming from other state to this state and is not having any physical place of business in this state is known as a casual taxable person, and they cannot opt for composition scheme. And manufacturer of certain notified goods, that is ice cream, edible ice, pan masala, tobacco and tobacco products, aerated waters, bricks and roofing tiles. So manufacturer of these goods cannot opt for composition scheme. For example, Ibaco ice cream shop, can they opt for composition scheme? Yes, because they are not manufacturer, they are trader. A trader of these notified goods can always opt for composition scheme. The restriction is only to the manufacturer of these goods, these notified goods. Okay. So this is about S9 RCM. So these cases and all these should be for the current year. Last year, can I have interstate supplies? Yes. But current year, after opting for composition scheme, I should not make interstate supplies. Last year, can I have non-taxable supplies? Yes. But current year, when I am opting for composition scheme, I should not have non-taxable supplies. That is the meaning of this point. So therefore, what is the difference in condition? Manufacturer of notified goods cannot opt for composition scheme, but a trader of notified goods can opt. And next, we are looking into 10(2)(a). So what is the difference between 10(1) and 10(2)(a)? So 10(1) is applicable to manufacturer, trader and supplier of food service provider. But 10(2)(a), if you see, manufacturer, trader and any service provider can go for composition scheme under 10(2)(a). And when applicable, composition scheme under 10(2)A is applicable if my aggregate turnover during the previous year does not exceed 50 lakhs. Then composition scheme will be applicable under section 10(2)A. And what is the benefit of reduced rates? 6%, that is 3% CGST and 3% SGST on what turnover? Total turnover. And current year limit for reduced rates will be 50 lakhs, means as and when they cross 50 lakhs they will be disqualified from the composition scheme. And difference in the conditions, if you see here, manufacturer of notified goods cannot opt for composition scheme. Here also manufacturer of notified goods cannot opt for composition scheme. Both 10(1) as well as 10(2)A same. And in 10(2)A there is one more point, that is supplier of notified services also cannot opt. What are those notified services? It is not yet notified, so they cannot opt for composition scheme. Literally all the conditions whatever we have for 10(1) is applicable for 10(2)A also, but for 10(1) extra we have yes, but 10(2)A that is not there, because any service provider can go for composition scheme. Means literally when a person will go for composition scheme under 10(2)A, to whom composition scheme under 10(1) is not applicable, that is they are any service provider, then they will go for 10(2)A. Or they are under 10(1) but they want to provide service beyond 10% limit, then also they will be going for composition scheme under 10(2)A. And you can see this below. So composition scheme under 10(1) is not applicable, then they can go for composition scheme under 10(2)A. Then one more point you please make note there below. Whenever I am under composition scheme, I may have some inward supplies on which I need to pay GST at what rate? Even though I am under composition scheme, on my turnover only, that 1% or 5% or 6%. All these 1%, 5%, 6% is on my turnover. Turnover means outward supplies. But I may have some inward supplies. On that inward supply I need to pay GST under RCM. That I will pay at what rate? Normal rates. So composition scheme is not applicable for inward supply. Composition scheme is only for outward supplies. GST payable under RCM at normal rates, even though they opted for composition scheme. Even though they opted for composition scheme, they need to pay GST at the normal rates. Then one more point, carefully listen. Section 9 subsection 4 is that there is a promoter or builder who is making purchases from an unregistered person. That promoter or builder is required to pay GST under RCM. If it is cement, they need to pay GST at the rate of 28%. If it is other goods and all, they need to pay capital goods, means they need to pay GST at the rate applicable to capital goods. If it is any other inward supply from unregistered person, they need to pay GST at the rate of 18%. Now listen, I am a promoter or builder. I am purchasing cement from an unregistered person. I need to pay GST under RCM at 28%. Now, I am asking that unregistered person, boss, you register under composition scheme. When you register under composition scheme, you will be required to pay GST at the rate of 1%. You pay 1% out of your pocket, so that when I am purchasing from you, I am purchasing from a registered person. So therefore 9 subsection 4 is not applicable for me. Like that, can I make that unregistered person to come under composition scheme? Impossible, because a person who is making supply to a person covered under 9 subsection 4, means promoter or builder, they cannot opt for composition scheme. So this also you write down. You have written this point now. One more point also you write down. Suppliers who are making supplies to promoter or builder under section 9(4) cannot opt for composition scheme. Suppliers who are making supplies to promoter or builder under 9(4) cannot opt for composition scheme. So these are some extra points which are like practically when we are reading, we may get these doubts. That's why I have given this, but these are all not tested in exams. Then next, supplier who are making supplies to promoter or builder under 9(4) cannot opt for composition scheme. Then you can see what is the meaning of aggregate turnover for determining the eligibility to opt for composition scheme. What is the general meaning of aggregate turnover? In aggregate turnover, we have to include taxable supplies, exempted supplies, non-taxable supplies, zero rated supplies. But we need to exclude inward supplies under RCM and taxes. This is the general meaning of aggregate turnover. But when you are under composition scheme, while deciding the aggregate turnover for the eligibility to opt for composition scheme, we need to take pre-registration turnover is also part of aggregate turnover. So we need to add the pre-registration turnover. And then interest on loans, advances and deposits, even though it is exempted, that will be excluded while computing the aggregate turnover. So you can see here, aggregate turnover will be computed on the basis of turnover on all India basis and will include value of all taxable supplies, exempted supplies and exports made by all persons with same permanent account number, but would exclude inward supplies under reverse charge as well as GST group. And what about interest? Interest income will not be considered for calculating aggregate turnover. Moreover, interest income will not be taken anywhere in this composition scheme as a part of aggregate turnover. As well as there is one more turnover in a state or union territory. So then also they cannot take this. The meaning of aggregate turnover is literally same even for turnover in a state or union territory. So look into this. What is the limit up to which I can provide the services? I can provide services up to 10% of aggregate turnover or 10% of turnover. 10% of turnover. You see that. So if you observe, what is the limit up to which I can provide services? I can provide services up to 10% of turnover during previous year or 5 lakhs, whichever is higher. For example, say previous year 2024-25, I am doing business in 3 states, that is Tamil Nadu and Andhra Pradesh and Telangana. I am doing business in 3 states and my limit, that is aggregate or turnover limit in Tamil Nadu is somewhere like 60 lakhs and in Andhra Pradesh my turnover is 30 lakhs and in Telangana my turnover is 25 lakhs. So what is my aggregate turnover? Because always aggregate turnover is computed on all India basis. What is my aggregate turnover? 60 plus 30 plus 25, that will be 115 lakhs. So now current year 2025-26, can I opt for composition scheme? Yes, because none of these states is in MMT and USAM. Therefore, the 75 lakhs limit will not be applicable. So therefore, 150 lakhs is the limit. And as my aggregate turnover during the previous year does not exceed 150 lakhs, I can definitely opt for composition scheme during the current year. What is the limit up to which services can be provided? Limit up to which services can be provided. Limit up to which services can be provided. How much limit I can provide the services? 10% of turnover, that is 115 lakhs into 10%, that is 11.5 lakhs or 5 lakhs, whichever is higher, that is 11.5 lakhs. Wrong answer, because we need to see 10% of turnover during previous year, not aggregate turnover. 10% of turnover. So 60 lakhs into 10%, 6 lakhs. So 60 lakhs into 10% or 5 lakhs, whichever is higher. Okay. So therefore the answer will be 6 lakhs. And here, so 30 lakhs into 10% or 5 lakhs, whichever is higher. Okay. 5 lakhs, whichever is higher, that will be 5 lakhs. Same way, in this case also it will be 5 lakhs. Then what is the limit up to which services can be provided? 16 lakhs. Okay. So means state wise we need to check the limit. Tamil Nadu I can provide service up to 6 lakhs. Andhra Pradesh I can provide service up to 5 lakhs. Telangana I can provide service up to 5 lakhs. So that is how we need to compute, because the 10% is not on aggregate turnover, 10% is on turnover. And one more point here, in this case, what will happen if I provide more than 6 lakhs of services in Tamil Nadu, but overall the limit of 16 lakhs I have maintained, then also I am disqualified from the composition scheme, because if I cross this limit of 6 lakhs, I am disqualified from the composition scheme under 10(1). Naturally, for 10 like this AP and Telangana also I will be disqualified, because remember, all in all out. If you are not eligible to opt for composition scheme in one state, you are not eligible to opt for composition scheme in other states also. Okay. So that is this. What is the difference between aggregate turnover and turnover? Aggregate turnover will be computed all India basis, but turnover will be computed state wise. That's why turnover, wherever we use a word in a state or union territory, and this is the meaning of aggregate turnover only for composition scheme but not for registration. Then the person opting for composition scheme can provide service up to 10% of turnover, 10% of turnover during previous year or 5 lakhs, whichever is higher. While computing this 10% turnover also, the interest income will not be taken into account. For example, my turnover during the previous year is 80 lakhs. 80 lakhs into 10%, 8 lakhs worth of services I can provide. So during the current year, I provided 7 lakhs of normal services and 3 lakhs of interest income. Interest income is also service. So because of which, did I breach the limit of 10%? No, because interest income will not be counted for the purpose of this 10%. That is this. And what is the tax rate applicable for these services? The tax rate applicable for this service is 1% of taxable turnover, that is 0.5% CGST, 0.5% is GST on taxable turnover. That should be taken. Then some other procedural provisions you can see. Suppose if I am already registered, I need to make application for composition scheme in CMP2 before commencement of the financial year. So at any time during the financial year, can I enter into composition scheme? No. If I am now only getting registered, I can enter into the composition scheme. Suppose if I am already registered, I need to wait before commencement of the financial year. If I am not already registered, now only I am getting registered, at any time during a financial year, I can enter into composition scheme by making application in REG1. REG1 is application for registration, CMP2 is application or intimation for composition scheme, and every person who is under composition scheme should display composition taxable person in every notice or signboard displayed at the principal place of business and every additional place of business. What is a return that should be filed by a person opting for composition scheme? CMP 08 and CMP 8 by when they need to file? By 18th of the month following every quarter. So they need to pay tax also on a quarterly basis. And while paying the taxes, how they need to consider the advances? Should they pay GST on advances? Yes, because the time of supply provisions, GST not payable on advances in case of goods, but that is not applicable in case of a person opting for composition scheme. So what they need to see is that during the current quarter, how much is the value of bill of supply? The tax invoice will not be issued by them because they cannot recover the GST from the recipient. So they will be giving bill of supply. We need to see total bill of supply during the quarter minus advances received in the previous quarter for which supplies are made in the current quarter should be reduced, because on that advances already they would have paid a tax. Again, they need to add advances received during the current quarter for which supplies will be made in future, so that they need to add. So after making this adjustment, they will get the value on which composition tax will be payable. So GST payable on value as per bill of supply during the current quarter, add advances received during the current quarter pertaining to next quarter minus advances received during the previous quarter pertaining to the current quarter. Okay, so but in zero rated services it is different. It is like payment received during the month minus advances received during the month for which supplies will be made in future, add advances received in the past month for which supplies are made in the current month. So slight difference is there between these two, so you appreciate the difference so that don't get confused in exam. Then next one, they need to file an annual return. What is the annual return? GSTR4. By when they need to file the annual return? By 30th June of the succeeding financial year. That's an amendment. Previously it was 30th April and now they changed it to 30th June of the succeeding financial year. Then all in or all out, that is either composition scheme or normal scheme for all registrations of a person. They cannot choose normal scheme for few registration and composition scheme for other registration. One more point also you keep in mind, there are two composition schemes, few registrations composition scheme under 10.1, few registrations composition scheme under 10.2a, that is also not possible. Okay, so write down few registrations under section 10.1 and few registrations under section 10.2a not possible. So this all in all out is not only for regular scheme versus composition scheme. Within the composition scheme also, between 10.1 and 10.2a, they cannot mix and match. All the registrations will be under 10.1 or all the registrations will be under 10.2a, but not both. So few registrations under section 10.1 and few registrations under section 10.2a is not possible. Then, so these are the restrictions S9 RCM, and this above non-applicability is same for 10.2a, except that any service provider can opt for composition scheme under 10(2)(a). And validity of composition scheme, if all the conditions are satisfied, the option remains valid. If the conditions are not satisfied, they need to pay tax as a normal taxpayer, and they will issue a tax invoice for taxable supply, and they need to exit from the composition scheme. What is the time limit that is available for them to exit from composition scheme? 7 days. So from the date on which they have breached the condition. So breach of condition could be like they crossed the turnover limit of 1.5 crores or 75 lakhs or 50 lakhs, or they started making supply of services through e-commerce operator, or they started making interstate supplies, or they started making non-taxable supplies. These are some breach of conditions. From the date of breach of condition, within 7 days they need to exit from the composition scheme by filing CMP4. And self-withdraw, voluntarily also at any time they can withdraw from the composition scheme by filing CMP4. And suppose if they have breached the conditions but they continue in the composition scheme, and proper officer has reason to believe that they have contravened but they continued in the composition scheme, now the officer will give a notice under CMP5, and thereafter a reply to be given within 15 days in CMP6, and thereafter within 30 days, so they will pass an order in CMP7 either accepting the reply or denying the composition scheme. So therefore we have to remember few forms here. So what are those forms I have given? So first remember 4 forms, that is 2 odd forms are there na, that is 1, 2, 3, 4. The odd number forms are ITC forms. The odd number forms are ITC forms. The even number forms are CMP forms. Okay. ITC 1 for what? Availing ITC on closing stock. Availing ITC on closing stock. When you will avail ITC on closing stock? When you enter into composition scheme or exit from composition scheme? When you enter into composition scheme or exit from composition scheme? Exit from composition scheme. When you exit from composition scheme, you will avail the ITC on closing stock. So exit from composition scheme, you will avail the ITC on closing stock. So therefore this ITC 1 first form and last form makes a combo, ITC 1 and CMP 4. What is the time limit by which CMP 4 should be filed? 7 days from the breach of conditions. What is the time limit within which ITC 1 should be filed to avail the ITC on closing stock? 30 days from the date of exit, and it can be extended for a further period. Then CMP2. CMP2 is for what? Entry into composition scheme. Entry into composition scheme. When you enter into composition scheme, what you need to do? Reverse the ITC on closing stock or avail the ITC on closing stock? Reverse ITC on closing stock. So due to that reason, CMP2 and ITC3 is a combo. CMP2 and ITC3 is a combo. Okay. And whenever you are entering into composition scheme, you need to reverse the ITC on closing stock. When you can enter into composition scheme by filing CMP2? Definitely before commencement of the financial year. And when you need to file ITC3? From the commencement of financial year within 60 days, you need to file ITC3 for reversal of ITC on closing stock. Okay. So these are the 4 forms which I have given over there, already it is there. CMP2. So CMP2 is for entry into composition scheme before commencement of the financial year. Whenever you file CMP2, you need to file ITC3. ITC3 is for reversal of ITC on closing stock, and that should be filed within 60 days from the commencement of the relevant financial year. CMP4. CMP4 is for intimation of withdrawal from the composition scheme within 7 days of occurrence of event. Whenever you intimate them for withdrawal from scheme, ITC1, you can avail the ITC on closing stock within 30 days from the date of conversion. Then CMP5 is a notice, and CMP6 reply, CMP7 order. Notice anytime and reply to notice within 15 days, order within 30 days. CMP8 is a return to be filed by a person opting for composition scheme, that is 18 days from the end of the quarter. Got it? And denial of composition scheme, whether it is prospective or retrospective. So say you have not fulfilled the conditions, say you made interstate supplies and they have issued a notice, you gave a reply, and thereafter they denied the composition scheme. Now whether that will be prospective or retrospective, it can be prospective or it can be retrospective, but not before the date on which you have made the contravention. For example, on 18 September 2024, you made supply of services through e-commerce operator. Means they can deny the composition scheme retrospectively also, but not before 18 September 2024. That is this. In case of denial of composition scheme by the tax authorities, the effective date of such denial shall be from a date including any retrospective date as may be determined by tax authorities. However, such effective date shall not be prior to the date of contravention of provisions of the Act. When is it advisable to opt for 10(2)? I told you, if a person is making only services or they are making supply of goods other than restaurant services, but they want to provide service beyond 10% of limit, then also they can go for 10(2)(a). Now you can see meaning of various turnovers. We have come across three turnovers in composition scheme. One is aggregate turnover for determining the eligibility to opt for composition scheme, then turnover for computing that 10% limit for services, and turnover for payment of GST under composition scheme. Now tell me, what is the period that we need to see? Whether aggregate turnover of current year or previous year we need to check. Previous year, because previous year if my aggregate turnover does not exceed the specified limit, then current year I can opt for composition scheme. I need to see the previous year. Turnover for determining 10% limit for services, whether it is current year or previous year. Previous year, because 10% of turnover during previous year or 5 lakhs, whichever is higher. And for payment of GST under composition scheme, we need to see current year basis. So when the moment when we use the word aggregate turnover, it will be on all India basis, but the other two turnover will be state or union territory wise. And if you see aggregate turnover, so total you need to remember 8 points. Taxable 5 plus, taxable supply included, exempted supply included, non-taxable supply included, zero rated supply also included. Okay, and even pre-registration turnover. Pre-registration turnover means, say for example, this year only I commence the business, and after crossing 40 lakhs I have registered, and after registration my turnover is 120 lakhs. 120 plus 40, only 120. 120 plus 40, 160 lakhs. So I cannot go for composition scheme next year. Got it? So pre-registration turnover will be included. 5 plus taxable, exempted, non-taxable, zero rated, pre-registration. Three things will be minus. What are they? Inward supply under RCM, taxes and interest on loans, advances, deposits. And now you will get aggregate turnover. Whatever is the meaning of aggregate turnover, the same meaning is applicable even for turnover for 10% limit, but only difference is what? This will be all India basis, this will be state or union territory wise, but otherwise everything will be copy paste. Then what is the meaning of turnover for payment of GST under composition scheme? So usually turnover for 10% limit will be previous year, whereas this will be current year. Okay, and here non-taxable supplies, exports, interstate supplies can be there, but if you have non-taxable supplies, exports or interstate supplies, you are disqualified from the composition scheme. Also pre-registration turnover will be excluded. For example, this year I am opting for composition scheme, this year only I commence the business, then up to my registration I don't have to pay GST, thereafter only I need to pay GST under composition scheme. So pre-registration turnover will be excluded. So what is the meaning of not applicable? Not applicable means these supplies cannot be made during the current year, and if made, the person is disqualified from the composition scheme. That is the meaning of that. Now this turnover, we have come across many turnovers in many places. I have given at the end of this book, so the entire turnover chart you can see. So we have come across turnover in multiple places. All these turnovers you can see page number 297. Page 297 you can see. First there is aggregate turnover for determining eligibility for registration. That is regular aggregate turnover to check the registration. Then aggregate turnover for determining eligibility for composition scheme. Then turnover for determining 10% limit. Then turnover for payment of GST under composition scheme, and taxable turnover for a trader. Taxable turnover for payment of GST under composition scheme. Then turnover for computing ITC reversal and distribution of ITC by input service distributor. And finally turnover for computing refund of unutilized ITC in case of zero rated and inverted tax structure, that is adjusted total turnover we discussed. So all these turnovers I have given in this place. If you see aggregate turnover, the regular, so taxable supplies will come, exempted supplies, non-taxable supplies, definitely invert supply under RCM will not come, GST, all GSTs will not be coming, but old indirect tax will come in the aggregate turnover. But if you see for ITC purpose, these old indirect taxes will not come. You understood? Can you see this difference? So generally old indirect tax will come in aggregate turnover, everywhere it will come. Old indirect tax will come everywhere, but only for the purpose of ITC, these old indirect taxes will not be coming into aggregate turnover. So this you highlight that old indirect taxes will not come only in this place. Then generally interest on loans, advances, deposits will be taken into turnover, but only in composition scheme interest on loans, advances, deposits will not be taken into turnover. Okay, only under composition scheme. Wherever you see composition scheme, so interest on loans, advances, deposits will not come. But what about interest on account of delay in receipt of consideration? Yes, that will be coming in everywhere. And wherever you see aggregate turnover, there only it will be all India basis, but in all other places turnover in a state or union territory state wise, whereas last two cases is there na ITC turnover and refund turnover, that will be registration wise, means in the state also if you have more than one registration, so registration wise we need to check that. Then next pre-registration turnover, so included or excluded. So what you need to do is that you need to just go through this particular turnover, and so that whenever you have a doubt you refer this chart, and one day before the exam also quickly glance through this and you need to go for exam. Okay, so that you will not get any kind of confusion when you close your mind, the entire chart will come in your mind, so that you will know whether it will be included or not included, etc. and all. Because sitting in the exam hall we definitely get confused with respect to these turnovers. Next I have also given this concept index at the end also. Concept index will be useful for IBS exam. So for example, there is one MCQ related to arrest. Then you need to know which page arrest is there. So that's why go to this concept index, ABCD I have given arrest. It is in page number 187. You can go to page number 187, there the arrest related provisions are there. Suppose if there is one question related to blocked credits, you need to go and check where it is in blocked credits. You don't have to search many pages, directly you can go here, B for blocked credits, page number 97 it is there, you can take that. Okay, so it will be easy for you to search and refer and write, because the problem is after writing IDT exam usually you will not forget, but in case for IBS exam if you forget any provision, or you have to quickly refer and write, for that definitely this will be helpful, because the problem is that you will be under enormous pressure after seeing the question. So you will have lot of books before you, and when you have lot of books before you, you don't know which to take first. So that's the problem, it will happen. That's why I'm telling you. So whenever you read that MCQ or any question, if you are having a doubt, so you prepare a concept index like this for every subject. It will be helpful for you. Usually every teacher they are giving the concept index for their respective book, and don't take any other book for these 5 subjects. Whichever book you are following, you please take those books only. And for SPOM-A and SPOM-B study material, you take a print of it. So you go to one center, one Xerox center or photocopy center, you take a print of it, and there you prepare an index like this. So SPOM-A and SPOM-B, so that definitely it will be helpful for you. And these 5 books, whichever book you are referring, that plus this. And sir, should I carry all the books like solved workbook, because one subject means, so some 4 books or 5 books and all will be given? No, you will not have time to refer. Trust me, you will not have time to refer. So therefore you will have one concept book like that for every subject you will be following. So that concept book you carry, and apart from that, so 5 books, 5 subjects, 5 books. Maybe DT, so BB sir may be giving 2 books for compact. So maybe like that. Okay, 5 subjects, whatever is the concept books, plus SPOM A, SPOM B, plus one case study book that is also released by ICI. So that case study book also you take. In the case study book also, you go through the book once whenever you feel like sleepy. So like say for example, right now I am discussing about IBS na. So because you were sleepy, so like whenever you are preparing, you feel like you are down and all, you take that case study book. In that case study book, sir, should we read, sir? No, don't read. Just to go to each and every MCQ. That MCQ will be based on one concept. You prepare one small notebook. In that notebook, one page, one alphabet, A, B, C, D, E, F, G, H up to Z. Okay, you read a MCQ that is based on one concept. That concept, say for example, that concept is somewhere related to director's remuneration, like that. So you go to D, director remuneration, page number. You understood or not? You need to create an index. Weapon you need to make ready. Only then you can fight there. Otherwise there, if you search which weapon to use and all, gone. They will kill you and go. Got it? So for that reason, so case study book also you take print and you develop this. Daily night before sleeping, because somewhere like 10 o'clock, 9 o'clock and all, you will be exhausted. At that time you sit and do this work. Okay, so that you can prepare the weapon ready. It's not about how much you read, no, how much you carry, that is important. What to carry and how much you carry, so that IBS exam will be taken care. You got it? So IDT, don't worry, this book you carry, and this time we have really upgraded the book to a greater extent. I don't know whether you have seen the previous edition and all. If you have seen the previous edition, you might be knowing. So this time we have given extra and lot of notes also we have given. So at each and every page, that is for the reason that whenever you learn anything new, say maybe some questions you are reading or some new things you are reading, that you immediately incorporate there and you carry that to the exam. Not inside the exam for IDT exam, but for IBS exam, inside the exam also you can carry. Got it? Then coming back to this, that is about the turnover chart. So we completed composition scheme, and there is one query. Sir, if a supplier is already under composition scheme and if he supplies for the first time to a promoter or builder under 9(4), then in that case, will 18(1)(c) be invoked? Correct. He will be coming out of the composition scheme and he will be going into normal scheme, and so therefore 18(1)(c) will definitely be coming into picture. Okay. Then next, what about resource book, sir? What about solved workbook, sir? That's what I told you. Whatever you read there, some extra things you will be learning that you incorporate in this. So this is the exercise you need to do throughout your preparation for the next 1.5 months. So not only IDT, every subject you need to do that. Anything extra you are learning, try to put a sticky note or try to write in the book itself and try to minimize the books and to take to the exam. Because the problem is they will give one stupid chair and table, and in that you cannot keep all the books also. You cannot sit and refer also. You have to minimize the number of books, and mostly in many places there is no lift also. Somewhere 3rd floor, 4th floor. So you are not Bahubali to take entire luggage and all. And therefore they are not allowing the parents also to assist you. They are telling all the parents should stop there itself at the out gate. Then who will help? Others also will not help, because if it is others are, definitely no one will help. Everyone has to carry their books only, na? So no one is ready to help. That's why I am telling you, minimize to the extent possible. Next. So another question, solved workbook, question number 20, 21 and 22. Okay. So related to composition scheme, let me discuss few questions. Question number 20. Okay, see this here. So one friend asked me to discuss question number 20, 21, 22. Maybe he is finding it difficult to understand. Let me do it for him. Oh, this question. Say this. So this is one big question which they have not yet tested. I don't think so it will be tested now also, but it is an RTP question. Maybe if your time is bad they can ask. So B&D company, a partnership firm in Nagpur, Maharashtra, is a wholesaler of a taxable product P and exempted product Q. The firm supplies these products only in the eastern part of Maharashtra. All the procurements, both goods and service of the firm, are from the supplier registered under regular scheme in the state of Maharashtra. The firm pays tax under composition scheme. B&D company has furnished the following details with respect to its turnover exclusive of taxes and stock exclusive of taxes. Here what happened is that they gave the turnover data for the first quarter, that is 36,2000, and next again second quarter they gave the data, and they gave stock details as on 36, 39 and 31/10. And here they gave one paragraph as to when the stock is purchased. What is it we need to do in this case? All the above amounts are exclusive of taxes wherever applicable. Compute the net liability of B&D company for the period April to October, and they are under composition scheme. What is the date on which they exit from the composition scheme? We need to focus. So first quarter, what is their aggregate turnover? What is their aggregate turnover? 60 lakhs plus 17 lakhs 65,000, that is 77 lakh 65,000. Again second quarter it will be 50 lakhs plus 17 lakhs, that will come to total 1 crore 44 lakh 65,000. 1 crore 44 lakh 65,000 is the turnover already they have completed for the half year. Now October 1, so they have made some supplies, 2 lakh plus 3,000, 2 lakh 3,000. So you add that 1 crore 44 lakhs plus 2, 1 crore 46 lakhs plus 1 lakh 38, 1 crore 48 plus 1 lakh 6,250, 1 crore 49 lakhs plus 92,500, 1 crore 50 lakh 5,000, means exactly on 3/10/2000 because of this invoice they are crossing, means that invoice onwards they will be under normal scheme. You understood? Because of a particular invoice, if you are crossing the threshold limit of registration, from that invoice onwards you need to register and pay GST. Same way, because of a particular invoice, if you are crossing the composition scheme, from that invoice onwards you need to pay under normal scheme. Okay, so mainly for that cutoff only we have this data. Now for the first quarter, that is up to 36,2000, product P, product Q, whether it is taxable or exempted, basically what they are, wholesaler. Wholesaler will pay GST only on taxable turnover. What is a taxable turnover? Product P is taxable and product Q is exempted. So but for aggregate turnover we will take both, but for payment of GST we will take only taxable turnover. For the first quarter you can see the answer. For the first quarter 60 lakhs, 60 lakhs into 0.5%, 0.5%, 30,000 and 30,000. Is it clear? So that is about first quarter. Second quarter, what is the turnover? 50 lakhs. Because 17 lakhs is exempted, no need to pay GST by a trader. So 50 lakhs into 0.5%, 0.5%, that is 25,000 and 25,000. Thereafter, in the third quarter, up to which date they are under composition scheme? So 210. As on 210, up to 210, only product P you take, because product Q is exempted. Only product P, that is 2 lakhs plus 1 lakh 36,000 plus 67,000, that will be 4 lakh 3,000. So 4 lakh 3,000 into 0.5%, 0.5%, 2015 and 2015, this will be taken as the GST payable by them under composition scheme. Now there is some inward supply data. So see the first one, freight paid to GTA during the period April to October. April to October means total 10 months data they have given. 10 months or 9 months. So 7 months data they have given. For this 7 months they have paid 1 lakh 40. Means 1 month is how much? 20,000. Assume equal amount of freight is paid each month on the 10th day of each month. GTA service so will always be covered under RCM unless they have opted for FCM. So GTA can opt for FCM. If they opt for FCM, then it will be 12%. But if you observe here, they have given make suitable assumptions wherever required. Rate of CGST, SGST on service of transportation of goods by GTA is 2.5%. Under FCM also 2.5, that is 5% is there. RCM also 5% is there. But what is the default option? The default option will be RCM option. If the GTA opt for FCM only, it will be FCM option. So therefore, this is an inward supply on which they need to pay GST under RCM. So first quarter, that is April, May, June. April, May, June, how much? 20,000, 20,000, 20,000, 60,000. On that 60,000, they need to pay GST under RCM. at the normal rate, not at the rate applicable to composition scheme, because for your outward supplies only you need to pay at 1%, but inward supply normal rate. So you can see here 60,000. So on that 60,000, 2.5, 1,500 and 1,500, that will be GST payable under RCM. Again, second quarter also same, 1,500, 1,500. But October, what is the time of supply for this transaction? 10th. How you know time of supply? In case of services covered under RCM, the time of supply will be the date on which payment is made to supplier or 61st day from the date of invoice, whichever is earlier. So invoice they have not given, and date on which payment is made is 10. So whichever is earlier will be 10. But by 10th they are under normal scheme. By 10th they have exited the composition scheme, which means the last month RCM will not come under composition scheme. The last month RCM will come under normal scheme. That's why for last month, that is quarter ending third quarter, we have not taken. So that is the answer for this. Understood here? So why for last month? That is last month means what? October month. October month means what? October, November, December. October, November, December. Up to which date they are under composition scheme? Only 210. Only 210 means only first 2 days they are under composition scheme. But what is the time of supply for this GST paid under RCM? 10th of October. Is 10th of October coming before 2nd of October? No. So means by 10th of October they were under composition scheme or normal scheme? Normal scheme. But the question is what? The question is compute the net GST liability of B and D under composition scheme. So they are under composition scheme up to 2nd only. So that's what I have given here. Paid on 10th day for goods transported between 11th to 20th day of the month. So the same will be assessed under regular scheme. Okay. Next, keeping all the facts and figures. Sir, one more inward supply is there. Why it is not considered? Because it is packing charges. Packing charges is not covered under RCM, it is FCM. So therefore it is not added to their liability. But can't they take ITC? How they can take ITC? They are under composition scheme. They cannot take ITC on this inward supply and all. Next, keeping all the facts and figures of question number 20 unchanged, compute the ITC credited to the electronic credit ledger of B&D company when it exits composition scheme and become liable to pay tax under regular scheme in accordance with the provisions of 18(1)(c) of CGST Act. So whenever they exit from composition scheme and come into normal scheme, we need to see what is the closing stock that they have as on the date of exit from composition scheme to normal scheme. What is the date of exit from composition scheme to normal scheme? 310. So 310 means we need to see the closing stock as on 210. But where we have the closing stock as on 210, we don't have the data related to closing stock as on 210. Then we need to follow a single entry system. What is that? Opening stock plus purchases. Opening stock plus purchases minus cost of goods sold equals to closing stock. Okay. Opening stock plus purchases minus cost of goods sold is closing stock. What is the opening stock? As on 110. As on 110. I need the closing stock as on which date? 210. As on 210. So I need to take the purchases between 110 and 210. Even cost of goods sold also between 110 and 210. Okay. Then we will get the closing stock as on 210. What is the opening stock as on 110? For which product we need to see? Only product P. Why not product Q? Sir, product Q is exempted. Naturally, when you buy that product Q, there won't be any GST. But when you buy product P, there will be GST on that product P. So only for product P we need to count. What is the opening stock as on 110? So whatever is the closing stock as on 39, that will be taken as the opening stock as on 110. That will be 10 lakhs. And purchases, if you see, they have given one line. The entire stock of product P and Q available with the firm as on 39 is purchased during the said half year except a consignment of product P valuing 3 lakhs which was purchased in the April month of the preceding financial year in the month of October. So we need October data. In the month of October, no purchases were made. So which means this purchases will be 0 minus cost of goods sold. They have given one data. The products were sold with a profit margin of 20% on sales. What is the sales here? 2 lakhs, 1 lakh 36 and 67,000 for these 2 days. For these 2 days 110 and 210, 3 sales have happened. 2 lakhs, 1 lakh 36,000 plus 67,000. This is sales. Sales minus gross profit. Sales minus gross profit 20% will be cost of goods sold, that is 3,22,400, and that will be closing stock as on 210. That is how much? 10 lakhs minus 3,22,400, 6,77,600. You understood now how we got 3,22,400? Sales minus gross profit is cost of goods sold. Okay, somewhere in childhood you would have studied. So 6,77,600. But in this 6,77,600, there is some stock which is purchased beyond 1 year, which cannot be taken as ITC under 18(1)(c). You read that paragraph. The entire stock of product P and Q available with the firm as on 39 is purchased during the said half year, except a consignment of product P valuing 3 lakh, which was purchased in the April month of the preceding financial year. Right now we are in October. So within 1 year prior means October previous year, but April previous year means beyond 1 year. So that should not be taken, because in case of 18(1)(c) we have observed 1 year time limit. So therefore it is beyond 1 year. So therefore we need to take out 3 lakhs. What is the balance? 3,77,600. On this 3,77,600, whatever is the GST paid, that can be taken as ITC. Assume the rate of GST as 9% each. So you can see here 3 lakh, how much? 2 lakh plus 1 lakh 33,000. Here in this question it has been taken as 1 lakh 36,000, but in this answer it has been taken as 1 lakh 33. So it is 1 lakh 36,000. So when it is 1 lakh 36,000, it will change. So 2 lakh plus 1 lakh 36,000 plus 67,000 into 80% will be 3,22,400. So when it is 3,22,400 minus 10 lakhs, that will be 6,77,600. 6,77,600 minus 3 lakhs, that is 3,77,600 into 9%, 9%. Okay, so 3,77,600 into 9%, that will be how much? 3,77,600 into 9%, 33,984, and 33,984 is the answer. Okay, so slight change happened because actually this is a different question, this is a different question. So but this, because of this 1,36,000, and there it is taken as 1,33,000. So but this is how you need to do the computation. Okay, next another question, continuation to this. Particulars relating to capital goods of the firm owned by the firm. Date of purchase they have given, value they have given, GST they have given, computers, printers, motorcycle, furniture and fixtures, air conditioner, exhaust fan. All these are blocked credits, are eligible for ITC. Computers nowhere in the block credit, printers nowhere in the block credit, but motorcycle used by the staff for collecting payments from the debtors, so that will be blocked credit. And furniture and fixtures, air conditioners, exhaust fan, no issue. All these are purchased when? All these are purchased on 1/2, then 23/9, 12/6, 15/10 and 10/3. Now, what is the date on which you are migrating from composition scheme to normal scheme? You can see here 3/10, correct? So which means we need to see the capital goods as on 2/10. So what are the capital goods as on 2/10 here? By 2/10. So this is before 2/10, correct? And this also before 2/10. this is also before 210, this is also before 210, but this is 1510, means after that only we have purchased, and 10.3 also before 210, and all these capital goods also. You can see here computers, first computers 36,000, but we need to reduce. As per 18(1)(c), we need to take ITC on capital goods after reducing 5% for every quarter or part thereof from the date of purchase till the date of migration. What is the date of purchase? 1/2, 1/2 to 2/10, 1/2 to 2/10. Is it within 1 year prior? Yes, within 1 year prior. So how many quarters? So 1/2 means January, February, March, then April, May, June, July, August, September, and October 1 day also. So you need to count it as total 4 quarters. So 5% into 4 quarters, and that will be taken. So 36,000 is the GST paid. 36,000 is the GST paid. So 36,000 minus 5 into 4, 20%. That will be 28,800. But in that 28,800, CGST will be 14,400 and SGST will be 14,400. Then next, printers. Printers, January 1st, 2 year prior. So means beyond 1 year, we will not be able to take ITC. Motorcycle, blocked credit, will not be able to take ITC. Furniture and fixtures, 12/6, 12/6 to 2/10, 12/6 to 2/10. So June means, so April, May, June, July, August, September, October. So for 3 quarters, you need to reduce. So 5% into 3 quarters, 72,000 divided by 2, 30,600, 30,600. Then air conditioners used in office will not come under 18(1)(c), because it is after you converted into normal scheme, then you have purchased. So it will not come under 18(1)(c). The question is how much ITC they can take in terms of 18(1)(c). So due to that reason. Then next, exhaust fan used in the go down. Exhaust fan used in the go down 10/3 to 2/10. 10/3 to 2/10. So which means Jan, Feb, March, April, May, June, July, August, September, October. So therefore 4 quarters, 9,000 minus 5% into 4 quarters. So divided by 3, 3,600, 3,600. So this is the ITC to be claimed on capital goods. This is the ITC on inputs and this is the ITC on capital goods. So the total also will slightly change because of this. 33,984 plus 48,600. So that will be the total. Next, one more question connecting to this only. Keeping all the facts and figures of question number 20 and 21 unchanged, compute the GST liability of B&D company payable from electronic credit ledger under or electronic cash ledger as the case may be for the period covered under regular scheme. So first they asked composition scheme, then they asked 18(1)(c), then they have asked under regular scheme. Okay, actually this was a May 19 RTP question, and I thought they will be giving this question and all in exam. From 19 I was waiting, so they have not at all tested. I don't know whether they will be testing in future also, but you know, so thanks to this guy, he asked me, so I am discussing this. If at all this question comes now, so I will tell his name, Abhi Srivatsan. Okay, so you thank him. Suppose if it is not coming, you scold him only. I am not responsible. He only said, I did not tell. Then, so this question, slight change, kindly make the correction. That is 33,984 plus 48,600, 82,584, 82,584, 82,584. Then next one you see, keeping all the facts, we need to compute under regular scheme. Now see, again another torture. We need regular scheme data. Regular scheme data, how we will get? Problem is, from which date you are under regular scheme? 3rd October. 3rd October, we don't have full data up to October, but we have this stock as on 31st October. So again single entry, again single entry. So what is that single entry? Opening stock, opening stock plus purchases. So one second, I'll write here itself. Opening stock as on which date? Opening stock plus purchases minus closing stock equals to cost of goods sold. Opening stock as on which date? 3rd October I need the opening stock, okay. And purchases for which period? 3rd October, during the October, okay. October onwards, 3rd October onwards I need the purchases to 31st October minus closing stock. Closing stock as on which date? 31st October. Then I will get the cost of goods sold, okay. So now if you see what is the opening stock as on 310, just now we computed here, closing stock as on 210. What is the closing stock as on 210 that we computed? No, 6,77,600. 6,77,600 is the closing stock as on 210 for product P. So that should be taken, that is 6,77,200, okay. 6,77,600. 6,77,600 plus purchases. Purchases during October is 0, that is given. You can read this paragraph. During the October month they have not made any purchases. Then we need the closing stock as on 3110. What is as on 3110? 3,60,000. 3,60,000. Then you will get the cost of goods sold. 6,77,600 minus 3,60,000. 3,17,600. But this is what? Cost of goods sold. So for this cost of goods sold, you need to add profit. How much? 25. Sales 20% means one cost. How 20 are? From where are you came? Directly foundation you came for final or what? So 25% here. So 25% we need to add. 3,17,600 plus 25%, 3,97,000. So 3,97,000 should be taken as the sales of product P under regular scheme, okay. 3,97,000. Understood how we got 3,97,000? Next, on that GST we need to pay, that is CGST, SGST. Under regular scheme 9%, 9% into 9%, 35,730, 35,730. Now one more point which we missed, that GTA services, that 1 month will come under regular scheme na, inward supply under RCM. What is that inward supply under RCM? 20,000. On that 2.5%, 2.5%, this will come under RCM liability. Got it? Now can we leave like this? No, we cannot leave like this, because the problem is that during the month when you are under regular scheme, you have exempted supplies. When you have exempted supplies, you need to reverse the ITC. See this, ITC reversal on input services and ITC reversal on capital goods. So that data, because we are purchasing some capital goods and we are receiving some input services, you can see that working note number 1, first GTA services we received. GTA service 20,500, 500. On that also we will take ITC. Then again CGST, SGST paid to packing agency. For that also 30,000, 2,700, 2,700. So total credit 3,200, 3,200. What is the exempted turnover? So based on the exempted turnover we need to do reversal. Sir, how to find the exempted turnover? Just now you computed for product P, na? The same way you need to compute for product Q. So you will know what is the exempted turnover to total turnover. You understood? And thereafter you know that how much you need to reverse, 392 rupees. Same way capital goods also. Capital goods also ITC claimed on 210. So 48,600, 48,600. Thereafter on 15th October we are purchasing some capital goods, 18,000. So common ITC, again that common ITC, monthly ITC you need to get. 66,600 divided by 60 you will get monthly ITC. Monthly ITC into exempted turnover divided by total turnover. You need to do the reversal. So that is this. So you can see here how much is the ITC to be reversed and ITC avail. So net GST will be GST of RCM liability. Got it? So this is a wonderful question. At the time of starting the question, I told you na, if your time is bad, if you are getting this question gone like that, so that is this, because everything in input tax credit they gave. Inputs rule 42 is there, capital goods rule 43 is there, composition scheme is there, 18(1)(c) availment is there, and RCM liability. Everything they have given in one question itself. Okay, that is about this, and because of which I could not discuss one chapter. And see this. So now we will see one small chapter. Let's complete that. Time of supply. Please take time of supply chapter. Segment 6, time of supply. You can see here, first, time of supply. What is the objective of time of supply? Three objectives are there for time of supply. Number one, to determine the due date of payment of GST. That is, the due date of payment of GST for a transaction depends upon the time of supply for a transaction. For example, if time of supply for a transaction falls in July, we need to pay by 20th of August. If it is August, we need to pay by 20th of September, like that. And second point is to determine the exchange rate. In rule 34 in value of supply, we have seen whenever the transaction is denominated in foreign currency, like import of goods or import of services, export of goods or export of services is in foreign currency, we need to convert that into Indian rupees for payment of GST. For that we need to take CBIC rate or GAAP rate. Again, that rate prevailing on time of supply we need to take. So that is the second objective of time of supply. Third objective of time of supply is to determine the rate of GST, because on different dates there will be different rates of GSTs. So we need to see what is the time of supply for the transaction, as on time of supply what is the rate of GST that is relevant. So time of supply is relevant for these three purposes. Number one, to determine the due date of payment of GST, to determine the exchange rate, and to determine the rate of GST. But the time of supply for a transaction is in turn dependent upon the due date of invoice. That due date of invoice is given in section 31. In that section 31, we have total 6 subsections. In that 31, subsection 1, subsection 4 and subsection 7. 147 is for goods. Subsection 1 is applicable in normal cases, and subsection 4 is in case of continuous supply of goods. Subsection 7 is sale on approval or on return basis. First you need to see sale on approval or return basis, you need to check. Suppose if it is given in the question like sale on approval, means the product will be delivered, and if you like you will accept, otherwise you will return. So that is sale on approval or on return. So only when you accept, it is considered as sale. So therefore whenever you accept, at that time I need to raise invoice to you. What if you are not accepting within 6 months? On expiry of 6 months it is deemed that you have accepted, so I need to raise the invoice accordingly. Therefore 6 months from the date of removal or date of acceptance, whichever is earlier, will be taken as the due date of invoice. Number 2, in case of continuous supply of goods, continuous supply of goods means there will be successive supply of goods for which the payments are settled on a periodical basis. Then what we need to do is that check whether the payments are received irrespective of the account statement. Yes, if the payments are received irrespective of the account statement, the payment received date. If the payments are received based on account statement, the account statement date. So account statement date or the payment received date, as the case may be, should be taken. Say for example, I enter into contract with you to supply the chemicals through a pipeline, wherein first month, second month and third month you need to give me 2 lakhs, 2 lakhs, 2 lakhs on ad hoc basis. After 3 months I will give you an account statement and the differential amount you need to pay. So therefore first month, second month, third month, anyhow you need to give me 2 lakhs, 2 lakhs, 2 lakhs. So whenever you give me 2 lakhs, at that time I will raise the invoice for 2 lakhs. Whereas for all these 3 months I will give you an account statement na. In that account statement I will mention, say for example 6,86,000 minus 222 already you have given, so 86,000 I will give you an account statement. So that account statement date will be taken as the due date of invoice for the 86,000 portion. So for whichever amount that is mentioned in the account statement date, for other amounts the payment received date, that should be taken as the due date of invoice for continuous supply of goods. Continuous supply of goods means, remember, there will be successive supply of goods for which the payments are settled on a periodical basis. Then section 31 subsection 1, normal cases. In normal cases we need to see supply involves movement of goods or supply does not involve movement of goods. If supply involves movement of goods, we need to give invoice at the time of removal. If supply does not involve movement of goods, at the time of delivery or making the goods available to the recipient. Then in case of services, we have section 31 subsection 2, subsection 5 and subsection 6. Subsection 2 is normal cases. So normal, then subsection 5 is continuous supply of services. Subsection 6 is cessation of services. In case of cessation of services, that is immediately after completion of the service, abruptly stopping the service is known as cessation of service. Immediately after that cessation, they need to give the invoice with respect to the proportionate amount. Say for example, an actor entered into contract with the producer to act in the movie for 50 days. So he gave 50 days call sheet, and for each day he need to receive a remuneration of 1 crore. So 50 days into 1 crore, 50 crores is the remuneration. He acted for 5 days. Thereafter he is stopping the movie because he did not like the movie in which it is progressing. So due to that reason he stopped acting in that movie. But for 5 days he need to get the money. So immediately whenever he stops, so he need to raise the invoice for that 5 days. That is the due date of invoice in case of cessation of service. Whereas in case of continuous supply of services, for continuous supply of services means what? A service which takes more than 3 months to complete, and so both the conditions should be satisfied. It should take more than 3 months to complete and it should involve periodic payment obligation. Then only it is a continuous supply of service. For continuous supply of service, we need to check whether due date of installment is ascertainable from the contract. For example, construction contract is a continuous supply of service because it will take more than 3 months and there will be some periodic payments also, and they will specify the due date. Say for example, as on 31st March you have to pay this much money, and as on 30th April you have to pay this much money. Like that they have defined the due dates. Even rental agreement is also coming under continuous supply of services because the rental agreement will be for a period of 11 months and the periodic payments will be involved, and they will mention like by 5th of every month you need to pay the rental amount like that. So that 5th will be taken as the due date of invoice for that particular installment. Is it clear? So if the due date of installment is mentioned in the document, then the due date of installment will be taken as the due date of invoice. Suppose if the payment is linked to completion of event, again construction example, if you see, they will be mentioning like upon 30% completion you have to pay this much, upon 60% completion you have to pay this much, like that they will be telling the milestone events. So whenever the 30% or 60% completion happens, at that time we need to give invoice for that respective amount. Suppose in the absence of these two, where the due date of installment is not ascertainable from the contract, when the payment is not linked to completion of event, as and when we receive the installment, at that time we need to raise the invoice. That is in case of continuous supply of services. Whereas in normal cases, that is banking services, 45 days from the date of completion, and banking or insurance, other cases 30 days from the date of completion, that is the time limit for issuance of invoice. So this is the due date of invoice. What is the need of due date of invoice? Due date of invoice is relevant for the purpose of determining the time of supply, because if you see in time of supply for services we have time of supply under section 13, whereas for goods we have time of supply under section 12. So both 12 subsection 1 and 13 subsection 1 says that the liability to pay GST is determined based on the time of supply. Then subsection 2 talks about FCM. Both subsection 2 talks about FCM. Both subsection 3 talks about RCM. Then subsection 4 talks about vouchers. Subsection 5 residual cases. Subsection 6 interest, late fee or penalty for delay in receipt of consideration. But if you see the subsection 4, subsection 5 and subsection 6, the provisions are common between goods and services. Whereas in case of section 12 subsection 2, time of supply under FCM, goods FCM. For goods FCM, we need to see whether the person is opting for composition scheme or specified actionable claims. What are specified actionable claims? HC block, horse racing, casinos, betting, lottery, online money gaming and gambling. In that case, we need to take 3 dates. Due date of invoice, just now we determined due date of invoice, that due date of invoice, or actual date of invoice, or date of payment, whichever is earlier, which means whether they will pay GST on advances. Yes, if the invoice is next month and the due date of invoice also next month, then payment is received this month, they need to pay GST on advances. That's what we connected in composition scheme. We need to see the bill of supply and we need to add the advances received during the period minus advance of the past period, because it would have been taxed at the time itself. So in case of person opting for composition scheme and specified actionable claims, time of supply is actual date of invoice or due date of invoice or date of payment, whichever is earlier, and GST payable on advances. In other cases, it will be actual date of invoice or due date of invoice, whichever is earlier, only 2 dates. As date of payment is not there, whether GST payable on advances? No. GST not payable on advances in case of goods covered under FCM. Only for composition scheme and specified actionable claims we need to pay. Then time of supply in case of goods under RCM. First we saw goods under FCM, that is 12.2, 12.3 goods under RCM. We need to take 3 dates: the date on which goods are received by the recipient, date on which payment is made to supplier, or 31st day from the date of invoice. So the date on which recipient has received the goods. As it is RCM, we need to see from the recipient point of view. The date on which recipient has received the goods, the date on which recipient is making payment to supplier, or 31st day from the date of invoice, whichever is earlier will be taken. So whether GST payable on advances in case of goods under RCM? Of course yes, because date of payment is also one of the date. GST payable on advance in case of goods covered under RCM. Then next we have services under FCM, that is 13 subsection 2. Check whether the invoice is given within the due date. What is the due date? Just now we discussed 30 days, 45 days, continuous supply, etc. If the invoice is given within the due date, then invoice date, that is actual date of invoice or date of payment, whichever is earlier. So ADOI within DDOI, that is actual date of invoice, is given within the due date. Then date of invoice, which invoice? Actual date of invoice or date of payment, whichever is earlier. What if invoice is not given within the due date? If invoice is not within due date, then we need to take date of completion or date of payment, whichever is earlier. In both the places date of payment is there, which means GST payable on advances for services under FCM. Whereas what is taken as the GST, like time of supply in case of RCM, date on which payment is made to supplier, or 61st day from the date of invoice, whichever is earlier. And GST payable on advance? Yes, because date of payment is one of the date. So therefore GST payable on advances in case of services covered under RCM. So this invoice may be given by supplier or invoice may be given by recipient, that is based on the self-invoice. Then in case of vouchers, so this is about service under RCM. If you see RCM, goods RCM, service RCM, first date is not there and second date is there, and instead of 31st day here it is 61st day. In case of vouchers, so vouchers are divided into two: identifiable vouchers, non-identifiable vouchers. For identifiable vouchers at the time of issuance of voucher, non-identifiable voucher at the time of redemption of voucher. So today itself this is identifiable voucher, which means that I know against which product or service you are going to redeem. So therefore today itself I know the product, so I am paying GST. So for identifiable voucher, date of issuance of voucher. Non-identifiable voucher at the time of redemption. So whenever you are coming to my shop and you are redeeming the voucher, at the time only I know against which product you are going to redeem. So therefore that is taken as the time of supply. So in case of identifiable voucher, what if I have already paid the GST but you are not redeeming the voucher? Today I gave you the voucher and considering it as time of supply, I paid the tax, but you are not coming to my shop and redeeming it, and the voucher gets expired. Unnecessarily whatever GST I have paid, I can get it as a refund under excess payment of tax. Whereas in case of non-identifiable voucher, anyhow I will be paying GST only when you come and redeem. So if you are not coming and redeem, so the liability shall not arise for me. Then in residual cases, before moving on to residual cases, first of all, before applying residual cases, there is one more point. You can write that there. In case of goods under RCM, in case of service under FCM or RCM, please write down. In case of goods under RCM, in case of service under FCM or RCM, if time of supply cannot be determined. Why time of supply cannot be determined? Maybe you don't know one date. The date on which goods are received is not known, or the date on which payment is made to supplier is not known, or one date is not known here. Simple. In that case, time of supply cannot be determined. When time of supply cannot be determined, then what should be taken as the time of supply? Date of entry in the books of recipient should be taken. If we don't have that also, then only we need to come into residual cases. If not available, then residual cases under 12 subsection 5 or 13 subsection 5. So this is common for goods under RCM, service under FCM or RCM. Okay. First you need to see whether time of supply is possible as per regular provisions. No. Then you need to take time of supply as the date of entry in the books of recipient. If recipient data is also not available, then come into residual cases. Means what? We have evaded the tax. We tried to evade the tax. That's where residual case will come into picture. In that case, whether due date of return is available, which means that he is a registered person. Where the person is required to file returns means he is a registered person. Whatever is the due date of filing that return, that should be taken. Where the periodical return is not required to be filed, the date of payment of GST. Then 12 subsection 6 is interest, late fee or penalty for delay in receipt of consideration. As and when such additional consideration is received, that should be taken. Therefore, GST is payable on receipt basis. Related to interest, late fee or penalty for delay in receipt of consideration, remember few points. Point number 1, for that interest, late fee or penalty, so I am just writing it here, you can make note somewhere. So what are the special points? Special points for interest or late fee, interest or late fee or penalty, interest or late fee or penalty for delay in receipt of consideration, for delay in receipt of consideration. So what are those points? Number 1, what is the time of supply for this? For this interest, late fee, first it should be included in the value, correct? It should be included in the value, as per section, include in value as per under section 15 subsection 2 clause D. What is the rate applicable to this interest? There is no separate rate. There is no separate rate that is applicable to this interest. GST at invoice, GST at the rate mentioned in invoice, GST at the rate mentioned in invoice. So definitely you are not making the payment, for that only this interest is collected. So for that invoice, whatever is the GST rate, for example 12% means this interest also 12%. If in the invoice 18% is there, this interest also 18%. If in the invoice it is exempted, this interest also will be exempted. Number 3, what is the time of supply? Time of supply is on receipt basis. Receipt basis means whenever we are receiving, we need to pay GST. Okay, so it is not on accrual basis, only on receipt basis. Number 4, and always it is assumed to be inclusive of GST. So unless given in the question, always assumed to be inclusive of GST, always assumed to be inclusive of GST unless specified otherwise. Unless specified otherwise, it is always assumed to be inclusive of GST. Then what is the document that should be given in case of debit, in case of this interest? Debit note to be issued by supplier to recipient, to be issued by supplier to recipient. So these are the points that we have. So total 4 points. First, it should be included in the value under 15(2)(d). GST is at the rate mentioned in invoice. Time of supply is on receipt basis. Always it is assumed to be inclusive of GST. And finally, debit note to be issued by supplier to recipient. Okay. So that is this. So in case of interest, late fee or penalty for delay in receipt of consideration, it will be always taxable on receipt basis. So we completed the time of supply provisions. Now you can see here the additional points related to this. So date of payment. So in supplier's case also, recipient case also, so FCM also date of payment is there, RCM also date of payment is there. What should be taken as the date of payment? In case of supplier, date of entry in the books or date of credit in the bank account, whichever is earlier. From recipient point of view, when you see date of entry in the books or date of debit in their bank account, whichever is earlier. Then in case of goods, other than composition scheme or specified actionable claims, goods covered under FCM on advances, GST is not payable and GST is payable only upon invoice, as the time of supply is due date or actual date, whichever is earlier. But in case of services under FCM, GST payable on advances. Then up to 1000 rupees received in excess, of the invoice. So wherever we need to pay GST on advances, whenever we are receiving some excess amount, but that excess amount is up to 1000 in excess of invoice. For example, invoice is for 13,200 and we are receiving 14,000. So this 800 rupees which is received in excess is up to 1000 rupees. For that 800 rupees, either we can take this month in which the 800 rupees is received, or for this 800 anyhow we are going to give invoice in future. So that date. So we, at the option of the supplier, they can decide. So up to 1000 rupees received in excess of the invoice in case of service covered under FCM. Time of supply can be date of invoice or determined as per section 13(2). Supplier has the option to choose. So date of invoice means whenever for that excess amount we give the invoice in future, or the regular provisions of 13(2). What is regular provisions of 13(2)? Invoice date or payment date, whichever is earlier. So supplier has option to choose. What is the advantage of this? The advantage is that they can defer the tax payment. Then in case of supply of services between associated enterprises, as per section 92A of Income Tax Act, where the supplier is located outside India and the recipient is located in India, it is an import of services. Usually for import of services, the date on which payment is made to supplier or 61st day from the date of invoice, whichever is earlier should be taken. But in case of associate enterprises, date on which payment is made to supplier same. Instead of 61st day, the date of entry in the books of recipient should be taken. See this. Where the supplier is outside India and the recipient is in India, time of supply shall be date of entry in the books of recipient or the date of payment to supplier, whichever is earlier. Then point number 5, when the goods are taken outside India for exhibition, is it supply or not a supply? It is not a supply. But when the same is not brought back within 6 months, then this deeming fiction, sale on approval, will come into picture. So it will be deemed to be supply. Then section 14. Section 14 talks about time of supply in case of change in rate. First of all, when time of supply, that is section 14, will be applicable. Section 14 will be applicable between 3 dates there is a change in rate. What are those 3 dates? Date of supply, that is date of completion or date of invoice or date of payment. Between these 3 dates there is a change in rate. Also it is applicable in case of services, and it is applicable in case of composition scheme, and it is applicable in case of specified actionable claim. For all service providers, section 14 will be applicable. For goods, only 2 places it is applicable, that is composition scheme and specified actionable claim. For other supplier of goods, the section 14 will not be applicable. So between 3 dates there is a change in rate. First, if the completion is before change in rate, if the date of completion is before change in rate, then only 2 more dates are there. What is that? Invoice date or payment date. You take whichever is earlier. So date of invoice or date of payment, whichever is earlier should be taken. Suppose if the completion is after change in rate, again check the invoice date and payment date. If both are before, then whichever is earlier. If one before, one after, whichever is later. If both are before change in rate, whichever is earlier. If one before, one after, then we will take whichever is later. And usually what should be taken as the date of payment? Date of payment will be date of entry in the books or date of credit in the bank account, whichever is earlier. But for the purpose of section 14, if the payment is credited within 4 working days, if the payment is credited within 4 working days from the change in rate, then we need to take date of credit or date of entry, whichever is earlier. If the payment is credited beyond 4 working days from the change in rate, then we need to take date of credit in the bank account. Okay, here again we have one provision related to whichever is later, mark that. So date of invoice or date of payment, whichever is later. So as per section 14, what is considered as the date of payment? If the payment is credited within 4 working days from the change in rate, then entry date or credit date, whichever is earlier. If the credit in the bank account is beyond 4 working days, only the date of credit in the bank account will be taken. So this point, don't forget, you apply it only in case of section 14. Then there are 2 circulars related to this time of supply. So look into the first circular. So these 2 are newly added one amendment. First one, what is the time of supply in case of construction of hybrid annuity model projects under National Highway Authority? So usually what happens, the contractor will enter into contract with NHAI to lay down the road, and they will also be doing maintenance of the road, that is called as hybrid annuity model projects. In case of hybrid annuity model projects, what happens? So it is like a continuous supply of service, because it will take more than 3 months to complete definitely, and there will be periodic payment also, because the payment will be payable by annuities by the government. and yearly there will be operations also, operation and maintenance also, for which again some money will be received. So definitely this is not a normal supply of service, it's a continuous supply of service. HAM contract is a single contract where the supplier is responsible for both construction of highway and its operation and maintenance over a period. It is a continuous supply of service. When it is a continuous supply of service, what should be taken as the due date? Definitely due date will be determined as per section 31 subsection 5, which says that if the due date of installment is ascertainable from the contract, the due date of installment is the due date of invoice. If the payment is linked to completion of event, as and when the event is completed, and in the absence of that, as and when the payment is received. And what should be taken as the time of supply? The time of supply will be as per section 13 subsection 2. If invoice is given within the due date, invoice date or payment date, whichever is earlier. If invoice is not given within the due date, completion date or payment date, whichever is earlier. Listen, this is the point. Completion date or payment date, whichever is earlier. What will be taken as the completion date? Whether the completion date will be the actual completion of the project? No, it is not actual completion of the project. If invoice is given within the due date, no problem, invoice date, payment date, whichever is earlier. If invoice not given within the due date, then completion date or payment date, whichever is earlier. So what should be taken as the date of completion? The due date of installment only should be taken as the date of completion. That is why they have given this clarification. So please write down. Due date of installment is considered as date of completion. Due date of installment is considered as date of completion. Okay. So initially there was no clarity, and thereafter, so in study material they have given this, and clearly they have specified due date of installment is considered as the date of completion. And in every installment there will be interest component also. As there is interest component in every installment, so that should be included in the value or not? Yes, definitely it should be included in the value. Installment payable by NHAI include interest component, which is part of value as per section 15(2)(d). Now look into one question related to this. I have given one question on amendment for this. So that is question number 7. Question number 7. You can see this question number 7. Larsen and Toubro L&T has entered into hybrid annuity model contract with the National Highway Authority of India for the construction, operation and maintenance of a highway. The contract specifies that L&T will receive payment in 20 equal installment over 10 years. Each installment is 10 lakhs, which includes 1 lakh as an interest component. So definitely 10 lakhs will be taken as the value, because interest should be included in the value. The deemed date of completion of milestone event is 30th June. The due date of first installment is 1st July. What is the due date of installment? 1st July. And however, L&T issued the invoice for the first installment on 5th July. So is invoice given within the due date? No. And the payment was received on 15th July. The applicable rate of GST for such contract is 18%. What is the due date of invoice as per section 31 subsection 5? As per section 31 subsection 5, as the due date, first priority is what? Due date of installment ascertainable. The due date of installment is the due date of invoice. What is the due date of installment? 1st July. So that 1st July 2024 will be taken as the due date of invoice. Okay. Then next, what is the time of supply as per 13(2), and what is the due date of payment of GST? As per section 13 subsection 2, if invoice given within due date, then invoice date, payment date, whichever is earlier. Check when the invoice is given, 5th July. Is it within due date? No. So therefore we need to take date of completion or date of payment, whichever is earlier. Is the date of completion 30th June or 1st July? It is 1st July, because date of completion will be taken as the date of invoice, but not the date of completion of milestone event. So therefore kindly make the correction to your answer in the book, because initially I thought it was date of completion, but later on only I have read that properly. So therefore date of completion is the due date of installment. Due date of installment, that is 1st July 2024, or date of payment. What is the date of payment? 15 July 2024, whichever is earlier, that is 1st July 2024. If 1st July is the time of supply, then what will be taken as the due date of payment of GST? Next month 20, that is 20th August 2024 will be taken. Okay, understood this? Then next one, third part of this question, you see, calculate the GST liability for the first installment, that is same. Therefore, we need to take 10 lakhs into 18%, because entire 10 lakhs will be taken as the value including the interest component, so on that 18%. Then 4, what will be the time of supply if the invoice is issued on 1st July 2024? What is the due date? 1st July. Invoice also given on 1st July. So what should be taken as the time of supply, as invoice is given within the due date? So invoice date or payment date, whichever is earlier, same, that is 1st July only will be taken. So next month 20th will be taken as the due date of payment of GST. Understood this circular here? And related to this circular, I have given one more question. I coined one question in the test series. You can see that question. Okay. And so my humble request to all of you is that, so this May 25 exam, I have given the test series. Total I think 8 tests. In that 8 tests, 8 question papers with suggested answers, you take a print. It's open only. It is shared in the drive. So you take a print of it and you keep that and try to at least see that and go for exam. It's okay if you are not writing a test, but at least see that once, because lot of new type of questions, mainly on amendments, I have coined lot of questions, so that along with none of those questions is in this amendments, question on amendments, fully newly I have coined. So that also you go through, so that you will get a confidence to face the exam. Okay. Next, look into another circular, last part. After this I will complete. Listen please. So it's because of that guy only. He asked me to discuss those questions now. Then what is the time of supply in case of spectrum allocation services by government to telecom operators? What should be taken as the time of supply? Generally, government will be allocating spectrum to the telecom operators. If the spectrum is allocated before 1/4/2016, that will be exempted. But now if the spectrum is allocated, definitely it will be taxable, because we have one exemption. Assignment of right to use telecom spectrum by government to business entities before 1/4/2016 is exempted. But if it is after 1/4/2016, definitely it will be taxable. How to determine the time of supply? Will it be a continuous supply of service? Of course, yes. It is a continuous supply of service, because yearly they will be required to pay the royalty also. And this upfront payment will be there. Just to get the right, they have to pay upfront payment. That upfront payment may be payable at lump sum, that is in one shot, or they can make the payment in installments. Then how to determine the time of supply? In that case, even though it is continuous supply of services, they have not given the regular provisions. They have created a separate set of provision for that. Whenever the installment is due or whenever the installment is paid, whichever is earlier. Simple. Whenever the installment is due or whenever the installment is paid, whichever is earlier, that should be taken. And suppose if it is upfront amount, same. Whenever that upfront amount is due or whenever that upfront amount is paid. Option exercised by telecom operator. Either they can go for upfront payment or they can go for deferred payment. And whatever the case may be, you need to read this box. That's it. GST liability arises when the payment is made or due, whichever is earlier. Okay. And so in this case, GST liability arises as and when the installments are due or paid, whichever is earlier. Simple. Whenever it is due or whenever we are paying, whichever is earlier. Okay. How do we know the installment data? There will be something called as frequency allotment letter. Frequency assignment letter issued by Department of Telecommunication to telecom operator. There we will get the installment data, but that is when it should be paid. Don't consider that as the invoice. Cannot be considered as tax invoice. That's it. With the time of supply is over. Related to this, one question is there. You can see that question number 8. Question number 8. Reliance Jio has successfully bid for the allocation of spectrum by the Department of Telecommunication under the Government of India spectrum allocation model. The total bid amount for the spectrum allocation is rupees 1000 crores. Reliance Jio is given two payment options. Option 1, make a full upfront payment of 1000 crore on or before 30th June 2024. Option 2, pay 10 equal installments. The first installment is due on 1st July with each installment comprising both principal and interest. The installment amount considering an annual interest rate of 10% is as follows. They gave, this is the frequency assignment letter. I told you, na, they will mention which installment, how much is the amount and by when it should be paid, like that. The frequency assignment letter from DOT specifies this payment option, also states that GST at the rate of 18% applicable on the spectrum allocation. Assume that invoice is issued by DOT on 15 June. Actually, invoice is irrelevant here and you are required to determine the following. Number 1, determine when GST liability arises if Reliance Jio opt for full upfront payment and calculate the GST amount payable. Assume that the payment is made on 28th June. In case of full upfront amount, by when they should make payment? 30th June. When are they making payment? 28th June. Whichever is earlier will be 28th June. That's it. Then second, what will be your answer in one above if the payment is made on 5th July and such delay is condoned? Then 30th June. 30th June or 5th July, whichever is earlier will be 30th June. Determine the GST liability, timing and amount if Reliance Jio chooses to pay in installments and specifically calculate the GST payable for the second installment. Second installment due on 1st July but they are making payment on 30th June. So whichever is earlier will be 30th June. And what is the GST amount? 144 crore. But it includes interest, let it be. This is interest on account of delay in receipt of consideration that should be included in the value and chargeable to GST. And as 30th June is the time of supply, next month 20th, that is 20th July will be taken as the due date of payment of GST. What will be your answer? What will be your answer in 3 above? If the payment is made on 4th July and such delay is condoned by DOT, what is the due date? 1st July and 4th July, whichever is earlier will be 1st July. So next month 20th will be taken as the due date. Understood? So with that, time of supply is over. And tomorrow we will be discussing all other remaining topics. Okay, thank you.